So we are going to discuss the major area, assessment of companies. So first I will make an overall revision of the provisions, then we will go to the questions. So first of all, while computing the total income of a company, remember there will be only four heads: post property, PGBP, capital gain, income from other source. Clubbing provisions usually not applicable for a company because majority of the provisions of clubbing are applicable to an assessee which is not a company, usually individual HUF. But set off, yeah, definitely applicable. Some of the provisions of set off is exclusively applicable to companies, especially section 79, closely held company. As on the last day of the previous year in which loss is incurred, the persons holding at least 51% shares of the company, that person shall be present as on the last day of the previous year in which such loss is going to set off or carry forward by the company. That section 79 will be applicable exclusively for private companies assessment. And there are some other provisions exclusively applicable for companies under section 72A, that is in case of amalgamation, demerger, etc. predecessor's loss can be taken. So all those provisions will be applicable. Clubbing provisions won't be applicable. So computation of HP, PGBP, capital gain, IFOS, then set off, we will get the GTI. Once we got the GTI, the chapter 6A reductions possible for a company's, see, pay, for example, ATC, that's only for individual HUF, ATCCC, individual, CCD, individual HUF, ATCCH, CCE, that's cumulative limit, and ATCCH, Agniveer Corpus Fund, only individual, 80D, DD, DDB, all those are related to individual, EEE, EEA, EEB, interest, all those are related to individual. So 80G. So for companies, the chapter 6A will be 80G, and then 80GGB, 80GGB, if it is an Indian company, give donation to a registered political party or electoral trust, or advertisement expenditure incurred in the printed publication of a political party which is paid not in cash, that is also eligible under 80GGB. And then chapter 6 heading C, section 80 IA, IAB, IB, IC, so 80 JJAA, deduction for intercorporate dividend, section 80M. So all those deductions they can claim. And then after that, once we reduce the chapter 6A, then the next item will be section 10AA, special economic zone deduction. So after that, we will get the total income of the company computed as per the regular provisions of the income tax law. Once we got the total income computed as per the regular provisions of the income tax law, compute the tax on this total income. There are various tax rates are prescribed that we will discuss in detail. And then if it is a domestic company or whether it is a foreign company, sometimes there is an applicability of MAT, minimum alternate tax. So we should go to section 115 JB, compute the book profit and arrive the MAT and compare the both tax computed as per the regular provisions of the income tax law or MAT, whichever is higher is the tax liability. So this is the way normally the total income and tax liability of a company is computed. Now, first I will explain the different type of rates of tax applicable for domestic companies as well as foreign company. So company can be classified into two, domestic company and foreign company. In case of domestic company, at present there are total 4 type of rates of taxes available, 4 types. So in case of a normal company which is not following section 115 BAB or which is not opting for 115 BAA, those two sections are sections providing for concessional rate of tax, but the income should be computed without taking lot of benefits which is otherwise allowable under the tax law. So they have to forego that provision, then only they will get the benefit of BAB or BAA. So for a normal company which is not opting for 115 BAB or BAA and it is a domestic company, that is Indian company, domestic company, and that company's rate of tax will be 25% if the turnover during the previous year 22-23 does not exceed 400 crore. So remember, we are going to compute the tax liability of the company for the previous year 24-25. So determine the rate of tax for previous year 24-25. We should see the turnover for previous year 22-23. So if the turnover or gross receipts in the previous year 20 to 23 does not exceed 400 crore, then the rate of tax will be 25%. This is normal provision, normal domestic company which is not opting for 115 BAA or BAB. They will get every benefits, every incentives, every reduction of the income tax law they can take. Normal provision. And now, if the turnover of that domestic company during the previous year 20 to 23 exceeds 400 crore, then the rate of tax will be 30%. So this is actually the normal rate, 30. But this 30 will be reduced to 25 if the turnover in 20 to 23 does not exceed 400 crore. And then, if a company opted for section 115 BAB, that is especially a new manufacturing company which is incorporated in between a particular time period from 2019 to 2024, for those companies, there is a concession rate of tax 15%. And if the company is an existing company, not a new manufacturing company, it is an existing company, at any point of time, an existing company, a domestic company can opt for section 115 BAA. But 115 BAB is an on-time option. In the first year in which a company started business, they have to opt for section 115 BAB. Once they opted, they cannot change. But this, if they violate certain conditions of 115 BAB, then they will be out of BAB. In that situation, they can opt for BAA. So 115 BAB has to be exercised in the first year in which the domestic manufacturing company started production, subject to the other conditions to be satisfied. First year they have to opt. So subsequently they cannot opt for 115 BAB. But 115 BAA, at any point of time, an existing company can opt for 115 BAA. So both are concession rate. The most attractive section is 115 BAB. 115 BAB, the rate of tax is, basic rate of tax is 15%, and 115 BAA, the rate of tax will be 22%. Another advantage which can be enjoyed by these concessional rate of tax opting companies is they are not liable for MAT. And further, there is a disadvantage, there is a mandatory surcharge of 10%. See, in case of normal company, the surcharge will be applicable only if the total income exceeds 1 crore. If the total income does not exceed 10 crore, but it exceeds 1 crore, between 1 crore and 10 crore, the surcharge will be 7%. And if the total income exceeds 10 crore, the surcharge will be 12%. So that is for the normal company where the rate of tax is 25% or 30%. But for 115 BAB or BAA, irrespective of the total income, always the surcharge will be 10%. But their basic rate of tax is very low, 15 or 22. So these are the basic provisions regarding rate of tax of domestic company. So what about foreign company? Again, further, one more important provision you have to keep in mind. If a company, domestic company opted for 115 BAB or BAA, they are not liable for MAT. There is no need to compare normal tax with the MAT and whichever is higher. That's not required. So only for the normal company where the rate of tax is 25 or 30, they will be liable for MAT. So these two companies are exempted from MAT. And then foreign company. So foreign company means a company incorporated outside India. So even though due to the POEM guidelines, it may be resident in India, but still this rate of tax will be applicable. So for a foreign company, the rate of tax is 35%. And MAT not applicable in some cases. See, generally for a foreign company, MAT cannot be applied unless that foreign company has a fixed place of business in India or some permanent establishment in India, provided that company is resident in a country with which India has a double taxation avoidance agreement. But if that foreign company located in a country to whom India does not have a DTAA, in that situation we should see whether that foreign company required to take any registrations or license required under any law in India, then only MAT is applicable. So for foreign company, MAT applicability is conditional. So what is the basis for that? This is the basis for that. For applying MAT to a foreign company, these are the conditions. If there is a double taxation avoidance agreement between India and with the foreign country in which this foreign company is a resident, if there is a DTA, then we should see whether there is a permanent establishment as per the DTA in India, whether that foreign company has a permanent establishment. Permanent establishment means a fixed place of business, like a branch or office or outlet or warehouse or godown, something like that. A fixed place of business should be there in India. So that is known as PE. So if there is a double taxation avoidance agreement exists, yes. So whether there is a PE, yes, okay, then MAT is liable. MAT is applicable for that foreign company. If there is a double taxation avoidance agreement, but there is no PE in India, in that situation, MAT is not applicable. Only they have to pay the normal rate of tax, that is 35% only. MAT is not applicable. Suppose there is no double taxation avoidance agreement. Okay, if there is no double taxation avoidance agreement, then we should see whether to do business in India, whether that foreign company required to take any registrations or licenses required under any law. That may be a license to be obtained from RBI, or that may be a license to be obtained under FEMA, or that may be a registration required under any other authority in India. So as per any law in India, they are not specifying which law. Any of the requirement of a registration or license required in India for that foreign company, then MAT is applicable. If there is no such registrations or license are required in India, then MAT is not applicable. Again, even though there is a permanent establishment, or even though there is some registrations is required, but MAT is not applicable if that foreign company having business in India, but they are declaring income under the presumptive provisions applicable for a non-resident. 44B, shipping business of a non-resident. 44BB, exploration of mineral oil. And 44BBA, airline. And 44BBB, civil construction or turnkey power project. So if the foreign company have business income from India, but they are declaring PGBP income as per the provisions of presumptive provisions applicable to non-resident under PGBP, 44B or BB and BBA or BBB, and they have no other income. So only these income, and they are declaring income under these sections, then MAT is not applicable for them. Here we have to keep in mind, under section 44BB and 44BBB, for a foreign company, there is an option. They can maintain books of accounts in India and audit the books, and they can declare a lower income than the income prescribed under these sections. Okay, in that situation, definitely they have to pay MAT. They will be liable for MAT. So income must be declared as per the presumptive provision only in any one of these sections, and they should not have any other income in India. Then MAT is not applicable for the foreign company. So this is the applicability of MAT on foreign company. Okay, so if MAT is applicable to a foreign company, then we must compare the domestic tax, that is 35%, normal provisions tax 35, or compute the book profit of foreign company and compute the MAT, whichever is higher is the tax liability. And what about surcharge of a foreign company? If the total income of a foreign company exceeds rupees 1 crore but does not exceed 10 crore, the surcharge will be 2%. And if the total income of a foreign company exceeds rupees 10 crore, then the surcharge will be 5%. But for a domestic company, normal domestic company 7 and 12, here it is 2 and 5. And for BAB and BAA, mandatory surcharge 10%, but exemption from MAT. Now, what about a normal company which is not a BAA or BAB? Not a BAA or BAB, how the tax liability will be computed? So first one, as we discussed, tax computed as per the normal provisions of the income tax law, that is HP, PGBP, capital gain, IFO is computed, set of provisions made, GTI, chapter 6A, total income. On that total income, compute the tax. So while we are applying the tax, remember, if the total income includes the normal income, the normal rate of tax 25 or 30. If it contains long-term capital gain, flat rate, 111A short-term capital gain, flat rate, virtual digital asset, that is a Bitcoin or some type, that type of items transferred and income earned 30%. And if they have black money or unexplained income, that will be special flat rate. That will be amount to 60% and 25% and 4%, effectively 78% tax will be applied. So if flat rate income is there, remember, we must apply that flat rate. For normal income, 25 or 30, depends upon turnover in the previous year 20 to 23. So we compute the tax, and if the total income exceeds 1 crore or 10 crore, apply surcharge, then add health and education cess, we got the tax as per the normal provisions of the IT Act. Now go to the 115 JB section. As per the provisions of 115 JB, we have to compute the book profit of the company and then apply MAT. So MAT will be 15%, and if the book profit exceeds rupees 1 crore, then we should apply surcharge on MAT also, and then health and education cess, we will go the minimum alternate tax. So whichever is higher is the tax liability of a domestic company, which is not opting for 115 BAA or BAB. If a company opting for BAA or BAB, MAT is not at all applicable. Now, even though normal company means a company which is not opting for BAA or BAB, But if it is engaged in the business of life insurance, then MAT is not applicable, because life insurance company's income is computing at a special manner as per the income tax schedule. So MAT is not applicable for life insurance companies. Similarly, MAT is not applicable for domestic companies opted for BAA or BAB. MAT is applicable for foreign company, depends upon this criteria, whether there is a DTA, whether there is a PE. If there is no DTA, whether any registration required, or whether they are declaring income under presumptive, depending upon that, MAT applicability on foreign company should be verified. So these are the introduction main points you have to keep in mind as a summary, especially related to tax rates. Now, for a domestic company, prior to 1st October 2024, if a domestic company is making a buyback, the company has to pay buyback tax at the rate of around 20% plus surcharge plus cess. They have to pay buyback tax as per the provisions of section 115 QA, QB and QC. But with effect from 1st October 2024 onwards, the buyback tax has been abolished, and instead of that, the consideration received by shareholder towards the buyback will be taxable in the hands of the shareholder as a dividend under section 2 subsection 22 subclause F. And further, what is the cost of acquisition of that shares can be claimed as a capital loss. That means full value of consideration of shares subject to buyback will be treated as nil, and cost of acquisition can be claimed. So they can claim capital loss under the capital gain head. But remember, capital loss can set off only against a capital gain. Capital loss cannot set off against any other head. So actually it is a trap, because the consideration received for buyback will be separately taxed under IFOs as a dividend. And this will be the cost of acquisition of such a share subject to buyback can be claimed as a capital loss by the shareholder under capital gain head. So these two cannot set off. So definitely there will be a tax impact on that such a dividend. This is the position after 1st October 24. But before 1st October 24, domestic company has to pay buyback tax. So in addition to that, see, there is no other special tax. Apart from that, there is no other special tax applicable for a company now as per the provisions of the tax law. So now we can proceed to compute the MAT. How we will compute the MAT? See, MAT is calculated on book profit. So book profit means the net profit computed as per the provisions of the Companies Act. The statement of profit and loss prepared as per the Companies Act should be the basis. So from that, take the net profit. So you have to make certain additions which are prescribed under explanation to section 115 JB, and reduce certain items which are mentioned under explanation to 115 JB. Majority of that additions and deductions are to be debited or credited to P&L. Some of the items, if debited to P&L, we have to add back. Some of the items, if it is credited to P&L, we have to reduce. But certain items, even though not debited or credited to P&L, we have to adjust. So that is the base idea of computation of book profit. So we are going to find out the book profit. Remember, banking companies and even electricity companies, they are companies, but their profit and loss account or statement of profit and loss is not prepared as per Companies Act. There is some other law, Banking Regulation Act or Electricity Companies Act. So some other laws are governing their computation of statement of profit or loss. So in that situation, we cannot take the net profit as per the P&L. So they are saying, okay, no problem. So if their statement of profit and loss is prepared as per any other law, okay, then the net profit as per that statement of profit and loss should be taken, and then come to here 115 JB explanation. What are the items prescribed here? If debited to P&L, add back. If credited to P&L, reduce. We will get the book profit and compute MAT. So banking companies are liable for MAT, but insurance companies, life insurance companies are not liable for MAT. And how the book profit of a domestic company which are not opting for BAA or BAB, MAT is applicable. So how it will be computed? So there are two stages of computation for of book profit. Number one, if the company is following accounting standard, the company is not following Ind-AS. So not a big company, it's a small medium level company, not coming under the level 1 category. So that definitely there will not be Ind-AS, it's not mandatory. So if they are following books of accounts as per accounting standard, then book profit should be computed first. And then if that company is following Ind-AS, then further we have to make certain additional adjustments only for those companies which are following Ind-AS. So first, anyway, we have to compute the book profit as per this particular provision, 115 JB subsection 1, and then we should make additional adjustment in case of Ind-AS compliant company. For examination, they tested both normal company which is not following Ind-AS, or sometimes they may ask questions on Ind-AS followed company. So first we will study the computation of book profit of a normal company which is not following Ind-AS. So first we should take the net profit as per the statement of profit and loss prepared as per Companies Act or as per some other law. So take the net profit. Add these total, there are mentioned 13 items. So practically 11 or 12 items will be relevant. Some of the items are not relevant for your exam point of view. Practically it is relevant, but for exam point of view, they won't ask because it's very complicated. That's why. So what are the items which should be added? So number one, if the profit or loss account of this company debited income tax, dividend distribution tax, interest on income tax, surcharge on income tax, whether income tax paid or provision for income tax or advance tax or past income tax demand paid now debited to P&L. So any income tax related payment, but remember they are not mentioning penalty. If the P&L account debited with income tax penalty while computing book profit, please do not add back. That's not in the list. So it's very clear. Income tax, dividend distribution tax. Nowadays there is no DDT, it's abolished. Interest on income tax, surcharge on income tax, whether it is paid or payable or maybe provision for income tax, if debited, add back. And second one, amount transferred to any reserve. If there is any appropriation, see what is the idea behind adding back income tax, DDT, interest, etc. See, we need the profit before providing for tax. So we need the profit before tax. See, on the book profit, company want to levy a particular tax, right? Book profit means profit before appropriations, profit before tax. So that is why we are add back income tax, DDT, interest, surcharge, and then amount transferred to any reserve. Any reserve means it may be a revaluation reserve, or it may be capital reserve, or it may be general reserve, or it may be debenture redemption reserve, or it may be foreign exchange fluctuation reserve, or it may be any other reserve. Even sometimes may be due to the guidelines issued by Institute of Chartered Accountants of India, we are creating some specific reserves and we are transferring that. Yeah, we have to add back. Sometimes that reserve may be created due to the guidelines of the RBI. See, any reserve, you have to add because it's an appropriation, unnecessarily going to reduce your current year profit. So that's why add. And third, provision for unascertained liabilities. Unascertained liability. Unascertained liability means it's not a determined liability. So we can say example, see, if for employee benefits or provision for gratuity, if provision is created as per the actuarial valuation, we can say it is an ascertained liability. But if the provision for gratuity is created not as per actuarial valuation, unascertained, we have to add back. Provision for warranty is debited. If the provision for warranty is created as per the scientific method valuation based on historic data, proper analysis is made, and in past year, what are the goods for which a complaint arises? Warranty has to be provided. So what are the corrective measures taken by the company to eliminate that these type of complaints? So after analyzing all the scientific data, statistical data, we created provision for warranty in a systematic manner. Then it is ascertained. Simply creating provision for warranty, unascertained. So provision for leave encashment is created. See, if leave encashment is created only on estimation basis, unascertained. But clearly we are calculating the leave eligibility, leave balance and creating provision ascertained. So a lot of examples we can say, but in exam purpose usually they will say provision for gratuity not as per actuarial valuation, or sometimes directly they will say unascertained liability. But remember, if they want to ask a question in a very tough manner, they can do like this. They will say provision for warranty. They will say not as per scientific methods. Provision for leave encashment based on last year's estimate. Then it is unascertained. There was a dispute whether provision for bad and doubtful debts is a ascertained liability or unascertained liability. There is an old Supreme Court case, Hindustan Computers Limited, HCL Comnet Systems Private Limited. So in that case, a dispute arises. The dispute is whether provision for bad and doubtful debts can be treated as an ascertained liability or unascertained liability. So department is of the view that provision for bad and doubtful debts is an unascertained liability. So they want to add it back while computing book profit of the company. But company is saying, no, it is not an unascertained liability, it is an ascertained. The dispute went to the Supreme Court. So Supreme Court decided provision for bad and doubtful debts is usually created by a businessman who is following mercantile system of accounting. Practically, majority of most of the companies are following mercantile only. So they will create provision for bad debts. Why provision for bad and doubtful debts is created? Because see, it's a prudent business decision. A businessman, out of his experience, he may know, okay, these debtors not going to recover. So I have to create provision. So they will create a provision. It is a prudent, pakka commercial business decision. See, a businessman, he will not create provision for bad debts if it is not sure, right? Only if he is sure that he is not going to get that money out of his past experience, he will create provision. So Supreme Court say that provision for bad and doubtful debts is an ascertained liability. It is not unascertained. So department was not happy with that decision. As usual, department amended. So they are saying provision for diminution in the value of any asset if debited to P&L, it should be added. So actually it is targeting provision for bad and doubtful debts. Due to this decision, they put that amendment. So the next item, provision for diminution in the value of any asset. So even though they created the word provision for diminution in the value of any asset and targeting provision for bad debts, but practically it will affect some other cases also. See, provision for bad and doubtful debts is going to diminish the value of sundry debtors. So that is why it should be added. See, sometimes as per the provisions of AIF 28, sometimes people will debit provision for impairment. So if they create provision for impairment in the debit side of the P&L, it is going to reduce the value of assets. So provision for impairment should be added because of this provision while computing book profit. Provision for diminution in the value of any asset. Sometimes as per accounting standard 13, valuation of investments, sometimes the short-term investments which is held in the balance sheet, as on the balance sheet date, we will compare the value with the market value. If there is any diminution, we will debit to P&L. So that is also going to reduce the value of investments. That should also be added. So provision for bad and doubtful debts, impairment provision debited to P&L, and provision for reducing the value of investments due to compliance with any AS or any other direction. So all these items must be added due to this particular point, diminution in the value of any asset. So unnecessarily reducing your current year profit, purely notional. The next one is provision for losses of subsidiary companies. Under the tax law, holding company is a separate entity, subsidiary company is a separate entity, both are different. So two different assessees. So if holding company is debiting provision for losses of the subsidiary, it is unnecessarily reducing the profit of the holding company. So it should be added. It's purely notional. It should be add back. The next, dividend paid or proposed. Dividend paid or proposed is actually an appropriation. So it must be add back if it is debited to P&L. Remember all these items, if debited to P&L, add debited to P&L. If it is not debited to P&L, should not be adjusted. If debited to P&L, add back. And then depreciation. Depreciation, why we are adding? Because depreciation is a real allocation. It's a real expense. Why it is add back? See, the purpose behind adding depreciation is under the provisions of the books of accounts or as per the provisions of accounting principles, sometimes they will create some revaluation on the assets, and for the revalued figure they will provide depreciation. For computing book profit, they are saying the real depreciation should be reduced. You should not reduce, should not debit notional depreciation on revaluation. So for that purpose, they are saying simply add back full depreciation and reduce real depreciation excluding depreciation on revaluation. So the net effect, only the real depreciation will be allowed. So that's the only purpose behind adding this particular depreciation. So if there is no revaluation on depreciation, if there is no depreciation on revaluation, then no need to add back this item. So first add full depreciation, then reduce depreciation excluding revaluation on depreciation on revaluation. The real depreciation we can reduce. Then if an income is exempt under section 10 or 11 or 12 under the normal provisions of the income tax law, then it should be exempted from MAT also. If an income is exempt under normal provision, it should be exempted from MAT also. For that purpose, they are saying if the P&L account contains an exempted income in the credit side and expense of that exempt income in the debit side, simply eliminate. So please take it away from the P&L because it is exempted under the normal provision. MAT also exempted. Under the provisions of MAT also, it is not, no tax is payable on such income. So how to eliminate from the P&L? If expense relating to exempt income under section 10 or 11 or 12 is debited, add back. And in the P&L account credit side, if there is exempt income under section 10 or 11 or 12 is credited, reduce. So that simply it is taken away from the P&L. So this is the idea behind adding this. So agriculture expense debited to P&L, add back. And if some other similar type of exempt income under the P&L, if it is debited related to an exempt income of under section 10 or 11 or 12, it should be add back. And then remember 10, 11, 12, they are not saying 10 AA. Actually 10 AA is not an exemption. Section 10 AA is a deduction. So if there is 10 AA expense in the P&L debit, please do not add. If there is 10 AA income in the credit side, please do not reduce. 10 AA is not an exemption. It is a tax planning. It is a deduction. First we will compute the income in PGBP, and after chapter 6 we are reducing. Even though the number is 10 AA, remember it's not 10. It is after 10 they put a separate section 10 AA. Section 10 contains almost 52 subsections, 10.1, 10.2, 10.2a, 10.3 like that. So they are here section 10 means those subsections, not 10 AA. For 10 AA book profit, 10 AA special economic zone profit, you must pay MAT. MAT is applicable on 10 AA with effect from 2012. So prior to 2012, even MAT is not applicable for 10 AA also. So at that time, the software companies, they enjoyed a lot of exemption. Complete income was tax free, no tax at all. But after 2012, under the normal provisions, they will claim 10 AA. So income will be zero. But here they should pay MAT. So they will be liable for MAT. So expenditure relating to exempt income under section 10 or 11 or 12, if debited, add back. The next one, deferred tax or provision for deferred tax, if debited to P&L, it should be added. So why it is adding back? Because it's absolutely notional. Accounting stand 22. As per accounting principle, it is a beautiful concept, but when it is come to the tax law, it is purely a notional item, unnecessarily reducing your current year income. So it should be add back, deferred tax provision. See, remember this item can be in the other side also. Deferred tax credit may be there in the P&L. Similarly, expense relating to exempt income under section 10, 11, 12, there will be credit side exempt income that they will reduce. Then next one, expense relating to share income from an association of person in which this company is a member. Remember this particular company is member in an AOP. If company is a member in an association of person, normally the income of the AOP will be liable to tax at the maximum marginal rate, or sometimes it will be taxable at a 30%. So if the AOP is taxable at MMR, maximum marginal rate to tax, then whatever share income received by the members will be exempted from tax, because AOP already paid a tax at a very high rate. So the member share will be exempted. So if a company is member in an AOP, definitely the AOP will pay tax at MMR rate. So in those situations, the share income received by the member is exempted. So this is a company which is a member in an AOP. So this company is getting share income from the AOP, and that share income may be credited to P&L, and the expense relating to that share income is debited to P&L. Please take away from the P&L, eliminate. Please delete from the P&L, because under the normal provisions of the income tax law, it is exempted. So MAT also, it should be exempted. Otherwise, what is the purpose behind introduction of an exemption? Normal income tax exempted, but MAT is payable. Then what is the point in exemption? So that is why, similar to 10, 11, 12 exempt income, this is also same concept. So expense relating to share income from an AOP, if debited to P&L, add back, and if this share income received credited to P&L, reduce. They will study at the other side. Then the next item, applicable only for a foreign company. If the question asking for computation of MAT of a foreign company, then only you should think about this, the next item. Otherwise, it is not applicable for domestic company. See what this section says. Item says, expense relating to income of a foreign company from capital gain from securities, interest income, dividend income, royalty income, fees for technical service taxable under chapter 12, whose rate of tax is lower than MAT rate. See, capital gain from securities, interest income, dividend, royalty, FTS. See, majority of these items are taxed at a flat rate. and it is provided under chapter 12 means section 115A, 115AB, AC, AD. That is flat rate taxing income, mainly 115A. So even non-resident is getting interest income from India. Sometimes it will be taxable at 5%, sometimes 4%, sometimes 9%, and sometimes 20%. See, they are saying if these type of incomes are taxable in the hands of the non-resident at a flat rate, and if that flat rate is lower than MAT rate. So what is a MAT rate? MAT rate is 15. So if the rate of tax of these income is lower than 15, then MAT is not applicable. So if the income is taxable at a rate more than the MAT rate, okay, then definitely MAT is applicable. So we can say an example, if the foreign company is getting some interest income from India, and that foreign company also has a PE in India, so MAT is applicable on that foreign company, but their interest income is taxable at a concessional rate of 5%, then for such concessional rate taxing income, MAT is not applicable. So if that income credited to P&L, reduce. If expense related to that income debited to P&L, add back. But regarding royalty, this provision won't be applicable because royalty, the rate of tax is 20, FTS, the rate of tax is 20, dividend, the rate of tax is 20. So 20 is more than 15. So in those cases, MAT will be applied. So only if the income of non-foreign company from India comprises capital gain from securities, interest, royalty, FTS, and if the rate of tax, flat rate of tax is lower than the MAT rate, then for such incomes, MAT is not applicable. Because why lower rate is provided under the tax law? To give some concessions and to attract more investment into that particular area. There is a policy for the government. That is why they are giving some concessional rate. See, once they provided concessional rate in normal provisions of the tax law, but in the other side, in the parallel computation, if they are levying 15%, which is more than 5, then they will question what is the point in providing lower rate of tax? Even though under the normal provision you are saying lower rate of tax, in the parallel tax you are taxing 15. Then what is the point in lower rate? I am paying higher rate. So that is why if the lower rate is provided than the MAT rate, there are a lot of purpose behind that. To help foreign institutional investors, to attract more investment in India, to accept more fund in a particular sector. So that is why they are creating some concessional rate. That is as part of some government policy, high level policy. So on that MAT, if we apply the MAT, then there is no point in reducing the rate of tax under the normal provisions. So that is why expense relating to income of foreign company from capital gain, only capital gain, interest, dividend, royalty, FTs, only if the flat rate, chapter 12, flat rate, that is chapter 12, 115A, AB, AC, AD, flat rate. So if that rate of tax is lower than MAT rate, then that particular item expense should be added, and if that particular income credited to P&L of the foreign company, reduce it. Debit, add. Expense, debit, add. Credited income, reduce. So that it can be eliminated from MAT also. MAT also not applicable on such income. That's the meaning. And then expenditure relating to royalty income under section 115 BBF. Actually 115 BBF is a concessional rate of tax section that is applicable for a domestic company or a resident if they develop a patent or a particular technology in India, and majority of the research expenditure has been spent in India, and once you obtained that technology, please register that technology in India as per Indian Patent Act, and then you give that patent to some other person and gain royalty income. If you do like that, your royalty income will be taxed at a concessional rate of 15%. It will be taxed at a concessional rate of 15%, right? So that is 115 BBF. So what is the idea? In order to prevent the practice of some of the Indian companies, they will find out certain technology, but to avoid the tax, they will not register that technology in India. Instead of that, they will register that technology in a tax haven country. So the patent will be registered in some tax haven country, and then that technology will be given to Indian companies, and they will get royalty income from India. So in that technology is registered or patent is registered in a tax haven country. So what happened is this income will be taxed in that particular country, but that country is actually a tax haven country, so there is no tax. This royalty is received from India. Definitely there will be a double taxation avoidance agreement between India and that tax haven country. As per that DTAA, this royalty income from India will not be taxable in India, it will be taxable there only. Exemption method will be provided. For example, Mauritius, India, Mauritius DTA. So ultimately what will happen? Royalty income generated from India, and it will be taxable only in the tax haven country, but in the tax haven country there is no tax. India cannot tax because as per section 90 subsection 2, double taxation provisions will override domestic law. So what is the net effect of what is the impact? So India is losing tax revenue. Actually, this technology is invented in India. So the resources has been used from India. So good research students has been recruited from India, and majority of the research work has been carried out in India. But at the point of time when the technology is invented and they want to register it, they will stop the complete operations in India and they will move to a tax haven country. They will register there. It's a fantastic way of tax planning or tax evasion, whatever it may be. Actually, it is a tax planning. It's not an evasion. People are not ready to pay high tax. That's why they are moving. So government thought they changed their policy. Okay, then government is saying, oh, see, please don't go. We will give you some concessional rate. Please register your technology here only. We want to tax at a higher rate. We'll give you some concessional rate. So that is the idea of 115 BBF. So what is the purpose? What's the conditions? It will be taxable not at 15%. It will be taxable at a flat rate of 10% concession rate. Royalty income from patent is taxable 10% on gross basis. Expense is not allowed. It will be taxable on gross basis. Expenditure cannot be claimed because the rate of tax is only 10%. So that is why expense won't be allowed. Conditions: resident assessee first, he must be the first or true inventor. At least out of the total research expenditure, at least 75% research expenditure should be incurred in India, or it should be incurred in India to develop the patent, and that patent must be registered in India as per Indian Patent Act 1970. And further, it is an optional section. If you want to claim section 115 BBF, some sort of a lock-in period is there. Continuity is required, at least 5 years. If you opted for 115 BBF for assessment year 25-26, then next 5 assessment years also you must continue under 115 BBF. And option to be exercised before the due date for filing ITR. Once you opt out within this 5 year, then you cannot opt out for the next 5 years. Again, you cannot re-enter. Just like that 44 AD, there is a 5-year lock-in period condition that is applicable here also. See, what is a normal rate of a tax for a company? 25 or 30. If it is BAA or BAB, okay, then 15 and 22. You see, here the rate of tax is 10%. The only disadvantage is expense is not allowed. That's okay. Only some minor expense will be there because patent is already registered and the technology is given. We are getting royalty income. Expense is very nominal. So expense is not allowed. The rate is 10%. It's very attractive. Instead of taxing 25 or 30, it is taxing 10% means it's fantastic. So definitely company will choose this. So that is 115 BBF royalty income. See, what is a normal rate of tax? 10%. See, normal rate of tax is 10%, concessional rate. See, if MAT is applied, the MAT rate is 15%. Then what is the point in giving 10%? So even the normal tax, there is no, only 10% is tax. MAT is 15%. MAT will be higher. So they have to pay MAT. So that is why MAT is not applicable. So it's absolutely fantastic, this particular provision. It's very nice. So no MAT. So under the P&L account, if the expenditure related to this royalty income is debited, add back. And if credited, reduce. So that will be eliminated from P&L. No MAT. And under the normal provision, they have to pay 10% without expense. So that's a provision of 115 BBF. There is one more section at a 10% concessional rate of tax, that is income from sale of carbon credit. But remember, income from sale of carbon credit, MAT is applicable. MAT is applicable. 115 BBG. That is also taxed at a flat rate of 10% without any expense. But remember, there is no concession, MAT is applicable. But BBF, royalty income, if the expense is debited to P&L, add back, and credited to P&L if that BBF royalty income reduce. Now, next item what we have to add back is revaluation reserve of retired or disposed asset only if it is not credited to P&L. So when an asset is revalued in an upward revaluation, we will create revaluation reserve. As per the accounting principle, when that revalued asset is disposed or retired, that revaluation reserve must be closed. It should not be further, you should not keep that reserve, because this revaluation reserve is created for a particular asset and that asset is no more, then that revaluation reserve must be closed either to the asset account or to the P&L account at the time when that asset is sold or disposed. But some companies, they will have a manipulation. They will not close that revaluation reserve. It will be kept in the balance sheet even though that asset for which a reserve is created has been disposed. So to prevent that practice, they are putting this provision. So that revaluation reserve related to retired or disposed asset, if it is not credited to P&L, then we have to add back. Remember, all other items are debited to P&L, add. But this item is not debited in P&L and it is not credited in P&L. If it is not credited to P&L, add back. So for exam point of view, it will be given in the further information only. It won't be there in the P&L. Only in the further information they will say there is a revaluation reserve in the balance sheet which is related to a retired asset. That asset is sold in last year or sold in current year, but the revaluation reserve is still keeping in the balance sheet. Yeah, just take that and add. These are the major items we have to add back while computing the book profit. And then what are the items to be reduced? Remember, out of these 1 to 12, if debited to P&L, add. But the last item, if not credited to P&L, add back. If it is already credited to P&L, do nothing. So if not credited to P&L, add back. Now what are the items which should be reduced from the P&L to arrive at the book profit? Number 1, amount withdrawn from any reserve other than revaluation reserve and credited to P&L. Maybe withdrawn from general reserve or withdrawn from capital reserve or maybe withdrawn from debenture redemption reserve, whatever may be, except revaluation reserve. Because for revaluation reserve, there is a separate adjustment. That is why. So amount withdrawn from any reserve and credited to P&L, you have to reduce. Because these reserves are created in past years. And in the current year, we are withdrawing some amount from that reserve and credited to P&L means it is not current year's income. Unnecessarily, your current year income is increasing. Then why you are paying MAT on that profit which belongs to past years? So that is why it should be reduced. And second one, if you withdraw amount from revaluation reserve and credited to P&L, then such amount should be compared with depreciation on revaluation, if any. So if these two figures are there, compare these two figures, take the lower figure, that should be reduced from net profit. So remember, amount withdrawn from RR, revaluation reserve, and credited to P&L. Okay, for example, 3 lakhs withdrawn from RR and credited to P&L. So current year, there is a depreciation on revalued assets. So depreciation on revalued portion is 2 lakhs. So withdrawn from RR and credited to P&L 3 lakhs. Depreciation revaluation is 2 lakhs. So 3 or 2, whichever is lower. Only 2 lakhs you have to reduce. So from any other reserve, if any amount is credited to P&L, straight away, blindly we can reduce. But RR, withdrawn from RR and credited to P&L, we must make a comparison with the depreciation on revaluation, and whichever is lower only must be reduced. So if there is no depreciation on revaluation, that is 0, and amount is withdrawn from RR and credited to P&L, whichever is lower means 0, we cannot reduce. So don't do that. So compare these two, lower should be reduced. Deferred tax credit, if they're in the P&L, it's unnecessarily going to increase your current year income. That is a purely notional item, so reduce it. Just like debit, add, credit, reduce. Amount of exempt income under section 10, 11 and 12. Normal income, it is exempted. Under the MAT provisions also, exempted. So reduce. Example, agriculture income credited to P&L. And then profit of a sick industrial unit, or we can say if a company is referred to BIFR for reviving, it's already sick. The accumulated losses is more than 50% of net worth of the company. So we can say it is a sick industrial unit. So profit of a sick industrial unit, see that company is trying to recover. So if we levy 15% MAT on that, the death will be complete. So don't do that. So profit of sick industrial unit reduce. Share income from an AOP in which a company is a member. Yeah, already we discussed. If company is a member in AOP, company has to pay tax at MMR. So it is so the share income of the member will be exempted. So that is why. Just 1 second. if the share income of a member from AOP will be exempted if AOP is taxed at MMR. If company is a member, definitely AOP has to pay tax at MMR or at 30%. In that situation, the member's income will be exempted. So, under normal provisions of the income tax law, it is exempted. Under MAT also, it is exempted. So, that is why it should be reduced. Share income from AOP in which a company is a member. And then, royalty income referred under section 115 BBF that we already discussed. It is a tax at a concession rate of 10%. So, if again MAT is levied, it's not good. So, that is why it is reduced. It has to be reduced. Next one, only applicable to foreign company, that is interest, dividend, royalty, FTS, capital gain, which are taxable at a flat rate under chapter 12, where the rate of tax is lower than 15% and that income is credited to P&L, reduce. Then depreciation, it is a separate adjustment. Remember, it is not in the credit side of the P&L. We have to do separately. Depreciation, excluding depreciation revaluation, we have to reduce. See, first of all, we added the total depreciation, including depreciation on revaluation. When we reduce real depreciation, other than depreciation revaluation, we have to reduce. So, net effect, depreciation on revaluation is not allowed. That's the idea. And then next one is a separate item. So, remember, after the 8th item, these two items are separate. We have to check the further information. Then we have to make this adjustment. Brought forward business loss or unabsorbed depreciation, whichever is lower as per books of account, has to be reduced. See, whichever is lower as per books of account. Usually under the books of accounts, we won't say business loss and unabsorbed depreciation. We will say total loss, but we need the breakup. It is not as per tax law, as per books of account. So, business loss or unabsorbed depreciation, whichever is lower, should be reduced. So, if there is unabsorbed depreciation, but if there is no business loss, then business loss is 0. 0 or unabsorbed depreciation figure, whichever is lower, 0. So, only if there is two figures, business loss as per books brought forward and unabsorbed depreciation as per books brought forward, then compare these two, whichever is lower must be taken. Remember, under the normal provisions of the income tax law, we are taking brought forward loss or unabsorbed depreciation as per income tax law. As per section 72 carry forward, we will consider. But here, as per books of account, whichever is lower. See, normal provisions of the income tax law, we can set off the brought forward losses. So, in book profit also, it should be permitted. That's a basic idea behind this. But under the tax law, first we can reduce brought forward business loss, and last we can claim unabsorbed depreciation also. But here, both is not permitted. Whichever is lower is permitted. But both can be reduced in case of a company which is filed IBC application, or board of directors of the company has been suspended and the central government appointed new board of directors and subsidiary of such a company. In certain special situations, both can be reduced. Brought forward business loss and unabsorbed depreciation as per books, both can reduce. In all other cases, generally, whichever is lower only must be reduced. Here also sometimes there may be multiple years business loss and unabsorbed depreciation will be given in year wise. So, if you take each year, compare business loss, unabsorbed, lower, business next year, business loss, unabsorbed, lower. If we take horizontal, we will take a figure. But if you take vertical approach, total business loss and total unabsorbed, whichever is lower for multiple years, their figures will be different. So, which approach should be taken? If multiple years business loss and unabsorbed depreciation is given separately, year wise separately, whether we should take the horizontal approach or whether we should take the totality or vertical approach. So, there is a High Court decision. High Court clearly mentioned we should take the totality approach, because usually accumulated depreciation means the principle is it is total. So, totality approach. So, don't compare each year's business loss and unabsorbed depreciation separately. Don't do that. 2019-20, 2020-21, 21-22, 22-23. 4 years business loss, unabsorbed. Take the total of business loss, take the total of unabsorbed depreciation, whichever is lower. Not individually year wise lower. Don't take like that. So, we will get the book profit. So, when we can claim these both, okay, both means business loss and unabsorbed depreciation, both can be claimed. If it is a company on which insolvency and bankruptcy code application has been given, or that application is processed, or the company's board of directors has been suspended and central government nominated directors under section 241 and 2 of the Companies Act. In those companies cases, we can reduce both. So the brought forward business loss and unabsorbed depreciation as per books both can reduce if the company against whom application for corporate insolvency resolution process has been admitted. Similarly, both can reduce for a company and its subsidiary company and subsidiary of such a subsidiary where central government suspended board of directors and new directors nominated under section 241 or 242 of the Companies Act. And now, so once we made all these adjustments, we will go to the book profit. On this book profit, we have to apply MAT rate 15% of book profit. But if this company has a unit located in International Financial Service Center, that is GIFT City, Gujarat, and its entire activities are carried out in foreign currency, then their MAT rate will be 9%. So sometimes a company may have two units, one unit within IFSC and other unit outside IFSC. Then we have to compute the book profit separately for IFSC unit and separately for domestic unit because the MAT rate is different. For domestic cases, 15%, but if the unit is located in IFSC, the MAT rate is 9%. So 15% of book profit MAT rate, and if the book profit exceeds 1 crore but does not exceed 10 crore, then surcharge will be 7% on MAT. And if book profit exceeds 10 crore, surcharge will be 12% in case of a domestic company. In case of a foreign company, surcharge will be 2% or 5%, depends upon book profit exceeds 1 crore or 10 crore. Then add health and education cess, we will get the MAT. And this particular MAT should be compared with, as we discussed earlier, the total income computed as per the regular provisions of the income tax and what is the tax. So that tax or this MAT, whichever is higher, is the tax liability. If MAT is higher, MAT is the tax liability and the book profit will be deemed to be the total income of company for that year. But if normal income tax is higher, then MAT is not applicable. Normal income tax and normal total income will be considered. If MAT is higher than normal income tax, excess of MAT over normal tax can be claimed as MAT credit. As usual, 115 JAA, it can be carried forward for maximum 15 assessment years, and subsequent years this MAT credit can be utilized only to the extent normal income tax exceeds MAT. Only to that extent we can utilize the MAT credit, remaining again should be carried forward. So within 15 years you have to utilize, otherwise it will lapse. And again this MAT credit is not transferable. So if this company suppose converted into an LLP, this unutilized MAT credit will not be available to the new LLP. And similarly, if a domestic company have a MAT credit, but subsequent year this company opted for 115 BAA concessional rate of tax. In that situation, MAT is not applicable for such a company which is opting for 115 BAA. In that particular year, if there is any unutilized MAT credit available with this company, that shall lapse. Okay, so these are the main point regarding MAT. So for the recent trend, there is a last attempt or prior to that last attempt also they are not asked MAT. So there is a possibility we can expect there may be a book profit computation or MAT computation this attempt. We can expect September or January. And one more point, the next one is Ind-AS compliant company, if how the MAT will be computed. Actually, the book profit computation, what we studied now is equally applicable for Ind-AS compliant company. No difference. Only thing is, in addition to this, there will be additional adjustments for a company which is followed the books of accounts under Ind-AS. Additional adjustments. So these adjustments are common. Anyway, we have to study this. This is common for all company, whether following Ind-AS or not. So for Ind-AS compliant company, what are the additional adjustments that we have to make? So to this book profit, what are the additional adjustments that we will move to that? So first we have to take this book profit, what we computed now. So book profit computed as per 115 JB subsection 2 above should be taken, and then what are the items to be added and what are the items to be reduced. So first we have to add items credited to other comprehensive income or other comprehensive items which will not be reclassified to profit and loss account. Usually OCI for an Ind-AS compliant company under the P&L, after the general P&L, there will be a separate statement, that is OCI. OCI, there are two types of OCI. Items which will be reclassified in future, which will be taken to the general P&L account in future. Now temporarily we are showing under OCI, but in future these debits or credits will be considered in the main P&L. That is known as that will be reclassified. That will be reclassified means those items anyway in the near future it will come into the P&L. At that time central government will get MAT, they can levy MAT. But items that will not be reclassified into P&L, that will always they are going to show under OCI. So government is not getting MAT. So that is why they are saying that should be added. If it is a credit, add, and if it is a debit, reduce. So that's the idea. So items credited to other comprehensive item which will not be reclassified. Remember, sometimes in a question they will give a full format of a Ind-AS compliant company's statement of P&L. So definitely there will be OCI which will be classified. Some items debit, credit, and will not be reclassified debit, credit. So you should consider only that will not be reclassified OCI items. So don't consider will be reclassified because that will be coming in the future. Now there is no adjustment. However, there are some of the items which are debited or credited in OCI which will not be reclassified. Please don't consider now. At a later point of time we have to take, but not now. What are they? That is revaluation surplus on fixed assets or equity instruments. Remember, not debt, equity. Revaluation surplus on fixed assets or equity instruments which will be considered only on disposal or transfer. When that asset is disposed, that will be considered into the P&L only. When that asset is transferred, equity instrument is transferred, at that time only the realization happens. So at the time of realization, it will be considered. So up to that time should not be considered. So except this one, that is except revaluation surplus on fixed assets or equity instruments, all other items which are credited to OCI which will not be reclassified to P&L should be added. So if it is a debit, reduce. So second part we will study. If it is credit, add. If it is debit, less. And second one, that is a specific adjustment in Ind-AS, applicable only if there is a demerger carried out during the previous year. So if there is a demerger carried out during the previous year, amount debited to P&L on distribution of non-cash assets to shareholder in a demerger as per Ind-AS 10. Here they are talking about general P&L, our normal P&L. They are not talking about OCI, normal P&L. In the normal P&L, if there is a amount debited which is related to distribution of non-cash assets to shareholders in a demerger, it's absolutely notional under the tax perspective. That is why if it is a debited, unnecessary expense, unnecessary debit, notional debit, add back. That's the idea. Third one, remember the second item in your main P&L. First item not in main P&L, below the main P&L, OCI. Third, gain on disposal or transfer of foreign operations. If this company has a foreign operation, so if there is a foreign exchange gain or loss, that should not be considered in P&L unless that foreign operations has been transferred. So until transfer of foreign operation, don't add or less. So if it is transferred, actually transferred, then add. Then transition amount. So for the first time, if a company followed Ind-AS, there will be a huge amount of that transit difference will be there because past assets and liabilities will be converted into the present fair value. So there will be a huge appreciation or sometimes huge loss. So all those will be adjusted into the capital reserve and or the transition amount. So that will be shown in separately in the balance sheet, and they will adjust over a period of time. It will be write it off or they will be take it as income. So those should be considered only 1/5. So under the tax law, they are saying we need the MAT tax liability. We need the MAT. Government is saying we need the MAT tax on that transition difference, but not immediately because it's a huge amount. So over a 5 years, if it is credit, it will be taxed. If it is a debit, ultimate difference is a loss. It will be allowed under the MAT computation over a period of 5 years. If it is income, it will be taxed over a period of 5 years. This is regarding old assets and liabilities which are converted into fair value and the difference is adjusted in that particular transition amount, or we can say like a capital reserve. So 1/5 of transition amount if it is credited. If it is credit balance, not credit, if it is credit balance in balance sheet, the transit amount is credit balance, then add. If it is a debit balance, reduce. Only 1/5. That means over a period of 5 years. So this adjustment will be there only for the first 5 years from the year in which a company for the first time adopted Ind-AS. After 5 years, this won't be there. And this is purely in further information, nothing to do with the P&L, further information or balance sheet. Then corresponding items debited to other comprehensive income or other comprehensive items which will not be reclassified to P&L. Again, the same effect, except revaluation reserve on fixed assets or equity instrument, which will be considered only on at the time of transfer. And then amount credited to P&L on distribution of non-cash assets, again notional, so reduce from that. General P&L, normal P&L. Only this adjustment happens only if there is a demerger. And then loss on disposal or transfer of foreign operations, it's a loss, we can reduce. And then transition amount, if it is a debit balance, 1/5 has to be reduced. So in a question, either there will be credit balance or debit balance. There is no possibility of credit and debit. So any one will be there. If it's credit balance, add 1/5 of transition amount. If it is debit balance, reduce 1/5. So we will get book profit after Ind-AS adjustments. Further, there is no difference. 15% MAT, surcharge, cess, match. Further, there is no difference. So these are the additional adjustments we should keep in mind. How the transition amount should be arrived. So while taking the transition amount, the following items, if it is included in the transition amount, that we have to eliminate. The addition or deduction of 1/5 of the transition amount should be done for the first 5 years, starting from the year in which a company adopts Ind-AS for the first time. However, the following amount should be excluded from transition amount. So the following items are not to be taxed or not to be reduced. Okay. So what are the items? From the transition amount, we have to reduce. If transition amount includes capital reserve, eliminate. Securities premium reserve, eliminate. Revaluation surplus on fixed assets or equity instruments, eliminate, because that will be considered at the time of disposal. OCA items which will be reclassified to P&L if adjusted in transition amount, eliminate. Cumulative translation difference of foreign operations. So these are the items which should be reduced from transition amount. For exam point of view, in my opinion, keep in mind capital reserve you have to reduce, securities premium reserve you should keep in mind, and the third item, revaluation surplus of fixed assets or equity instruments. So these are the three items. There is a possibility if they are ask you to compute the transition amount first, these three items keep in mind. First three items you should keep in mind. Actually total these are the items which should be eliminated from transition amount, and after eliminating this item, excluding this item, you should take the transition amount, then divide it into 5. Before that, you should see whether the previous year 24-25 is coming within 5 years from the year in which they adopted Ind-AS. If already 5 years is expired, no need to do these things. Yeah, these are the adjustments regarding Ind-AS complaint company. Okay, so now we can go to solve a question on this Ind-AS complaint company's match. Okay. So you have to take question number 26. Question number 26. So from the past 13 years, this was the question which was asked as the most toughest level for Ind-AS complaint company. This was the maximum for the past 13 years. You don't know the future because it is Institute of Chartered Accountants of India, right? Yeah, you are familiar with ICA, right? This was from the past year history, this was the most toughest from Ind-AS. They asked a total 3 times they asked Ind-AS complaint companies math computation. This was the tough one, that's why I selected this one. ABC Formulations Limited, an Indian company engaged in pharmaceutical formulations in Tamil Nadu, started adoption of Ind-AS compliance with effect from 1st April 2022. So that should be keep in mind. 22-23 first year, 23-24 second year, 24-25 third year. So we have to make the transition difference adjustment we should consider because it's a third year only. Total 5 year there will be transition difference adjustment will be there. The book profit after adjustments of all items specified in section 115 JB2. Yeah, the first part they are directly given in the question, which is 52.26 lakhs. Except, okay, but in that book profit computation, normal BP computation, they didn't consider adjustment for brought forward losses. So all other items like dividend paid or proposed income tax, all those they adjusted, but they didn't adjust brought forward losses. That is 52.26. So this is a starting point for book profit computation for Ind-AS compliant company. So what is the brought forward loss and depreciation they're given? Financial year 21-22 business loss, depreciation, and then 22-23 1.75 2.2 brought forward. This is as per books of account. This is as per books of account. Next item they are saying the business loss of 4.6 lakhs and 1.75 lakh have been deducted while computing book profit under section 115 JB for assessment year 23-24 and 24-25. So last 2 years they already considered this 4.6 and 1.75 in MAT computation. So what? But it is not absorbed fully because now also it is available in the books of account. That means it didn't actually set off. In last year's BP computation you consider, okay, that's fine. But in your balance sheet it is still available. So we can consider now. So this is absolutely given to mislead the students. So students will say, okay, 4.6 and 1.7 we already considered. Okay, we should not take that. No, it's wrong. We should consider full because it's still available in the books. Question says, or the provision says, brought forth business loss or unabsorbed depreciation as per books, whichever is less. It is still available in the books. Actually, it didn't set off in books. Last year in MAT computation they considered. That is last year. This is current year. In balance sheet whether it is available, yes. If it has been eliminated from balance sheet, then it's okay. It won't be appear here, right? That's very important. Now, we should go to the last part of the question. This company made an application under IBC. You see the further information, this sixth point. The National Company Law Tribunal, Chennai bench has admitted an application under section 7 of Insolvency and Bankruptcy Code 2016 IBC made by financial creditor against the company for initiation of corporate insolvency resolution process on 30th March 2025. So in the current year, they made an application and their application has been accepted. So what happened? So in case of a company for which application has been proceeded, in that situation, we can claim both. No need to compare. So the first step is we have to take that 52.26 and do this adjustment so that 115 JB2 book profit will be complete. Then we can start with the Ind-AS adjustments. What is the total? 4.6 plus 1.75 plus 4.9 plus 2.2. 13.45. Balance 38.85. 81. So this is known as the book profit computed as per section 115 JB2. You must write like that. Now further adjustments for Ind-AS. Okay. We are going to the Ind-AS adjustment further. So first these two adjustments are over. Now fourth. The particulars of other comprehensive income of the year ended 31st March 2025. See, other comprehensive income that may be reclassified. Yeah, ignore that. We won't require this because may be reclassified. Do not take that. We need which will not be reclassified. other comprehensive income that will not be reclassified to P&L. That we have to consider. Debit we have to reduce, credit we have to add. Changes in, the first item, changes in fair value of equity instruments. See, what we studied is changes in fair value of equity or fixed assets or evaluation surplus should be adjusted only when that asset is disposed or transferred. So here this item should not be considered now because it's an equity instrument. Equity instrument revaluation. So that will be considered only when that equity instrument is to be disposed of in the year in which it is transferred. Up to that, it should not be considered. Deferred gains on cash flow hedges. It should be adjusted. So debit or credit, this 7.25 credit. So we have to add 7.25 we have to add. Deferred cost of hedging, yeah, should be adjusted. Debit, so we have to reduce 4.10. $4.10, right? That should be reduced because it's debit. Then share of other comprehensive income of other associates. Yes, it's credit. We have to add 3.20. Next item, remeasurement of post-employment benefit obligation. Yeah, we should add back. Last item, revaluation surplus for assets. No, it should not be done. It should be done only at the time of disposal. So 3.2, 4.45 we have to add. What is the total? This total 38.81 plus 7.25, 3.20, 4.45. 53.71 minus 4.10. What is the BP? How much? 49.61. So 49.61 is the book profit as per the. Whether there is any other adjustment? What? Yeah, transition. Yeah, that should be considered. Transition amount as on convergence date. As on 1/4/2022 stood at 52.50, including capital reserve of 8 lakhs and adjustment of 4.5 lakhs related to transition difference in foreign operation. Yeah, so these two items must be reduced, right? So reduce 8 lakhs capital reserve and reduce 4.5 because foreign exchange operation should be adjusted only at the time of disposal, and capital reserve must be excluded. So these two items must be reduced. So what is the balance of transition amount? How? 40, right? This is debit or credit? Credit. So 1/5. What is 1/5? 8. It's credit, right? So we have to add 1/5 of transition amount. What is amount? No. What is the 8? So what is amount? 57.61. This is the book profit of this company. Now we can continue the question. So we got the book profit. So transition adjustment has been taken and national company law that we considered. And then compute the MAT liability for the assessment year 25-26 applying the provisions of relating Ind-AS company. Okay, we can compute the MAT. So this is 57.61. So MAT is 15%. Surcharge not applicable, 4% cess because book profit does not exceed 1 crore. So what is the MAT liability? Including cess, 15% plus 4. 8.9871 lakhs. Now what the question says? So now the question says they are given the other details of the normal provisions of the income tax law, assuming that the income tax under provisions of Income Tax Act. See, they are straight away given income tax under normal provisions works out to 9.2 lakhs. Compute tax credit if any to be carried forward by the company, including the period up to which it will be available to carry forward. So here the MAT is 8.987 only, but normal income tax rupees 9.2. So here MAT is not applicable. As MAT is not applicable, MAT credit also not there. So the tax liability of companies normal income tax rupees 9.2. MAT is not applicable here. So there is no MAT credit. When this question was asked for the exam, at that time the MAT rate was 18.5%. In that case, it will be more than the normal tax and there will be MAT credit. So now we can further go to the assessment of company area. So these items you should be keep in mind. It's important. This MAT related computations. We are going to study the concept of 115 BAA concessional rate and 115 BAB. So first, for the existing companies, 115 BAA concessional rate of tax of 22%. So that provision we will discuss. So to claim the benefit of section 115 BAA, primary condition it must be domestic company. So foreign companies are not eligible for concessional rate either BAA or BAB, not possible. So it must be a domestic company, whether private or public, listed or unlisted, doesn't matter. It should be a domestic company. And second, either it can be a new company or it can be an existing company, no problem. So a company at any point of time from the normal provisions, they can come to 115 BAA because it is for existing companies. There is no condition like 115 BAB. See, BAB only for new company manufacturing. In the first year in which they are studying, they must opt for BAB. But BAA is not like that. And to claim the benefit of section 115 BAA, total income must be computed under the regular provisions of the income tax law without considering the following benefits. So do not take these incentives, do not take these deductions. So section 10 AA, SEZ deduction, not available. Section 32 subsection 1 subclause 2A, that means additional depreciation not available. But remember, normal depreciation is possible, but do not take additional depreciation. Section 33AB or ABA deduction not possible. 33AB means tea, coffee, rubber development account. If a part of the profit has been transferred to a special reserve account with a NABARD or tea board or coffee board, rubber board, up to 40% of profit, they can claim a deduction. That is 33AB. And ABA for exploration of mineral oil assessee, they can claim similar up to 20% of profit. So that two deductions not available. That should not be taken. If it is a growing and manufacturing tea or coffee or rubber company, then they should not claim 33AB. And under section 35, you can have in-house research, no problem. You can do that. In-house research deduction 35 allowable, but please don't give donations. If you give donation to scientific research to the approved research institution, that is not allowed. That should not be taken. Section 35 AD deduction for that specified business deduction, that is not available. That is other than cost of land, financial instrument and goodwill, all other capital expenditure can be claimed. Pre-commencement period capital expense is also eligible if it is capitalized on the date of commencement of the business. And under section 35 AD, All capital expenditure is eligible except land, financial instrument, goodwill, and no need to claim depreciation. So there will be a huge amount of loss. That is the tax planning. That is not possible. 35AD is not possible. So no need to worry about that. Under section 15 BAA, they are not claiming 35AD. But you can claim 32. You can claim depreciation. Normal depreciation you can claim. 35AD not available. Now 35CCC and 35CCD. Expenditure on notified agriculture extension project, that is 35CCC. CCD, notified skill development project expenditure. Both revenue and capital expenditure is available, but no capital expenditure on land and building is allowed. So that is 35CCC and CCD. That deduction not allowed. So skill development project and notified agriculture extension project deduction not possible. Under chapter 6A, only 2 deductions are possible. Section 80JJAA, additional employee cost, 30% of additional employee cost that can be claimed. Section 80M deduction, that is also possible. That is intercorporate dividend. So if a domestic company received a dividend from a foreign company or other domestic company, and from that dividend, if they are declaring to their own shareholders declared and paid a dividend before September 30, then they can claim the dividend distributed as deduction under section 80M. So that is possible. 80JJAA possible. All other chapter 6 are not possible. And if a company, existing company for the current year, they want to claim 115 BAA, they are opting for BAA. Current year income should be computed without considering these benefits. Further, in the past years, you were under the normal provision. So in the past years, you claimed NAA or additional depreciation or AB or 35 or 35AD. So due to that reason, past years you have any brought forward losses related to these deduction. For example, if you have brought forward 35 AD loss, in the past years you claimed 35 AD, you are an existing company. Current year you want to come under 115 BAA, you have 35 AD loss brought forward, lapse. So that won't be allowed to carry forward. So brought forward losses due to these sections shall lapse. So if you have a lot of that brought forward losses, then don't claim this section in the current year. First you set off, absorb all these losses. After 2 year or 3 year or 4 year, you can opt for BAA, because at any time you can opt to BAA. So that will be a decision making, right? Now, if you want to claim section 115 BAA, keep in mind it must be exercised, option to be exercised on or before the due date for filing IT return under section 139 subsection 1, and once the options exercised, it must continue to the subsequent years automatically. It cannot change. But if you change it further, then thereafter you cannot re-enter into section 115 BAA. So once you enter into BAA, once you can go out and then you cannot re-enter. And what is the advantage of 115 BAA? So if we are waived off these deductions and benefits, then what is the advantage? The advantage is the basic rate of tax will be 22%. That is the normal rate of tax will be 22%. See, otherwise the normal rate of tax is 30%. But if the turnover does not exceed 400 crore in 2020-23, the rate of tax will be 25. So instead of 30 and 25, your rate of tax will be 22. And mandatory surcharge 10%. Even though total income does not exceed 1 crore, you have to pay surcharge. Mandatory 10%. But remember, under the normal provisions, surcharge applicable only if the total income of a domestic company exceeds 1 crore or 10 crore, 7% and 12%. But here, mandatory 10% surcharge and 4% cess. But next one is the great benefit. No MAT. Minimum alternate tax is not applicable. Whether you are following AIS, whether you are following Ind-AS, anyway, MAT is not applicable. And remember, flat rates will continue as flat rates. That is 112, 112A, 115 BBF, that is concessional royalty, 115 BBG, carbon credit, 115 BBH, virtual digital asset. So all those flat rates will continue, but normal rate of tax will be 22% and 10% surcharge mandatory always, no MAT. This is section 115 BAA, concessional tax in respect of domestic company. It is not applicable for foreign company. Got it? You have any doubts? Clear? Right. We will take a break now and then we will come back and we will continue. Okay. So 20 minutes. Okay, so we discussed the provisions of 115 BAA. So now we are going to apply this provision in a question. Okay. Sometimes they may ask a question on a decision making way, that is which is better, whether normal provision is better or whether 115 BAA is better. That way they can ask a question. So now we can go to question number 28. So Lotus Company Limited is a listed company located in Jaipur. It is engaged in multiple activities at different locations. Books of accounts are maintained by each unit separately. The head office maintains books relating to common transactions. All the accounts are consolidated and the return of income is filed at Jaipur. Following information is furnished unit wise for the year ended 31st March 2025. Medicine Manufacturing Unit Delhi. The company has reported net profit of rupees 200 lakhs in the books of account of the said business unit. It entered into an agreement for use of know-how owned by a renowned scientist. It paid a royalty of rupees 5 per unit of medicine sold as royalty, and the amount of royalty paid during the previous year was 36 lakhs. Company deducted tax at source on the amounts paid up to December 24 and omitted to deduct tax at source on the royalty of 8 lakhs due for the period from January 25 to March 25. The payee admitted the royalty income fully, paid tax and filed his return of income before the due date specified in section 139(1). The company paid rupees 43,20,000 being 14% of basic salary plus DA of the employees in notified pension scheme, and the amount so paid is debited as expenditure in the books of account. So this is the first unit. Second unit, Garment Manufacturing Unit Tirupur. The company has a manufacturing unit at Tirupur, Tamil Nadu. It reports a net profit of 90 lakhs as per books of account of the unit. It bought a trademark from Mr. Yellow for rupees 20 lakhs on 1st June 2024, which is charged as expenditure in the books of account. The unit paid rupees 3 lakh as interest on loan taken from a non-resident Indian. The tax was deducted at source in March 25, but it was remitted only on 6th May 25. Company paid rupees 6 lakhs being the amount of income tax payable by the employees on non-monetary perquisites provided by the company. This amount is debited in the books of account as expenditure. Then again, third unit, Fertilizer Producing Unit Narmada. Company established a fertilizer producing unit in Narmada, Gujarat, which became operational in June 24, acquired a land for 1 crore and put up a building for 3 crore and installed plant and machinery 4 crore. Net profit as per books of account of the unit 220 lakhs after deducting depreciation on building of 30 lakhs and plant and machinery 60 lakhs. Warehousing facility for storage of edible oils at Chennai. It established a warehousing facility for storage of edible oil from 1st August 24. Made investments such as cost of land 2 crore, building 3 crore and plant and machinery 5 crore. Net profit as per books without deducting depreciation 70 lakhs. Now additional information. Company mobilized capital during the previous year 24-25 by public issue of shares. The application money was kept in bank pending allotment of shares. The interest income from the said deposit of 3,20,000 is credited to general reserve. The company declared interim dividend at 10% of share capital being 30 lakhs in February 25. It has 27% shareholding in Wire Incorporation, Singapore, from whom it received 54 lakh as dividend in January 25. Both dividend received and paid were credited and debited respectively in the consolidated statement of P&L. Total turnover for the previous year 22-23 282 crore and for the financial 23-24 405 crore. Company has MAT credit of 20 lakhs of assessment year 16-17. Book profit computed for the assessment year 25-26 is 620 lakhs. Compute. Total income of the company and optimum income tax liability for the assessment year 25-26. Your answer must give reasons for treatment of each item given above and also for the tax liability. So it is actually a big question. They are asking for total income and optimum income tax liability. So as it is an existing company, they cannot claim for 115 BAB, but there is a possibility of 115 BAA is possible. So we should do regular provisions of the income tax law with MAT, computer tax. Then go to BAA, computer tax. Then suggest which one is better. If you go for regular provisions of the income tax law, there is a fertilizer producing unit. Fertilizer manufacturing is a business specified under section 35 AD. So under the normal provision, fertilizer producing unit, they can claim 35 AD. All other cases, normal business computation only. So first we will go to the normal business income computation. So Lotus company, listed company. Okay. So first we will do the medicine manufacturing unit in Delhi. So the net profit given is 200 lakhs. So they are paying royalty ₹5 per unit for the medicine sold. For ₹36 lakhs, they deducted TDS correctly, but they didn't deduct a TDS of ₹8 lakhs for the period from January 2025 to March 25. For the period, okay, that is 8 lakhs the total amount. So 36 lakhs they deducted TDS. For this 8 lakhs they did not deducted the TDS, but they are saying the payee furnished the return and paid the tax and something like that. Okay, so add disallowance as per section 40 subsection A subclause 1A. As per section 40A 1A, so if at the time of payment of expenditure for which TDS is applicable, TDS is deductible, but if the TDS is not deducted or the deducted TDS has not been remitted before the due date for filing ITR, then if the payment is made to resident, 30% of that expenditure must be disallowed, and if it is paid or payable to non-resident, 100% must be disallowed. So here the question doesn't say that it is a non-resident, right? Simply saying it paid royalty to a scientist, right? Rendered an agreement for use of know owned by a renowned scientist. That's it. So we can say that it is paid within India. So 8 lakhs TDS not been deducted. So 8 lakh into 30% must be disallowed. So 8 lakh into 30% will be 2.4 lakhs. Actually, there is a provision under the TDS. See, suppose even though the payer has not been deducted TDS, but the payee included such a payment as his income in the return and paid tax and filed ITR, then the payer will not be treated as assessee in default. But in those cases, this disallowed amount will be allowed as deduction back only in the next year. So here in the current year 24-25, you didn't comply with the section 40A 1A. That is, you did not deduct the TDS. Anyway, disallowance will be there. But in the next year, for assessment year 26-27, that is for the previous year 25-26, these 2.4 lakhs, they can claim as deduction back if the payee filed the return and paid the tax. So clearly saying the payee admitted the royalty income fully, paid the tax and filed his return before the due date under section 139(1). Okay, that's good. But current year you cannot escape from disallowance. Current year definitely there will be disallowance, because the provision says the date on which payee furnished return and paid tax will be treated as deemed to be the date on which payer deducted TDS. So the date on which payee furnished return and paid tax will be treated as the deemed compliance by the payer. So that other person, that is a payee, will file the return and paid the tax only in 2025 July 31 or 2025 October 31. 2025 July or October means that is in the next year 25-26. So that is why we are saying first year definitely there is disallowance, but next year you can claim it back. So we have to put a note, this 2.4 lakhs will be allowed as deduction in the next year, even though they did not deduct a TDS because the payee filed a return and they paid a tax. But current year, anyway, there is disallowance. Now, the company paid rupees 43,20,000 being 14% of basic salary plus DA to the national pension scheme, and the amount is paid is debited as expenditure in the books of account. See, originally when this question is asked, at that time there will be a disallowance, because now there is an amendment under section 36. If an employer providing any contribution to National Pension Scheme, NPS, or Atal Pension Yojana or NPS under section 80 CCD, employer is making a contribution up to 14% of basic plus DA forming part of salary, it is allowed. Prior to amendment, it was 10%. So at the time of this original question, there will be disallowance, because at that time section 36 permit only 10% contribution. Here 14%, excess 4% will be disallowed. But for our exam, there is no disallowance, because now the limit is 14%. Here the contribution also 14% of basic plus DA forming part of the employee. So no problem, no disallowance. It is allowable under section 36. So we have to put a note on section 36. It is allowed. So 40 capital letter A subsection 9 disallowance not applicable, as it is within the limit of 14%. So we got the medicine manufacturing profit we got. So rupees 22.4. Sorry, 2 not 2, right? 202.4. Now, the next unit is Garment Manufacturing Unit in Tirupur. Garment Manufacturing Unit, Tirupur. The company has a manufacturing unit Tirupur. The net profit, we have to put that net profit is 90 lakhs. It bought a trademark from Yellow for 20 lakhs on 1st June 24, which is charged as expenditure in the books of account, 20 lakhs. That is wrong. It is an intangible asset. So that first we have to correct that. It is debited to P&L. So that trademark expenditure should be added, and then we have to claim depreciation also, 20 lakhs. The unit paid 3 lakh as interest on loan taken from a non-resident Indian. Tax was deducted at source in March 25, but it was remitted only on 6th May 2025. No problem, because as per section 40A1, TDS must be deducted during the previous year, and the TDS must be remitted on or before the due date for filing ITR. So it is 6th May 25. They have the time period to file the return up to October 31st, 2025. They have the time. So they paid before the due date. So no problem, no disallowance. 40A1 disallowance not applicable here, because it is paid within the due date. Company paid 6 lakhs being the amount of income tax payable by the employees on non-monetary perquisites provided by the company. This amount is debited to books of account as an expenditure. There is a specific disallowance, section 40 subsection A subclause 5. As per 40A5, if the employer paid income tax on perquisite of the employee. See, anyway, perquisite is as part of salary which will be debited to P&L. It is an expenditure. Sometimes the company will pay income tax on perquisite of the employee. That will also be paid by the company. And if that is debited to P&L, specific disallowance 40A5, and further the same amount will be exempted in the hands of the employees under section 10 subsection 10 CC. So here it must be disallowed. So the amount is 6 lakhs. To be disallowed. Now we have to claim depreciation on trademark. It's an intangible asset. Less 25% depreciation on trademark. So trademark is 20 lakhs. 20 lakhs into 25%. How much? 5 lakhs. So depreciation 5 lakhs we have to reduce. So here total 116 less depreciation. So what is the profit? 111 lakhs. Now third, that is fertilizer manufacturing unit. We are doing problem or the computation under normal provisions of the income tax law without any concessional provision. So we can claim 35AD because fertilizer producing unit under section 35AD. So that name of that business you should keep in mind. Cold chain facility for storage or transportation of specified goods, warehousing facility for storage of agricultural produce, and cross-country crude oil natural gas pipeline network distribution, and warehousing facility for storage of sugar, 2-star hotel anywhere in India, hospital at least 100 beds for patients, affordable housing project construction, and industrial slum rehabilitation housing project, warehousing facility for storage of sugar, that we already discussed, and slurry pipeline for transportation of iron ore, laying and operating of slurry pipeline for transportation of iron ore, and semiconductor wafer fabrication manufacturing unit, fertilizer manufacturing, and on infrastructure development operation maintenance facility, inland container depot customs freight station. So these are the total 14 businesses specified under section 35AD. So fertilizer manufacturing is one of the specified business under section 35AD. So we can claim 35AD. The company established a fertilizer producing in Narmada, Gujarat. So what is the profit? The profit they given is net profit after deducting depreciation. Yeah, that is a problem. After deducting depreciation is a problem because they can claim 35AD, that depreciation that we have to add back. So first net profit. So net profit is 220 lakhs. Add depreciation debited to that, that is 30 lakhs and plant and machinery 60, total 90 lakhs. So 310. Then now produce less. So acquired a land cost is not eligible under section 35AD. Put up a building for 3 crore eligible and installed a new plant and machinery 4 crore. Yeah, both are eligible. So 3 plus 4. 7 crore is the 35AD deduction. So there will be a loss. What is the loss? $390. This is known as 35AD business loss. 35AD business loss cannot set off with any other business. 35AD loss can set off only against the 35AD income. So this should be carry forward to next year. Carry forward. Now D. Warehousing facility for storage of edible oil at Chennai. Edible oil is not an agricultural produce. It is a processed item. So it is a normal business. So don't consider 35AD. Warehousing facility for storage of agriculture produce. Edible oil is not agriculture produce. It is processed. So the net profit given is rupees 70 lakhs without claiming depreciation. It established a warehousing facility for edible oil from 1st August. It made investments such as land, that's not eligible. Building 3 crore and plant and machinery new 5 crore. So they can claim depreciation. So building 3 crore into 10%, more than 180 days. Plant and machinery 5 crore into 15%. So 3 crore into 10% will be 30 lakhs. 5 crore into 15% will be 75 lakhs. Yeah. So we got it. What is the amount? Profit. No, here also loss, right? Yeah, loss. What is the loss? 35 lakhs. How you can claim additional depreciation? No. Additional depreciation available only for manufacturing SSE. It's warehousing for storage, not available. So 35 lakhs. Loss. It is not a 35AD business, it's a normal business. So no problem. You can set off this loss with other activity. So we can make the set off. So 202.4 profit. 111 profit. 35 loss. So what is the income? $202 plus 111, 202.4 plus 111 minus 35, and this one to be carry forward. 35AD cannot set off. How much? 3, 278. Okay. Now what? Now further information, we can go to the further information. The company mobilized the capital during the previous year by issue of the shares. The application money was kept in pending allotment of shares. The interest income from the said deposit 3,20,000 is credited to the general reserve. The company declared interim dividend. So here this share issue and pending allotment, if the application money is kept in a bank and you are getting an interest, there is a Supreme Court case. This expense, sorry, this income, this interest income should be set off with the share issue expenses incurred. So it cannot be taxable. There are two views. It can be taken to IFOS, but there is a Supreme Court decision which says that already there will be some expenditure incurred in connection with the public issue of shares. So this income, 3,20,000 interest, should be adjusted against that issue expense. So it should not be considered here. The company declared interim dividend 10%, that is the declared dividend, but they received some dividend from a foreign company which amount to rupees 54 lakhs, right? So that is income from other source, dividend received from foreign company 54 lakhs. So IFO is 54 lakhs. Dividend. So what is the GTI? What is GT? 278.4 plus 54. 332.4. Now we should think about ATM. ATM. As per section ATM, if a company received dividend from another domestic company or from another foreign company or sometimes from units from real estate investment trust also they can receive. So if they get dividend income from other companies, whether domestic or foreign company, that dividend income will be taxable under IFOS. In income from other source, against dividend income, the only possible expense is interest expense incurred. That is, you took a loan to invest in shares. For that loan, you are paying interest. That interest expense can be claimed against dividend income up to 20% of total dividend income. But here there is no expenditure incurred for generating this 54 lakh, especially interest. There is no such expense. If any expense other than interest is given, don't consider, because no other expense against dividend is allowed under IFOS. Only interest expense. So no expense. So this 54 lakhs is taxed in IFOS. Okay. If such an income included in GTI, now you can claim ATM. The condition is this particular company must distribute. See, declaration is not enough. Declaration and payment is required. Dividend to its own shareholders at least 1 month prior to the due date for filing ITR. So 1 month prior to the due date for filing ITR means due date for filing ITR for company will be October 31st and 1 month before will be September 30th. So before September 30th, they have to declare and pay dividend to their own shareholders. Then such dividend declared and paid to their own shareholders can be claimed as a deduction under section ATM. But that deduction ATM cannot exceed dividend income. So the deduction ATM cannot exceed 54 lakhs. So here what they distributed? They distributed dividend of rupees 30 lakhs. The company declared interim dividend 30 lakhs in February 25. Yeah. So within the time limit. So no problem. They can claim ATM. So we have to claim ATM deduction. In doing company assessment questions, you should be very clear about ATJAA, ATM, ATG, ATGGB, and ATIAB and ATIAC. These are the 5 sections you have to keep in mind regarding chapter 6A when you are doing assessment of company. All other deductions are not relevant for company. So ATM 30 lakhs. Remember, this ATM deduction cannot exceed this 54. So if they declared 60 lakhs, we can claim only 54. Suppose there is an interest expense of 2 lakhs, for example. Suppose there is an interest expense of 2 lakhs against this dividend income, then 54 minus 2. balance 52 will be included in IFOS. In that case, chapter 6 should be restricted to 52. There is another contradictory view is that Act doesn't say that it should be net dividend. So what is the gross dividend up to which we can claim deduction? Another view is there. But usually in suggested answers, IC is taking the view of net dividend. So net dividend included in IFOS or dividend declared and distributed to their own shareholders, whichever is lower is allowed as deduction. So 30. So what is the total income? 302 lakhs, right? 302.4. So compute tax as per the normal provisions of the income tax law for the financial year 2020-23. The turnover is 282 crore. As the turnover does not exceed rupees 400 crore, they can claim the concessional rate of 25% rate. So 25% tax. As the total income exceeds 1 crore but does not exceed 10 crore, surcharge will be applicable, 7% surcharge and 4% health and education cess. Is the tax liability including cess? How much? 84.1277 lakhs. This is the tax as per the normal provisions of the income tax law. Now they given the MAT details. The book profit computed 620 lakhs. So BP would be 620 lakhs. So therefore MAT 15%, surcharge 7%, 4% cess. What is a MAT? What is a MAT? $103.4904 lakhs. So we are comparing the tax liability. Tax computed as per the regular provisions of the income tax law is 84.1277 and the tax computed as per the provisions of MAT is 103. Whichever is higher is the tax liability. So tax liability of this company as per the normal provisions is 103.4904. So MAT is higher. So MAT is liable. So again, MAT credit arise. Already question says there is a MAT credit of 20 lakhs, but that cannot utilize because MAT credit can be utilized only in the year in which a normal income tax exceeds MAT. So already MAT credit of rupees 20 lakhs is there. So we have to increase the current year MAT credit. So what is a MAT credit here? What is 19.362? So there will be a total MAT credit of 39.3627. So this is the answer, tax liability under normal provisions of the income tax law. Question asked about the advice. Okay, so we should go to find out the optimum income tax liability, we should check what is other option. The other option is the company can opt for section 115 BAA. So we are moving to 115 BAA. So if they are claiming 115 BAA, the speciality in this particular question is they won't get section 35 AD deduction, right? Because under 115 BAA, they should not have a section 35 AD deduction. So we already discussed the provisions of 115 BAA. So the 10 AA cannot claim. In this question, there is no 10 AA. Additional depreciation not available. There is no additional depreciation. 33 AB not relevant in this question. 35 is not there. 35 AD they can't claim. But 80M still possible. Even under 115 BAA or BAB, JJAA and 80M is possible. So no problem, 80M we can claim. 35AD not allowed, but in that case they can claim depreciation. So first business no change, income will be 202.40. Second, garment manufacturing, there won't be any change, same, 111. Correct? Third, fertilizer, there will be the change. Fertilizer, the profit given is 220 lakhs. So we add back that depreciation and then we claim to section 35 AD. So we have to check whether that depreciation is correct. Okay. So for fertilizer producing unit, building 3 crore and plant and machinery 4 crore. So it is more than 180 days. So 3 crore into 10% 30 lakhs, that is correct. And that 4 crore into 15%, 4 crore into 15% is 60 lakhs. That is also correct, right? So no problem. So that profit is correct. The given profit is correct. That is rupees 220 lakhs. So straight away you can take that 220 lakhs itself, right? So there will be an income, right? There will be an income. So earlier there is a loss, but there is an income 220 lakhs. And then last one that is correct, that is that there is a 35 lakhs loss. So what is the income under 115 PGBP? 565.4 positive, right? After setting off. Okay. What? 560? No, 498.4. So this is the PGBP income as per the provisions of 115 BAA. Now, IFOS, dividends. Dividend is rupees 54 only, right? GTI 552.4 plus ATM 30, same, right? No change. So total income under section computed as per the provisions of section 115 BAA. How much? 522.4. So on this 522.4, tax rate will be 22% tax and 10% mandatory surcharge and 4% health and education cess. We will get the tax liability. $139.03. 139.03, correct? Yeah. %22 tax, 10% mandatory surcharge, 4% cess. And here no mat. No mat. Not 139, 130, 131.47. Okay. So there is no MAT liability. No MAT liability. You see, if we follow the regular provisions of the income tax law, the tax liability is 103.4904. 103.4904 that we already computed. If we follow regular, that is MAT is higher, MAT is applicable there. But if we opted for 115 BAA, the tax liability is 131.476. So it is better not to claim 115 BAA. So this company should not opt for 115 BAA as the tax liability is higher. So better not to opt for section 115 BAA for assessment year 25-26. The optimum tax liability is equal to 103.490 for further he will get the MAT credit of total 39.3627. So anyway, it is advantage not to claim section 115 BAA. That is not favorable to assessee. Okay. So this is the provision regarding section 115 BAA. If they want to apply a question in a overall question, comprehensive question, then it will be like this. Okay. This was an exam question they asked in January 2021. But at the time of January 2021, there was no deduction of ATM. That was introduced later only. Okay. They may ask a question similar to this pattern. So should be careful. Okay. Because nowadays for regarding assessment of company, they have a lot of options to make a very nice question, because normal provision MAT is there, Ind-AS MAT is there, or normal AS companies MAT is there, 115 BAA is there, BAB is there. So lot of options in for company assessment questions. Now we can go to the section 115 BAB. So BAA we discussed, MAT we discussed, so BAB. So 115 BAB section applicable only for new domestic manufacturing company. New domestic manufacturing company means it should be incorporated, set up, registered and commenced their manufacturing activity in between 1st October 2019 or before 31st March 2024. So in the current year 24-25, if a company is setting up and starting manufacturing, this section is not available. To claim the benefit of BAB, a new manufacturing company which already commenced their manufacturing on or before 31st March 24, that is up to 23-24, it should be started and they should opt. Then they can continue 115 BAB. So for a new manufacturing company which is starting after 31st March 24, not eligible. So they should be engaged in manufacturing of articles or things, or any research and development related to such manufacturing. See, for manufacturing a goods, anyway they have to do some certain research and they have to continue that they can do. And distribution of such goods, that is whatever goods they are manufacturing, and that goods has to be distributed. So related to that business activity they can carry out. So they should not engage in any other business. So this should be the business, manufacture of article or things and related research and development and distribution of such goods. It must be a new business. It should not be an old business, and it should be a new business. And further, out of the total plant and machinery, 80% of the plant and machinery must be new. If imported second hand plant and machinery, it will be treated as a new plant and machinery. It will be counted in 80. And if they are using any building, that building should not be a building for which is used for 80 ID business. 80 ID is a tax incentive available, a deduction available business. So that is some star hotels or hospital with 100 beds. So all those type of business are prescribed under 80 ID. So if a building is previously used for a business under a section 80 ID for which a deduction you earlier claimed, such a building, if it is transferred to this business, it is not eligible. But this condition may be relaxed by the government or by the CBDT through notification. They can relax this condition regarding this building condition. And further condition, this assessee should not be, this company should not be engaged in any other business other than the above manufacturing business. They should do only manufacturing business. They should not be engaged in any other providing service industry or related to this. Any other business they cannot start. Any other line of business also they cannot start. Only this manufacturing business and related research and development and distribution. And the total income must be computed without giving the effect of. It's the same as that of the last section. 10AA deduction not allowed. Section 32 subsection 1 2A additional depreciation not allowed, but normal depreciation they can claim. 33 ABA not allowed. 35 in-house research possible, donation not possible. 35 AD not allowed. CCC, CCD not allowed. Chapter 6 they can claim AA or ATM, but all other chapter 6 are not available. And if their depreciation rate is more than 40%, it must be restricted to 40%. In rare cases, there is a possibility of 45% depreciation, that is, if any commercial vehicles are used for hiring business, which is acquired and put to use between 23rd August 2019 and put to use before 31st March 2020, in that scenario, 1920, in that specific period, if you acquired and put to use vehicles for hiring business, you can claim for it with an old company. That old amalgamating company has brought forward 35 AD loss. That brought forward 35 AD loss of the predecessor amalgamating company will not be available to this new amalgamated company, even though it is a manufacturing company. See, otherwise there will be no loss, because a new manufacturing company starting for the first year, there will be no loss. But the possibility is, if it is started by merging with an old company, that old company's loss will be there. If that is related to this section, that shall lapse. And they should not be engaged in development of software. See, sometimes there are a lot of high court decision, development of computer software and exporting can be treated as a manufacturing. There are some decisions. So they are saying no. For development of software, such assets are not eligible for BAB. Even though mining is treated as a manufacturing, here it is not eligible. Mining business is not eligible. Conversion of marble block into marble slab. Generally, it is treated as a manufacturing activity, but for BAB, it is not treated as manufacturing activity. Bottling of gas into cylinders, from the large bottle of cylinders to the domestic cylinders, gas is refilled. That activity will not be treated as manufacturing. Printing of books. There is a case, Madhribhumi Printing and Publishing. High Court held that printing of books can be treated as manufacturing. But here, printing of books is not treated as manufacturing. Production of cinematographic film, not treated as manufacturing. So these businesses are ineligible. Even though it is treated as manufacturing in other context, here under 115 BAB, it is not eligible. Not eligible. So business of development of software, mining, conversion of marble block into slabs, bottling of gas into cylinders, printing of books, and production of cinematographic film, not eligible. Not eligible. If they want to claim 115 BAB, it should be in the first year itself. Once that missed, then they cannot opt for BAB. Then the only way is to claim for BAA. Option to be exercised in the first year of commencement of production before due date under section 139 subsection 1. So before the original due date, they have to exercise BAB. But if they opt out, in subsequent years, if you are not satisfying any one of these conditions, then you cannot claim BAB. Or the assessee says that I do not want to claim BAB, I want to claim all the incentives and deduction. Okay, then you can opt out. But once you opt out, then cannot re-enter into BAB again. But in that situation, assessee can do one thing. You opt out of BAB, then you can opt for BAA. Because BAA is available for any assessee who is an existing assessee. At any time you can opt. But there also, once you entered into BAA, only once you can opt out, then you cannot re-enter into BAA. So even though assessee is opt out of BAB, he can come under BAA, because still BAA rate is a concessional rate compared to normal rate. BAA is attractive. The most attractive section is BAB, but that is possible only in the first year. And now there is a very strict condition they are putting, that is, if a company has section 115 BAB unit, and if this company has a related party, other sister concern, that sister concern has a normal business, there is a possibility of diverting that normal business of the other sister concern profit can be diverted, and that can be reported in this particular business, so that they can claim concessional rate of tax under BAB, thereby evading the tax. So they are saying, if there is a related party transaction between a company opted under BAB with a related party of this company which is not engaged in BAB or a normal business, if there is any interconnected transactions carried out, the transaction should be at a fair market value, or we can say arm's length principle. If more profit is reported into this BAB compared to the ordinary profit, if the price is manipulated in the transaction between related party and thereby declaring more profit in BAB, then assessing officer must find out that excessive profit, and that profit will be taxable at the rate of 30%. So how the arm's length price will be computed? Same as that of transfer pricing principle. Although those related party transaction with the BAB company should be analyzed with the arm's length principle and compute the excessive profit. That excess profit should be eliminated from the normal income, and this excess profit taxed separately at 30%. Other income will be as per the BAB rate. So if declare more profits than ordinary profit with the close connected persons, AO shall recompute such excess profit using arm's length principle under section 92BA, and such income will be taxable at the rate of 30%. Now we can see what are the concessional rate of 115 BAB. So income from manufacturing or production of business activity, their main business income, income from manufactured production, or they have income from short-term capital gain from depreciable assets. Remember depreciable asset, sometimes plant and machinery and building, furniture and electrical fittings used for this business, they may sell it and the selling price may exceed the block value. There will be capital gain, that is short-term capital gain from depreciable asset. That is also tax related concessional rate 15%. So this is the most attractive rate of BAB, normal business income and short-term capital gain from depreciable asset taxed at 15%. Now, if they have any income from non-manufacturing activity, for example, sometimes they have some incidental income, for example, this manufacturing business profit may be deposited in a bank account and they will get some interest income. Then that is not a manufacturing income, but they are not violating the condition. They are not doing any other business because there is a condition they should not do any other business. They are not doing any other business, but the surplus of the business profit can be deposited in a bank and they will get some interest. Then that is not business income, IFOS. Then that will be taxed at 22%. Suppose if this business has some factory building, some of part of the building has been remains vacant, so they let it out, incidentally let it out, so they get some rental income, house property, that will be taxed at 22%. So income from non-manufacturing activity, it will be taxed at 22%. But there is a problem that non-manufacturing activity income should be computed without any deduction or expense or allowance allowed under the tax law. So if factory building, part of the building is let it out, against that rental income, they cannot claim municipal tax, they cannot claim standard deduction, they cannot claim interest expense, nothing is possible. No deduction is allowed. So if they are getting interest income from the bank deposit, even though there is any expense related to that, that won't be possible. So no deduction is allowed. Any other income they are getting either under house property or IFOS, it will be taxed at 22%, not 15, 22. Similarly, short-term capital gain from non-depreciable asset, that is non-depreciable asset means from maybe from land or maybe some investments, etc. They cannot make investment, but related to business, if there is any asset is there, not a depreciable asset, they sold it, they got a short-term capital gain, then it will be taxable at 22. See, normally short-term capital gain is taxed as per the normal rate. Here the normal rate is 15, but they are saying no, we won't permit you to tax at a 15, 22. Now, if excess profit is computed by AO, that is close connected parties, they are reporting more profit in BAB business. Actually, that profit attributable to the sister concern. If that is diverted here and put it here, then that will be computed by AO, taxed separately 30. See, very high rate, 30. And now flat rate income, as usual, 112 long-term capital gain, 112A, 111A, as per those rate, 115 BBG. So all those income will be taxed at as per the normal flat rates. Mandatory surcharge 10%, MAT is not applicable. So that point are similar to that of BAA. BAA also no MAT is applicable, MAT is not applicable. Here also MAT is not applicable. There also mandatory surcharge 10%. Here also. See, remember mandatory surcharge, irrespective of the total income, surcharge 10% is compulsory in BAA and BAB. So these are the main provisions related to 115 BAB. So remember here also JJAA possible, ATM is possible. So can we go to a question? So before going to discuss this question, we have to study section 80 JJAA. So without knowing 80 JJAA, we cannot do that question. So we are going to discuss the provisions of chapter 6A, 80 JJAA. So name of that section is deduction for additional employee cost. Additional employee cost. So to promote employment, to create employment opportunity, they created this section. Assessee must be an assessee having PGBP income. That is a must condition. There should be a profit. There should be a PGBP income plus mandatory tax audit. There should be a tax audit. So if an assessee does not have a tax audit, not liable for tax audit, then they cannot claim 80 JJAA. That means turnover should exceed 1 crore, or in some cases 2 crore, or in some cases turnover exceeds 3 crore, or in some cases turnover should exceed 10 crore. Then only audit is applicable. So mandatory audit. So liable for tax audit and should have a positive PGBP income. And any assessee is eligible for JJAA, not only company, any assessee, even individual, HCF, partnership, LLP, any assessee. But there should be PGBP income and liable for tax audit. During the previous year, they have to create new employment opportunities. If it is a new company or a new assessee starting business for the first time, definitely they will create new employment opportunity because they are starting now. So whatever employee they are recruited during the previous year will be new. But in case of an existing business, to claim 80 JJAA, current year, they have to create new employment opportunity. Additional employment they should create. That means you should see what is the total number of employees as on the last day of the preceding year. For example, as on 31st March 2024, in that business, the existing business, number of employees is 100. Then what is the total number of employees as on 31st March 2025? Current year end. 31st March 25, 120. 31st March 24, 100. So we can say there is incrementally, there is employees number is increased. 100, 120. We can say new employment opportunity has been created. See, last year end 100. Current year, out of this 100, 50 employees retired. So number from 100 reduced to 50. Current year, we appointed new 50. So 50 plus 50. Current year end 100. 100, 100. You won't get 80 JJAA. Got it? So in case of newly started business, no problem, because current year if you appoint employees, they are eligible. And in case of existing business, number of employees exceeds total number of employees as on the last day of the preceding year. And what this section says? This section says what is the salary paid to eligible employees. So we have to study the concept of eligible employee. So what is the salary paid to eligible employee during the previous year? On that amount, apply 30%, and this 30% deduction will be available in 3 consecutive assessment years. So if you spend 1 crore rupees as salary paid to eligible employee, you will get 190 lakhs deduction. 1 crore current year salary debited to P&M. 1 crore into 30%, 30 lakhs, 80 JJAA. Again this 30 lakhs next year. Again this 30 lakhs next year. So total 190%. 100 you spend, you will get the benefit under the tax law 190. 100 as expense, 30 first year JJAA, again 30 second year JJAA, again 30. That same uniform amount, third year JJAA. So this deduction is available for 3 consecutive years. So who are the employees which are treated as eligible? Act does not define eligible employee. They are simply saying new employee, but they are listing out what are the who are the employees they are not eligible. So ineligible employees. An employee whose monthly salary is more than rupees 25,000, they are not eligible. So you have to create employment opportunity in middle level or lower level. So more than 25,000 salary, that employment or that job is not eligible. So that employee is not eligible. And second, employee does not participate in RPF. So it should be a permanent employee. That employee should join in your payroll. So you must provide PF. So if it is a casual employee, contract basis employee, not joining in RPF, then they are not eligible. And an employee who is employed during the previous year, that is in the year of appointment, that employee is working only for less than 240 days, then they are not eligible. But in case of textile industry, footwear industry, apparel industry, leather industry, then instead of 240, 150 is the condition. So that employee should be employed during the previous year or working during the previous year. That is the year in which he is appointed. He should be worked for more than 240 or more than 150 in case of textile, footwear, apparel, leather. All other cases more than 240. If it is less than 240 days out of 365, he is working for less than 240, he will be ineligible. So usually if the employee is appointed in August end or September or October, definitely he is working for less than 240. So that should be the date we should keep in mind. But in the year of appointment, if an employee does not satisfy this condition, that is that employee is appointed in December. So he is working for less than 240, but he satisfied all other conditions. Monthly salary does not exceed 25,000. He is joined in PF. So all other conditions satisfied, but less than 240 days. Okay, do one thing. In the year of appointment, that employee anyway not eligible. But if that employee continued in that organization in the next year also, then in the next year, this particular employee will be treated as new employee. And from the next year onwards, you can claim 3 years deduction. So in the year of appointment, if an employee becomes ineligible because of less than 240 or 150 days employed, but that employee continue in that organization, in the immediate next year, that employee will be treated as eligible for the purpose of JJAA calculation in next year. Now, it is a deduction under Chapter 6, heading C. So return must be filed within the original due date. And in the return, you must claim it. Then only it will be allowed. And if a person claiming ATJJAA, and if it is not a company, he will be liable for AMD because it is heading C. So he will be liable for AMD. If it is a company, there is no AMD because there is a concept of match. Now, the deduction is allowed for total 3 consecutive assessment years, first year and second and third. Total 3 years it will be allowed. So every year you are creating employment, every year you will get section 80JJAA. And in case of first year of new business, the salary can be paid in any mode. But in the subsequent, in case of an existing business or in case of subsequent years, the salary should be paid by account pay check or account pay draft or other prescribed electronic mode like debit card, credit card, NEFT, RTGS, IMPS, Aadhaar Pay, UPA payment, etc. But first year salary can be paid in cash. So subsequent year, the salary should be paid in prescribed mode. Otherwise, ATJJAA not available. And this deduction is available even though assessee is opting for 115 BAC or 115 BAA or 115 BAB. This deduction is available, JJAA is available. So this is section 80JJAA. So now we can go to that particular question. The following are the particulars relating to 2 Indian companies, namely Alpha Limited and Beta Limited, which are subject to tax audit under section 44AB for assessment year 25-26. Particulars: Alpha Limited, Beta Limited. Date of setting up or registration: Alpha Limited 1/4/2019 and Beta Limited 1st March 2024. So we can say for the previous year 24-25, Alpha Limited is actually an existing company and Beta Limited is actually a new company. So probably Beta Limited, if they opted, Beta Limited will be eligible for 115 BAB and Alpha Limited will be eligible only for BAA. Alpha Limited won't be eligible for BAB. Date of setting up or registration and the main object: Alpha Limited manufacturer of steel and Beta Limited manufacturer of leather. Place: Vaishali, Bihar. Other one is Ranipet, Tamil Nadu. Place is not relevant here. Turnover of previous year 20-23, 251 crore for Alpha. Next year 401 crore and for the current year 270 crore. Beta Limited 120 crore for the current year turnover. Value of new plant and machinery installed and put to use on 1st November 2024, 8 crore and 5 crore. Gross total income of previous year 24-25, 5 crore and 3 crore. So gross total income means we can assume it is computed, gross total income computed as per the normal provision. Or if they are saying if it is as per special provision, we have to take that like that. So further information we will read and decide. So GTA they given 5 crore and 3 crore. Number of new employees employed on the date of setting up or registration of the company. So Alpha Limited 50, Beta Limited 750. Number of new employees employed as on 1/4/2022 750, and this second one is dash. Monthly emoluments to paid to ECS through bank account. 250 employees, 20,000 per employee. Again 250 employees, 25,000 per employee. Again 250 employees, 28,000 per employee. So total 750 employees breakup is given. The other cases 21, 25, 27. So from the above details, compute the tax liability of Alpha Limited and Beta Limited for assessment year 25-26, assuming that Alpha Limited has not opted for any concessional rate earlier, and they both avail the beneficial tax rate under the special provisions of the income tax in the previous year 24-25 by fulfilling the conditions specified thereunder. Assuming that the GTI reflects the computation under special provisions. Second question, would it be beneficial for Alpha Limited to opt for beneficial tax rates in previous year 24-25 instead of paying tax under regular provisions of the Income Tax Act 1961 examen? So first we will do the tax liability of Alpha and Beta Limited under special provision, and then we will compute tax under normal provision in respect of Alpha only. Okay, because for Beta anyway they opted for BAB. Alpha we have to do the both computations under special provision as well as under the normal provisions of the income tax law. Then we should compare and we should advise. So here the question says GTI given as per computed as per the special provision. So this 5 crore and this 3 crore is GTI as per BAA or BAB. This is BAA. This is BAB. This is GTI. So we can claim chapter 6A. So chapter 6A 80 JJAA. So here the total number of employees appointed, number of new employees appointed as on 1/4/2022. They are saying 750. So I have a confusion regarding the dates given. Whether the dates given is correct. Total 750. Below that they are giving the details. When this company started, this Alpha, when they started? 2019, right? So value of, okay. Then next here they are saying number of new employees employed on the date of setting up or registration of the company. New company, okay, 750, that is correct. But here they are saying 50, right? Number of new employees employed on the date of setting up or registration of the company. So this company, if they appoint 50 employees in the year 2019, definitely those 3 years is expired, right? So that deduction is over. But if they appointed 750 employees on 1/4/2022, I am speaking about Alpha. If they appointed 750 employees on 1/4/22, 22-23 will be the first year, right? 23-24 will be the second year, and this will be third year. So definitely there will be JJAA for Alpha. Okay. So we can compute the 80 JJAA of Alpha. So here this 25,000 per employee, this is eligible, no problem. And this 28 is not eligible. Why? Because it's more than 25. So this 20,000 is also eligible, correct? And so out of this 750, only 500 employees are eligible. So 500 into, sorry, you have to take separately, right? 250 employees into rupees 20,000 into 12. Again 250 into 25,000 into 12. Take the total. Apply 30%. that is allowed in the current year, last year, third installment. Four crore, that is a total into 30%, into 30%. 30% is 4 crore 5 lakhs. 4.05, right? So the remaining income will be only 95 lakhs for BAA, under 115 BAA for alpha. What about beta? For beta, these 27,000 per employee, this is not eligible. This 21,000 which will be eligible, and this 25,000 is also eligible. So 250 into 21,000 12, 250 into 25,000 into 12. So what is our deduction? 4 crore 14 lakhs. So it's more than GTI. Huh? Then something is wrong in the question. 4 point something. Then we have to check the study material. It's a question in study material, so we have to check that. The figure is different, right? It's a 5 crore, right? Yeah, that you have to change in the question. Just change the figure of beta only, okay? Just beta only you can change, 5 crore. In our question, what is the total income for GTI for alpha? That's correct, right? So this should be 5 crore, 5 crore, 5 crore. Yeah. 4.14, right? So here 4.05 and there we have to take 4.14. So balance will be 86 lakhs, 86 lakhs. Yeah. So it is 5 crore. So 4.14, right? Yeah. So balance 86.86 crore. Sorry, 0.86, right? Or we can say in lakhs, right? 86 lakhs. So this is the total income computed as per the special provisions of PAA and BAB. They are giving only GTI. That's why we claimed the Chapter 6A reduction. So this is the income. Now we can find out the tax. Under section 115 BAA, on this 95 lakhs, they have to pay tax at the rate of 22% and mandatory 10% surcharge and 4% health and education cess. And no MAT. So what is the tax? Here it will be 15% tax, 10% surcharge and 4% cess. So what is the tax for alpha? 70, 23.9096 and here 14.7576. So this is the tax under special provisions of the income tax law for alpha and beta. Now, would it be beneficial for Alpha Limited to opt for beneficial tax rates in previous year 24-25 instead of paying tax under regular provisions of the Income Tax Act? So they are asking second part only regarding alpha. So for alpha, we are going to compute the provision income as per the regular provisions of the income tax law. So in that situation, remember, as per the regular provisions, they can claim additional depreciation because it is manufacture of steel. So they installed the plant and machinery of rupees 8 crore, which is less than 180 days, 1st November 2024. So for this 8 crore into 10%, they can claim additional depreciation, that is rupees 80 lakhs additional depreciation possible. So the GTI given in the question is 5 crore or 500 lakhs. So in which they didn't claim the additional depreciation because the question says the GTI given is computed as per the special provisions. Special provisions means BAA or BAB. In there will be additional depreciation not be allowed. So they didn't claim the additional depreciation in this 5 crore. So we are claiming that less additional depreciation. That is 80 lakhs. So balance will be 420 lakhs. Then 80 JJAA. How much was 80 JJAA? 4.0 4 crore 5 lakhs. For correct, right? 4.05. What is the balance income? 15 lakhs only. So this 15 lakhs, on this 15 lakhs, normal provisions of the income tax law. So question says the turnover for the previous year 22-23 of Alpha Limited is 251 crore. That is does not exceed rupees 400 crore. So they can claim the rate of tax 25%. And 4%, sorry, surcharge not applicable because total income does not exceed 1 crore, just 4% cess. So what will be the tax? 3.90 or 99? Okay. 3.9 lakhs. That is a tax as per the regular provisions of the income tax law without taking any concessional provisions. Here it is only 3.9, but here the tax rate is 23.9096. So we can say because of this additional depreciation impact, the overall tax liability of Alpha Limited will be lower if they are not opting for the provisions of 115 BAA. So for Alpha Limited, it will be better to pay tax as per the regular provisions instead of opting for BAA. But for the other company, Beta Limited, anyway, that they selected 420 BAB, the BAB will be the better. Because anyway, the rate of tax is very low, 15% plus 10% plus and 4%. Again, they will get 80 JJAA also. And the question is not asking regarding the tax planning of Beta. So this is the provision regarding BAA and BAB. So remember, they didn't ask the question regarding that BAB where there is a clause connected between related party and more profit is declared. So that part they never asked in your exam purpose. So they may ask a question testing the knowledge of students from that area also. That is, that there is any additional profit is declared by manipulating the transaction with the related party. So in that situation, they can tax that income at the rate of 30%. So that you should be careful. Excess profit computed, that can be taxed at 30%. And there are a lot of rates under BAB. You should be careful. Only for manufacturing or production and short term capital gain depreciable asset 15. Non-depreciable asset capital gain short term 22. If it is long term, anyway flat rate. Normal special rate. Short term 22. And non-manufacturing activity, that is house property or income from other source. If there is any income, remember, no expense, no standard deduction, no expenses, nothing will be possible. Gross income will be taxed at 22 if they have any income from non-manufacturing activity. That should be careful. So these are the rate of tax related to company you should keep in mind. And buyback of shares. Yeah, we can write that, but they didn't given the provisions relating to book profit and all those things. If they given the book profit, then we have to compute the MAT also. No, we cannot assume, because book profit is computed purely based on what that statement of profit and loss account as per the accounts, right? That will never match the GTA under the income tax law. That we cannot take assumption. For the purpose of the comparison, we are ignoring MAT. So buyback, this buyback provision is actually it's an amendment happened in between during our previous year. That is the position before 1st October, there will be buyback tax to be paid by the domestic company. But the position changes after 1st October 2024. So before 1st October 2024, if a domestic company making a buyback of its own shares from the shareholders, then what is the excess consideration paid by the company to the shareholder? For example, originally company issued the shares at rupees 120, 100 face value and 20 premium. At 120 originally shares issued, and before 1st October 24, company made the buyback of shares at the rate of rupees 200 per share. So buyback consideration is 200. Originally company issued at 120. So what is the excess consideration paid towards buyback? 200 minus 120, 80. So on that 80 rupees, company has to pay 20% additional income tax and 12% mandatory surcharge and 4% cess as per section 115 QA within 14 days from the date of buyback. And this tax, as it is paid by the domestic company in the hands of the shareholder, it will be exempted. The buyback consideration received by the shareholder. In our example, company originally issued shares at 120. Now it is made the buyback at rupees 200 for the shareholder. This entire 200 rupees received by the shareholder from the company will be exempted as per 1034A. And for the company, 200 minus 120 or excess amount of 80, company has to pay additional income tax. That is buyback tax. And this buyback tax is not a business expenditure for the company. It is a mandatory tax to be paid by the company. But this is applicable only for domestic company before 1st October 24. But on or after 1st October 24, the position changed. Now they are saying, if whatever amount is received by the shareholder upon the buyback. In our example, originally shareholder purchased the share at rupees 120, 100 face value, 20 premium he purchased for 120. Now he got a buyback consideration of 200. That entire rupees 200 will be taxable as dividend, and it will be taxable under income from other source under section 222F. Normally against a dividend we can claim interest expense, but here for 222F dividend, even this interest expense is also not allowed. So no expense is possible. This dividend will be taxable directly. It will be taxable under income from other source. Actually, it is a consideration received for transfer of a share. Actually, it is a capital transaction. But they are saying no. From 1st October onwards, the position is different. If a shareholder getting buyback consideration, that entire amount should be taken to income from other source as dividend and taxable in the hands of the shareholder. And then you see, the shareholder originally purchased this share for rupees 120, but now he is getting 200. Entire 200 is taxed under IFOs. That is not correct. So they are saying you do one thing. You can go to the capital gain head, compute capital loss. Full value of consideration of this share, nil, take it as nil. And what is the cost of acquisition? 120. So from nil, if you reduce 120, full value of consideration is 0, reduce cost of acquisition 120, then there will be a loss. So original cost of acquisition of such shares which are subject to buyback after 1st October can be claimed as a capital loss under the head capital gain. And if it is a listed share, while taking the cost of acquisition, you should be careful regarding 112 comparison. Original cost of fair market value as on 31st January 31st January 2018 compared with the full value. Full value is nil. So nil or FMV as on 31st January 2018, whichever is lower. So lower will be 0, or original cost, whichever is higher, original cost will be there. So that original cost will can be claimed as capital loss. So there are two impacts. Whenever there is a buyback after 1st October 2024, definitely there is two impact for shareholder. One is direct impact of that amount consideration received towards buyback as dividend taxable under IFOS, and original cost or cost of acquisition of those shares which are subject to buyback can be claimed as capital loss. See, these in between we cannot set off because it is a capital loss. Capital loss set off can be set off only against a capital gain. So that capital loss you can set off. If there is any other capital gain, you can set off. Otherwise, this capital loss should be carried forward, and this dividend will be taxed under income from other source. So the date is very important. It is after 1st October 2020, on or after 1st October 2024. There are a lot of other dividends under income from other source, that is 222A, B, C, D, E, and this is 6th one, F. So 220A means if a company distributed assets to shareholders and at the time of distribution of the assets, the company has accumulated profit, then to the extent of accumulated profit, this asset distributed will be treated as dividend in the hands of the shareholder. That is 222A. 222B says that if bonus shares are issued to preference shareholders and debentures of the company issued to shareholders, and at the time of issue of debentures and these bonus shares to preference shareholders, if the company has accumulated profit, that issue will be treated as dividend. And 222C says that at the time of sometimes there may be a possibility of liquidation of a company. At the time of liquidation, if assets are distributed to shareholders and if the company has accumulated profit, that will be treated as dividend. And 222D says that in case of internal reconstruction or reduction of capital, if the shareholders reduce their paid up share capital, in lieu of that company gives some assets, and at that time company has accumulated profit, that is deemed dividend, that is 222D. And 222E, very important for your exam point of view, very important. 222E, closely held company or a private company or a company in which public are not substantially interested. In that private company, a registered shareholder is holding minimum 10% equity shareholding, and such a registered shareholder took a loan or advance from the company. At the time of granting of the loan, company has accumulated profit, and at the time of granting of the loan or taking of the loan, he has 10% shareholding in that company. Then this loan or accumulated profit, whichever is lower, taxed as deemed dividend in the hands of the shareholder. Even though loan is repaid, still deemed dividend is applicable. But deemed dividend under section 222E not applicable in two situations. If the substantial part of business of the lender company is money lending, then this section not applicable. And if this advance is granted for genuine business purpose of the company or the business purpose of the company, in that case also 222 deemed dividend is not applicable. So that is 222E. Now they put 222F, amount received as buyback, received on buyback by a shareholder, should be taxable under dividend 222F. But simultaneously at the same time, immediately the cost of acquisition of that share can be claimed as capital loss. Okay. And 115 BBG we discussed, it's a carbon credit. So if from the atmosphere 1 ton or equivalent carbon dioxide has been reduced, you will get a certificate from UN framework on climate change. So 1 ton eliminated, you will get 1 carbon credit. So that is known as carbon credit. This carbon credit, it's a certificate. It can be traded, or if any other company who does not meet the pollution guidelines, If they need the credit, you can sell this credit to that company. At that time, you will get the money. So income from sale of carbon credit, actually it has the character of a capital asset, but they are saying that either you can take it to PGBP or into IFOS. Usually it is taken into PGBP as a normal income, but the rate of tax will be flat rate 10% and no expense is allowed. So that is income from sale of carbon credit 115 BBG. Actually it is applicable for any SSC, not only for company, for every SSC BBG is applicable. But this 115 BBF specifically, it is also applicable for every resident, but here it will be, they are asking question related to assessment of company, because 115 BBF royalty income, MAT is not applicable. While computing normal tax, we can pay only 10% on gross basis, but in computing MAT computation, if expense of BBF royalty debited to P&L, it should be added. If BBF royalty credited, it should be reduced. That is, MAT is not applicable. But regarding carbon credit, there is no such a provision. If there is income from carbon credit credited to P&L, it is liable for MAT. MAT is applicable. Yeah. Under section 222E, if the lender company have accumulated losses, no deemed dividend. If company taking loan from outside and given to shareholder, no problem. Company having a loss, then no need to proceed, right? No deemed dividend at all. Yeah. See, there should be an accumulated profit in the liability side of the balance sheet of the company, right? At the time of granting loan, whether capitalized or not. Some reserve or profit should be there. Then only this section is applicable. This company, private company have a loss, even though they took loan from a third party and given to the shareholder, there will be no deemed dividend. Yeah. There is another situation. Company have accumulated profit, but the loan is not granted directly to the shareholder, but the loan is granted to a third party, which in turn given to the shareholder. In that case, deemed dividend will be applicable. Even though the advance or loan has been granted to any other entity in which this particular shareholder has substantial interest, in that case also deemed dividend is applicable. I can show you that. So this is the position. Either directly the registered shareholder can take the loan, or the loan can be given to any other person, which in turn for the benefit of the shareholder, or the loan can be given to an entity. In that entity, this registered shareholder has substantial interest. But in all these three cases, the lender company should have accumulated profit. At the time of granting of loan itself, they should have accumulated profit. And the taxable amount of deemed dividend is accumulated profit amount or loan, whichever is lower only. Accumulated profit is 10 lakhs, loan is 12 lakhs, only 10 lakhs is taxable. Because if a company does not have accumulated profit, then how you will declare dividend? Instead of giving dividend, they are diverting the amount in the name of loan. That's the intention behind this provision. Because public companies, they cannot give simply loan, because special resolution, central government approval, lot of restrictions under Companies Act. All those restrictions not applicable for private company. So private company have a practice of distributing profit in the name of loan. That is why this provision is created. That's the intention. So if no accumulated profit, no dividend. Even for 222A, B, C, D, E, all these 5 cases, there should be accumulated profit. 220F, whether or not accumulated profit, F dividend is applicable. Okay. So these are the main points. So this dividend part, 222E and F. F is very important because it's amendment. So definitely they may ask a question from this dividend part. So that you should be careful. So when we are trying an assessment of company question, we should keep in mind these 3 sections also. Especially the first two sections are very important. As per the provisions of section 2 subsection 22E that we discussed, if a closely held company or private company distributed advance or loan, it will be treated as dividend in the hands of the shareholder, but it won't be affected in the hands of the company because it is taxed in the hands of the shareholder only under IFOS. But remember, if it is a private company, then only 220E is applicable. If it is a public company or a company in which the public are substantially interested or listed company, this section is not applicable. Next one, section 68. In case of a company, if the company's books of account showing that there is some share application money or share allotment money, so similar type of money credited in the name of a person, but assessing officer feels that such a share capital contribution made by a person out of his black money, then AO has a power. He can require the company to provide the details of in whose names that money is credited in the books of the company and from where that person get the money to invest in this particular company. That is, AO can require he can make a requisition regarding the source of that money. And if the company failed to provide the source of that money of the shareholder to the satisfaction of the AO, then such a share application or allotment money which credited in the books of the company will be treated as unexplained income, black money, and it will be taxable in the hands of the company. So taxation of sum received by company towards share application money, share capital, share premium, if the explanation offered by the company is not satisfactory. Explanation here means explanation regarding the source of such money in the hands of the shareholder. So from where shareholder get the money, if the officer gives a notice to the company, then company bound to give that information to the AO. So what will happen? Company has to collect that information from the shareholder and that should be given to the AO. And if the AO is not satisfied with regarding the explanation, then this share capital or the share premium money which is credited in the hands of the company can be treated as the black money or income of the company. This is also applicable for closely held company, only for private company. All these four provisions are applicable for private company. Next one, 79, that we already discussed. That is, in case of a closely held company or a private company, the persons holding at least 51% share capital of the company as on the last day of the previous year in which loss incurred should be the same persons as on the last day of the previous year in which that loss is going to set off. If there is a change in persons holding 51% shares, then such a loss will not be allowed to set off or carry forward by the private company. And the last one is 179. In case of a private company, towards the company is liable for any tax or interest or penalty, then all the directors of that private company are jointly and severally liable personally towards the tax dues of the private company. So these four provisions, 222E, 68, 79, 179. This is the reason why there is a classification of company into closely held company and widely held company, or private company and public company. What is a classification relevant for tax purpose? These are the four reasons. And next one is some of the provision regarding IFSC. So International Financial Service Center, a unit located in International Financial Service Center, they will enjoy some of the exemptions, some of the concession that is mentioned there. So in IFSC, if there is a recognized stock exchange located in International Financial Service Center, there will not be any STT, even though there is no STT applicable on share transactions carried out in a recognized stock exchange located in IFSC, and all those transactions will be in foreign currency. Even though STT is not paid, the benefit of section 111A and the benefit of 112A will still be available. Normally, to get the benefit of 111A and 112A, STT should be paid. But even though STT is not paid, in this case, the beneficial provision will be available. And second one, if a bond or GDR, bond or global deposit receipt or rupee denominated bond or derivative transferred by a non-resident to another person through a recognized stock exchange located in an IFSC. So see, if it is transferred outside IFSC, then definitely taxable. If it is transferred through and recognized stock exchange located in IFSC, then it is not a transfer. Capital gain is not taxable as per section 47. And second one, interest earned by a non-resident from a unit located in IFSC, completely exempted under section 10 subsection 15. Next one is income of a non-resident unit holder of a category 3 alternate investment fund located in IFSC. If that non-resident unit holder received income from that AIF located in IFSC, that is also exempted. And further, income of such AIF will be taxable as per 115 AD rate. 115 AD contains certain concessional rate of tax for foreign institutional investors. So that rate will be applicable for an alternate investment fund if it is located in IFSC. And for the unit holder getting return from AIF, that will be exempted. So there are two transactions are mentioned there. Non-resident unit holder getting return from the AIF located in IFSC, and again IFSC's income. That is AIF located in IFSC, their direct income. That is taxed at a concessional rate as per 115 AD rates. And in case of that non-resident unit holder getting return from AIF, if the AIF is located in IFSC, it will be exempted. And MAT or AMT, whether it is MAT or AMT, if it is a company having a unit in IFSC, the MAT rate will be 9% instead of 15. And if it is not a company having operations in IFSC and they are claiming Chapter 6A Heading C or 10AA or Section 35 AD, usually there will be only Chapter 6A Heading C 80LA, because those units located in International Financial Service Center, they can claim from their income Section 80LA Chapter 6A deduction. Similar to that of 80IAIB, their income can be claimed as deduction as per Section 80LA. So if they are claiming 80LA, definitely there will be AMD, because 80LA is a deduction mentioned in Chapter 6A Heading C. At that time, the AMD rate will be only 9. Normally the AMD rate is 18.5%, but a unit located in International Financial Service Center, the AMD rate will be 9%. Further, interest earned by a non-resident from long-term bond or rupee denominated bond which are listed in a recognized stock exchange located in IFSC, taxable at a 4% concession rate as per section 115A. But it should be issued before 1st July 2023. On or after 1st July 2023, the rate will be 9%. And the next one, dividend income of non-resident from a unit located in IFSC, taxable at the rate of 10% as per section 115A. Normally, as per section 115A, dividend income received by a non-resident from India taxable at a flat rate of 20% without expense. But here it will be taxed at the rate of 10%. Condition, the company or the unit should be located within IFSC and the shareholder must be non-resident. The income is dividend. Next one, as per section 80LA, if a person having a unit in International Financial Service Center, they will get a deduction, 100% of their income they can claim deduction under section 80LA. So as per section 80LA, 100% deduction shall be allowed in respect of income from business of unit located in IFSC. Deduction allowed for any 10 consecutive years out of first 15 years. Either you can select first 10 years or you can select 6 to 15th year. So in between, out of this first 15 years, any 10 consecutive years, you can claim the deduction under section 80LA from the profit. So once you claim deduction under 80LA, if they have only activities in IFSC unit and their entire income represents IFSC income, activities carried out in IFSC, then that income they can claim 100% under 80LA. So their normal provisions total income will be zero because 80LA 0. But we should calculate AMD. We should add back this 80LA. So we will get adjusted total income, apply 9%, they have to pay AMD. Normal tax will be 0 because they are claiming deduction under 80LA for those 10 consecutive years out of first 15 years, starting from the year in which permission under relevant law is obtained to locate in IFSC. These are the tax incentives allowed to IFSC under the income tax law. So this is a tonnage tax income. If you have time in last moment, you should go through this also. It is actually a presumptive taxation provision for a tonnage tax company. There are certain conditions. See, sometimes they may ask, it is not a regular area they are asking, but at least you should study this slab rate. See, they should have more than 15 net tonnage, then only they are eligible for, and it should be Indian company, then they can opt for tonnage tax scheme. Then this will be the income computation based on some slab rate. There are 2 questions available in your study material. You can go through that. I'm not discussing here. So now we have to go to, just I will tell a very brief idea of income from other source and PGBP, so that heads will be over. Then we will go for lunch break, and after that we will come back and we will return real estate investment trust, alternate investment fund, and then we will go to charitable trust and then TDS. Got it? So just I will give you an overall idea, the most important areas of PGBP. First we will go to PGBP. Yeah. So 28, chargeability. So major items you are aware. So some of the special items you have to keep in mind under section 28 is, if a person convert his stock in trade into capital asset. If stock in trade is converted into capital asset, on the date of conversion, what is the fair market value? That fair market value shall be deemed to be sales. That should be deemed to be income. Conversion of stock in trade into capital asset. That is one of the important points to keep in mind under section 28. Another point, 35 AD asset, even though it is an asset, once you claim deduction under section 35 AD, then you sell it, then that sale value or original cost, whichever is lower, taxed as business income under section 28. Normally, if you transfer an asset, we will take into reduce from block of asset, or we will take into capital gain. But here it is not possible. It's a 35 AD asset. Entire cost is claimed as deduction under section 35 AD. So subsequently, if you sell it, original cost or selling price, whichever is lower, taxable as business income under section 28. And another important point you have to keep in mind under section 28 is, if a partner is getting interest on capital and remuneration from his firm or LLP, it is not IFOS, it is not salary, it should be taxable in the hands of the partner under PGBP income. So that is the main points you have to keep in mind under section 28. And 41, deemed profit, that is also very important. Cessation or waiver of trading liability. Earlier, once you claimed an expenditure as a deduction under the income tax law, subsequently you recovered back, get it back, it should be treated as deemed profit. Similarly, if you took a bank loan and that bank loan is used for normal business purposes or working capital purpose, you spend that bank loan. Subsequently, you didn't repay that bank loan and bank waived the principal amount, it will be treated as deemed profit and taxable under section 41. But if that bank loan is used for a capital expenditure and subsequently bank is waived the loan, then it is not a deemed profit, because section 41 says cessation or waiver of trading liability. Trading liability means it must be revenue in nature. Revenue in nature. Should not be capital. And again 41, bad debts. Earlier claimed as deduction, allowed as deduction under the tax law, subsequently recovered. See, if earlier you claimed it but disallowed by AO, now get it back, no deemed profit. Earlier claimed under tax law, allowed under tax law, and subsequently get it back, recovered, it is deemed profit under section 41. In case of amalgamation, demerger, conversion, succession, if predecessor write it off the bad debts and allowed under tax law, after that restructuring happened. So bad debts recovery happened in the hands of the successor. Section 41 applicable for successor also. Successor also. Similarly, expenditure claimed and liability created by predecessor. After that amalgamation happened. In the hands of the successor, that liability become waived. That liability no more a liability. So income arises. Section 41 applicable for successor. So bad debts sometimes claimed by amalgamating company, but it is recovered by amalgamated company. 41 applicable for amalgamated company. Similarly, liability created and expenditure claimed by amalgamating company, but now that expenditure become waived, cessation happened, and it becomes an income in the hands of the successor. 41 applicable for the successor. And then 41 says that a straight line method depreciated asset, when you sell it, there will be a profit that is known as balancing charge. That balancing charge is taxable as a business income. Then 41 says scientific research asset for which a deduction claimed earlier, subsequently sell it off, then selling price or original cost whichever is lower, business income, taxable under section 41. And then special reserve created under section 36 by banks and financial institution, if subsequently they withdraw it, it will also be treated as a deemed profit under section 41. That is 28 and 41, that is chargeability related area. And remember one more important point, if a person who is an owner of a residential house property, if a person owner of a residential house property, and residential house property is let it out and he is getting rental income, and he may have 5 house or 10 house or 10 house or 15 or 25 houses, but he is the owner and residential building is let it out and he is getting rental income, it is absolutely income from house property. It cannot be taken to PGBP. That is an amendment under section 28. So we can say that if it is a commercial property and you are making it as your business activity of renting of commercial property, it is PGBP. And in case of a company, if the company's main object, business itself is renting of properties, then also it is PGBP, not house property. That is an amendment happened, explanation added to section 28. Now, 29, that is computation. Now, that's anyway we know. Now, a deduction, section 30, which says that expenditure relating to planned, building. If building is used for business purpose, then related to that building, you can claim 4 expenditure. That is rent paid as a tenant, current repair, insurance premium, and property tax. Regarding rent paid as a tenant, remember, if the rent exceeds rupees 2,40,000, you have to deduct TDS under section 194I. Otherwise, 40A1A, 30% will be disallowed. If the rent is paid or payable outside India without TDS, 100% will be disallowed, 40A1. Regarding current repair, if the building of the business is for repair, it is given as a contract as per section 194C. If the contract amount exceeds 30,000, single payment or aggregate payment 1 lakh, deduct TDS. Otherwise, 30% or 100% will be disallowed as per section 40A1 or 40A1A. Regarding insurance premium, no further condition. Property tax, again, as per section 43B, property tax, which is a tax paid or payable to government, to claim it as a deduction, it should be paid either during the previous year or at least prior to the due date for filing ITR. So, 43B will be applied regarding municipal tax. That is section 30. 31, if plant and machinery furniture used for business purpose, you can claim 2 deductions, current repair and insurance premium. So, if plant and machinery taken on rental expense can be claimed under section 37 only. 31 deals with only current repair and insurance premium. Current repair means revenue nature. If capacity of the machinery increase, capital nature, you cannot claim it here. Replacement of parts and machinery, there is no capacity enhancement, there is no increase in the capacity, only maintenance, but parts has been replaced, no problem. Revenue expense you can claim under section 31. Now 32, depreciation, normal depreciation, additional depreciation. Normal depreciation only WDV method, power generating assessee only straight line method. Classification, building, plant and machinery, furniture and electrical fittings, intangible asset. Goodwill, never eligible for depreciation. So, goodwill is not eligible. All other intangible asset 25%. And now plant and machinery, remember, normal rate is 15%. There are certain special rates of 40 and there are the special rate of 30 and some cases 20. Remember, electric vehicle, it will be covered under renewable energy devices. So, that is eligible for 40%. But normal vehicle 15. But electric EV, the rate will be 40. And computers and similar type of items also 40. So, you have to go through that rates. And depreciation, to claim depreciation, basic condition that you should be the owner and it should be actually put to use. In case of certain assets which are ready to use, that's enough. Passive use, you can claim the depreciation. Ownership, registered ownership is not compulsory for road transport vehicles and building. For all other assets, it must be registered in the name of the assessee. For these 2 assets, registered ownership is not compulsory. Main point, additional depreciation can be claimed only by an assessee engaged in production or manufacture of any article or thing or generation of electricity. Again, electricity generating assessee, only if they opted for WDV, they can claim additional depreciation. Under straight line method, there is no additional depreciation. So, electricity generating company, if they opted for WDV, they can claim additional depreciation because electricity is goods, movable, marketable. So, generating electricity is equal to manufacturing. So, additional depreciation possible. manufacturing assessee or electricity generation. Eligible plant and machinery should be acquired and put to use during the previous year. Additional depreciation will be available at the rate of 20% on actual cost of eligible plant and machinery. It is for one eligible plant and machinery available only once. And in the year of put to use, if the eligible plant and machinery put to use for less than 180 days, then additional depreciation 10%, balance 10% available the next year. Additional depreciation not available in case assessee opted for 115 BAC or BAA or BAB. Additional depreciation not available. Ineligible plant and machinery, any plant and machinery which is in the nature of ship, aircraft, road transport vehicle not eligible. Plant and machinery which is a second-hand plant and machinery not eligible. Office appliances, any plant and machinery installed in residential accommodation, guest house, these are the items which are not eligible. And after depreciation, there is another point, that is whenever there is a business restructuring of amalgamation, demerger, conversion, succession happened during the previous year, in between during the previous year, then depreciation should be bifurcated to the predecessor and successor based on number of days asset used by both of them. Section 32 subsection 2, additional depreciation, unabsorbed depreciation. Due to non-availability of profit or inadequacy of profit, entire amount of current year depreciation could not be claimed off. That is known as unabsorbed depreciation. Infinite period carry forward, due date is not compulsory. Restructuring cases also predecessors unabsorbed depreciation available to successor. And further, unabsorbed depreciation can be set off while computing book profit under section 40B for partnership firm and LLP. And further, this unabsorbed depreciation can be carry forward for infinite period. There is no time limit. So these are the major points related to unabsorbed depreciation. And then under depreciation, there are certain case laws are there. That is registered ownership related to that point. There is some case laws. And regarding use, it should be actually used for the purpose of the business. There is no condition that assessee should physically use that assessee. No, there is no such condition. In connection with the business, you can use. So even though the asset is used located in somewhere else, but it is used for your business purpose, it is not in your factory, not in your building, but still you can claim depreciation. And register ownership not compulsory. ICDS limited Supreme Court case is there that you can go through. So that is section 32. 43 speaks about actual cost. Generally, actual cost means the cost incurred to purchase an asset, brought it into site and make it ready to use. Whatever expenditure incurred up to that point, it can be added to the cost of the asset and you can claim depreciation. And in a single day, if the payment for purchase of asset exceeds rupees 10,000, it should be made by account by check or account by draft or other prescribed electronic mode. Otherwise, that actual cost is not allowed. So no benefit under the tax law. Single day. So today 10, tomorrow 10, no problem, eligible. And one more thing you have to keep in mind. As per the provisions of section 40, capital letter A, subsection 3, in case of freight paid to a goods transport operator, you can make the payment up to rupees 35,000 in cash. If it exceeds 35,000, the payment should be made in prescribed amount, otherwise it will be disallowed. But remember, to purchase a depreciable asset and brought it into site, you paid freight to GTA, the limit will be 10,000 only. Because the limit of 35,000 for freight applicable only in 40A3, 40A3 deals with the regular revenue expenditure which are debited to P&L. That is not applicable for capital expenditure. If you paid freight in connection with the purchase of an asset, whatever expenditure incurred in connection with the acquisition of asset should be capitalized. So it is a capital expense. So the limit will be only 10. So there you should not apply 35. And now 43 again says special cases of actual cost. If depreciable asset received as a gift, then original cost of the asset minus notional depreciation should be the actual cost. And in case of scientific research asset subsequently brought it into business, actual cost should be taken as 0. And personal purpose, building used for personal purpose, then brought it to business, original cost of that building minus notional depreciation for the period used for personal purpose should be reduced. Remaining is the WDV, that is the actual cost. Similarly, amalgamation, demerger, conversion, succession, in those cases, predecessors WDV as per income tax law should be the actual cost of the successor. Holding company to subsidiary, subsidiary to holding, the transfers WDV as per IT Act should be recipient's actual cost. So those type of special cases are prescribed under 43. 33 AB tea, coffee, rubber development account. If an assessee engaged in growing and manufacturing tea, coffee, rubber, part of the profit can be transferred to a special account within NABARD within 6 months from the end of the previous year or due date for filing ITR, whichever is earlier. Amount transferred to reserve or 40% of profit, whichever is lower, deduction. But once you transfer to reserve, that money can withdraw and it can be utilized only for specific purposes. If you are utilized for ineligible purpose, it is taxable in that year. And any planned and machinery acquired out of the money withdrawn from special deposit account, it should not be transferred within 8-year lock-in period. If that is violated, in that case also income will be taxable. Remember, due to violation, if 33AB income is REIT taxable, you must apply the segregation ratio, because growing and manufacturing tea, what is the ratio? 60-40. 60% agriculture, 40% business. Growing and manufacturing coffee grown and cured, the ratio is 75-25. Coffee grown, cured, roasted, what is the ratio? 60-40. And in case of centrifuged latex or rubber, 65-35. So compute PGBP, claim 33AB deduction, and then we are splitting. So 33AB deduction is claimed from composite income. So whatever amount is REIT taxable from that reserve amount, that is the deduction allowed amount subsequently withdrawn, and it is REIT taxable. Then again we should apply the ratio of segregation, because that income contains agriculture income. Agriculture income is exempted. So those are the points related to 33AB. 33AB is anyway not that much important. You can no need to study at all. 35, scientific research expenditure. In-house research is there. Donation is there. Again, 115 BAC or BAA or BAB SSE, only in-house can claim. Donation to outsiders is not eligible. Further, in case of donation, the recipient entity must file a prescribed statement with income tax authority. Otherwise, for the donor, deduction won't be possible. And 35, if research asset is subsequently transferred, so there will be business income. Original cost or selling price, whichever is lower, business income. If research asset is subsequently brought into block of asset, actual cost must be taken as 0. 35 AB and ABB, spectrum license and telecommunication license fees actually paid can be amortized over the life of the license on a proportionate basis. So no need to claim depreciation for telecommunication license. You should claim ABA or ABB. Amount actually paid is allowed as deduction over the period. So before expiring the deduction, if that license is sold, there is a possibility of business income and capital gain. 35 AD, that is we know investment linked tax incentive. It's a very big incentive. Capital expense is allowed. We discussed all the related points. Loss can carry forward. It can set off only against the 35 income. If a person, not a company claiming 35 AD, definitely he will be liable for AMT. So that is why 35 AD is absolutely optional. Assessee has a choice either to claim 35 AD and pay AMT, or not to claim 35 AD, claim depreciation and exempt from AMT. So he can select. It's purely optional, not compulsory. And under section 35 AD also, capital expenditure payment single day exceeds 10,000 should be made in prescribed mode. Otherwise 35 deduction is not allowed. And further, under section 35 AD, if pre-commencement expenditure is there and it is capitalized in the books on the date of commencement, that is also possible. That is also can be claimed as deduction. For the purpose of set off and carry forward, 35 AD will be considered as a business loss, but still 35 AD loss can carry forward infinite period because a separate section 73A. But due date is compulsory. In order to carry forward 35 AD loss or normal business loss, capital loss, owning and maintaining racecourse loss, the return must be filed within the original due date as per section 139 subsection 3. Otherwise, that loss you cannot carry forward. But remember, HP loss, house property loss, unabsorbed depreciation. Even though return is belated, we can carry forward. 35 CCA, that is that deals with some donation. That is not that much important. And 35 CCC and CCD, agriculture extension project and skill development project. And the CCC and CCD, even though it is an attractive section, not available for BAA and BAB persons. And CCC and CCD says agriculture extension project and skill development project, even though it is not directly related to your business, whatever revenue and capital expense incurred for that project, you can directly claim as deduction from profit. But regarding building, no deduction. Land, no deduction. All other revenue and capital expense for notified agriculture extension project eligible, notified skill development project CCD eligible, but CCD only to company corporates. 35D, amortization of preliminary expenditure, 5 equal installments. There is a ceiling limit. So for final level, we should think about company. For corporates, 9 expenses are eligible as preliminary. That is feasibility study, project report preparation, engineering service expenditure, market survey expenditure, agreement drafting expenditures, articles, memorandum, drafting, typing, printing, ROC incorporation expenditure, advertisement of prospectus, and initial public issue of shares, debentures, etc. This 9 expenditure total should be compared with 5% of capital employed or 5% of fixed assets, whichever is higher. So 5% of fixed assets or 5% of capital employed, whichever is higher. That amount should be compared with actual preliminary expenditure, whichever is lower, can be claimed as reduction in 5 equal installments starting from the first year. And again, here the word capital employed does not include securities premium. Supreme Court case. Securities premium should not be counted in capital employed. Unfavorable to assessee, because if securities premium is included, capital employed will be more. If capital employed is more, there will be more 5%. So you will get more deduction. Not possible. Securities premium should not be included in capital employed for the purpose of 35D. And further, at the time of issue of shares, if the share issue, at the time of share issue, there will be a lot of expenditure, but share application money and allotment money will be kept in a bank account until completion of that allotment. In those situations, bank will give some interest. Their interest income should be set off from preliminary expenditure. It should not be taxed to IFOS. It should be set off from preliminary expenditure. That is 35D. When a company is starting, at the time of starting, it issued debentures and debenture issue expenditure incurred 35D. On started, during the course of the business, debenture issued and debenture issue expenditure incurred, absolutely revenue expenditure, you can claim under 37. Share, at the time of starting of the company, issued shares, the share issue expenditure, preliminary, 35D. During the course of the business, to get some additional funds, share issued and share issue expenditure incurred, capital nature, not allowed under section 35D or not allowed under section 37 also. 35D, that is not possible because there is no commencement of business during the course of the business. So there will be no 35D, but such a share issue expenditure, that is shares issued during the course of the business, you cannot claim under section 37. It is capital nature. To claim an expense under section 37, it must be revenue nature. Brook Bond India Limited, Supreme Court. But if bonus shares issued during the course of the business and share issue expenditure is incurred, you can claim it under section 37, because in case of bonus issue, there is no fresh inflow of fund into the company. So it is absolutely a finance decision or internal decision. So that is a revenue expenditure. So bonus issue, share issue expenditure, revenue, you can claim under 37. But normal share or right share issued during the course of the business, that expenditure is capital, not allowed under 37. But if all these happened at the time of starting of the new business or extension of the existing business, you can try under section 35D. Debenture, very clear, whether it is convertible debenture or not convertible debenture or partly convertible or fully convertible, debenture issue expenditure, if during the course of the business absolutely revenue, you can claim under section 37. But at the time of starting of the new business, go to 35D. 35DD, amortization of amalgamation and demerger related expenditure. You can amortize over 5 years. No limit, nothing like that. But remember, amalgamation, in case of amalgamation, as a tax planning, it is always better to incur the amalgamation expenditure by the new company, amalgamated company, so that the entire 5 installments can be claimed. But if that amalgamation expenditure is incurred by the amalgamating company, old company, they can claim only that first installment in that year. Balance 4 installment they cannot claim, because after that company is no more. But in case of demerger, such an issue does not arise, because in case of demerger company still exists. Resulting company also arises. So any person can incur, they can claim all the 5 installments. DDA, VRS compensation actually paid. Actually paid. So VRS compensation due, not eligible. Actually paid. That is also allowed as deduction in 5 equal installments only. 36 deals with a lot of expenses. Just I will tell the name. First one is insurance premium paid to insure the stock of the business. WIP, finished goods, consumable stores, all stocks. Insurance is eligible. Health insurance premium paid to insure the health of the employees, eligible. Strict condition, premium should not be paid in cash. Even though less than 10,000, should not be paid in cash. Any mode other than cash only eligible. And if that premium exceeds 10,000, General Provision 48(3), account by check, account by draft. Less than 10,000 also should not be paid in cash. And policy must be approved by IRDA, or that should be belongs to GIC. General Insurance Corporation, then that is eligible. Health insurance premium. And then section 36 says that bonus or commission paid or payable to employees, but bonus and commission to employees will be allowed as a deduction subject to 43B. That bonus or commission should be actually paid before the due date for filing ITR. Either the company can directly make payment to employee, or the company can create a trust and the amount is transferred, bonus is transferred to the trust and trust is paid to the employee before the due date for filing ITR, even though they can claim that. There is a case known as Shas and Drugs and Chemicals Limited, Supreme Court. So, bonus and commission allowed as a deduction only if it is actually paid before the due date. 43B. Now the next item, discount on zero coupon bond. Allowed as deduction over the period of the bond on a pro rata basis. And then they are saying interest on capital, interest on loan, interest on borrowed capital, interest on loan. Lot of condition. If the loan is taken for purchase of a depreciable asset, do not debit to P&L from the date of loan till the date of first put use of asset. Interest should be added to actual cost and claim depreciation. After put use, debit to P&L. If the loan is taken from banks or public financial institutions or NBFC or cooperative bank, in those situations, interest will be allowed subject to 43B. If the loan is taken from a private person, not banks or public finance institution, then before making payment of interest, deduct TDS 194A and remit before the due date for filing ITR. Otherwise, 40A 1A, if the interest is paid to resident without TDS, 30% will be disallowed. If the interest is paid to non-resident, 195, 100% of that interest will be disallowed as per section 40AI. And if the loan is taken from outside India or resident, this is the rule. If the loan taken from banks, 43B. If the loan is taken from related party, one more condition, that interest should be paid at a fair market rate. Otherwise, 40 capital letter subsection 2, excess compared to the market rate, excess rate of interest will be disallowed. So those are the major provisions we have to keep in mind regarding interest on loan. And then section 36 says that if the company provides contribution to national pension scheme on behalf of employee, that is employer contribution to NPS, it should not exceed 14% of basic plus DA forming part of salary of the employee. If it exceeds 14%, excess will be disallowed as per section 40 capital letter A subsection 9. Up to 14% allowed under section 36. Similarly, if the employer is making contribution to PF, ESI or approved gratuity fund, etc., other than NBS, any other recognized employee welfare fund, employer is contributing, only one condition, 43B. It should be paid before the due date for filing ITR. Remember, for NBS also 43B applicable. Whatever contribution paid by employer on behalf of employee, subject to 43B. And then section 36 says employee's contribution deducted by employer from the salary of employee, and then later on employer remitted to PF account. Very dangerous. The moment employer deducted employee's contribution towards PF ESI, at that moment it must be treated as income of the company or income of the employer. It should be added to net profit as per section 2 subsection 24 subclause 10. And then if it is paid before the due date of the relevant act means PF Act, ESI Act, etc., then you can claim it as deduction under section 36. If any 1 month PF is not paid within the relevant act due date, then that month the PF you cannot claim it as an expense. So regarding employee's contribution deducted by employer, very strict provision, relevant act due date. But employer contribution, 43B, due date for filing ITR. You have an adequate time. Then section 36 says that if animals used as an asset for the purpose of business or profession, you can't claim depreciation under section 32, because 32 says plant and machinery does not include live animals and plantations and estates. So regarding animals, you can claim deduction only when that animal is died or permanently useless. Original cost of that animal reduced by sale of carcasses or scrap amount if any received. The net amount you can claim under section 36. So up to that, no benefit will be available for live animals. So that is the next item. Then section 36 says that family planning expenditure incurred by a company amongst the employees is allowed as a deduction only to corporates. So in an assessment of firm or LLP question, if there is family planning expenditure, suddenly you have to add back. Not allowed, only company. For company, family planning expenditure should be incurred not on the society, it should be incurred amongst its employees. If it is conducted a family planning program somewhere else, not allowed, not allowed. On the employees. And that is also, there is a revenue expenditure and a capital expenditure. Revenue expenditure on family planning 100% allowed in that year. Capital expenditure on family planning allowed only in 5 equal installments over a period of 5 years. And unabsorbed capital expenditure on family planning treated like unabsorbed depreciation. So these are the major items. They are mentioned under section 36. And then 37, general deduction. General deduction, any expenditure which is revenue in nature, not capital in nature, you can claim under as a deduction. The most important points are explanation 1, 2, 3. Explanation 1, very important. Any expenditure illegal in nature, public offense, prohibited by law, not allowed. Explanation 3, connected to explanation 1. Sometimes for the payer, it may not be prohibited by law. But for the acceptor, for the other person who is receiving that benefits, it is prohibited by law. Then, for the purpose of payer also, it will be deemed that prohibited. Prohibited by law means either prohibited in Indian law or prohibited by foreign law. That is also cleared by explanation 3. Again, explanation 3 says one more point. That is, sometimes some persons will breach the law and they will pay penalty, but that payment will be accounted as compounding fee or regularization fee. They will use some beautiful names to account that item. Actually, it is breach of law. So even though what type of terminology you are using, if it is a breach of law and you are accounted as compounding fee or regularization fee, it should be disallowed. Then there is a reason update in section 37. Sometimes there may be a breach of law and customer will file a case against a company and the company will go for litigation. In that situation, company very well aware that there is a breach from the part of the company and actually it is an illegal activity. So if the case further proceeded, definitely the company will be penalized. So at that time, the company will ask the client, see, we can do one thing, we can settle the case. If the client is ready, they will settle the case. So for that settlement, company will pay some amount to the client. So that settlement amount is also to be disallowed, because even though it is a settlement amount, what type of case you settled, if that case was proceeded, it is a breach of law and definitely the company will be liable to pay penalty. To avoid that, they are settling this case. So if an illegal case is settled, that settlement amount is also to be disallowed as per explanation 1 and 3. Now explanation 2, that is any CSR expenditure, corporate social responsibility expenditure incurred and debited to P&L, it must be disallowed. If it is characterized as or stamped as CSR, it should be disallowed. But if any CSR expenditure which has a character of a CSR but specifically allowed from 30 to 36, for example, family planning expenditure, actually it is a CSR, but specifically provided under 36, you can claim, no problem. So even though, see, scientific research donation, actually CSR, but 35 is specifically provided. All other general CSR expenditure claimed through 37 won't be allowed. That is explanation 2. So 37 is very important. You may aware there are numerous case laws, especially that pharma industries, there is a big issue. Pharmaceutical company will try to influence the doctors by giving freebies to the doctors to promote their branded medicines. So for that purpose, they are giving a lot of perquisites. All those perquisites will be taxable in the hands of the doctors as an income, but in the hands of the pharma company, it must be disallowed because of it is prohibited by Indian Medical Council Ethics Regulation. So all those areas are very important. There are numerous case laws regarding section 37. All those you should keep in mind, especially recent judicial rulings. Okay. So then there will be, there is disallowance is there. So I will go through that. Before that, special provision 43A says, if asset is purchased from outside India, foreign exchange fluctuation arises, that foreign exchange fluctuation should be adjusted to cost of the asset, should not be debited to P&L if it is asset. 43C, at the time of amalgamation, stock in trade will be taken from the old company by the new company. At the time of amalgamation, it will be revalued. Then it will account in the balance sheet. Then they will sell that stock and very limited income will be shown as income by manipulation of revaluation. So they are saying stock in trade obtained under amalgamation or demerger, or stock in trade received as a gift, or stock in trade is received as a will, under will, or stock in trade received at the time of partition of HEF. If subsequently that stock is transferred while computing PGBP income, the cost of acquisition of that stock should be taken as original cost of the predecessor. you cannot take that revalued figure. But if the original cost of that stock should be taken and further if assessee incurred any value addition, that can also be claimed. But revalued figure should be ignored. That should not be taken. So that is section 43C. Special provision for stock and trade. And 43CA we discussed, that is land building, real estate developer, 110% stamp value, maybe 2 stamp value, agreement, registration, and again disputed, valuation officer reduced, increased, court reduced, for the buyer, IFOS, TDS, 194 IA, all those provisions you have to keep in mind. 43CA, and if it is a capital asset, 50C. 44AA, compulsory maintenance of books of account. 44AB, audit, again very important. Out of all the outflow, 95% of the outflow through bank, only 5% or less outflow is other than bank or other than account pay check. Plus, out of all the receipts, 95% receipts through Pakka Bank, only 5% is less than 5% of the total receipts are through this particular cash or cross check, something like that. If all these two conditions are both sides satisfied, that is out of the total receipts 95% through bank plus out of the total payments 95% through bank. Or other words we can say that cash payment or normal check payment or cross check payment or cash receipts or normal check receipts is less than 5% of the total receipts and total payments, then tax audit limit will be 10 crore. So that's very much. Otherwise, normally 1 crore. In case of 44AD, presumptive taxation assessee 2 crore, and in some cases 3 crore. That is tax audit is very important. Now 44AD, normally businessman, any businessman, resident individual, resident HF, resident partnership firm. Remember, LLP not eligible for AD. LLP not eligible for ADA. Resident individual, resident HF, resident firm. Under 44AD, any business except agency business, commission business, brokerage business, turnover should not exceed rupees 2 crore. But this 2 crore can be increased to 3 crore. The condition is during the previous year, out of the turnover, amount received in cash does not exceed 5% of total turnover. Amount received in cash or normal check does not exceed 5% of total turnover. Then the limit will be 3 crore. 2 will be increased to 3 crore. Similarly, 44ADA, normally 50 lakhs for specified professionals, accounting, legal, medical, architect, engineering, company secretary, authorized representative, interior decorator, film artist. So those are the specified profession. Gross receipts should not exceed 50 lakhs. But out of the gross receipts, amount received in cash does not exceed 5% of the total receipts, then 75 lakhs. AD, presumptive income, out of the total turnover, during the previous year, out of the turnover, how much amount is received in account by check, account by draft, OPM, other prescribed electronic mode, OPM, before the due date for filing IT return. To that extent, 6% should be declared as income. And balance turnover, whether you received or not, whether it is received by cash, whether it is received after due date, doesn't matter. Take the total turnover, find out 6% category, remaining full 8%, that is income. So from this income, no expense is possible. As no expense is possible, remember, no disallowance for 44AD assessee. 40 to 43B disallowance not applicable for AD and AE assessee because they are not claiming expense. If a person not claiming expense, not debiting expense, there is no question of disallowance. And 44AD assessees are exempted from paying first 3 installment of advance tax. They need to pay only the last installment of advance tax. And 44AD, there is a lock-in period. Once they opted, next 5 assessment year, you must stick on in this particular section. And once you go out of 44AD, for the purpose of depreciation, WDV shall be computed for those period you declared income under 44AD on a notional basis. Reduce, you will get the WDV. That should be continued when you are maintaining books of accounts. If a person opt out of 44AD, even though eligible, before completing 5 years, opt out. Okay, then that opt out year plus next 5 assessment year, he cannot re-enter into AD. And in those period, if his income exceeds basic exemption limit, he must maintain books. Irrespective of the turnover, books should be audited by chartered accountant. That is section 44AD. And section 44ADA, similar to AD, but here the income is 50% of gross receipt should be declared as income, but no lock-in period. No lock-in period. And section 44 AD and ADA, if a partnership firm declaring AD or ADA, remember they cannot claim interest on capital to partners and remuneration. 40B deduction not possible. 44 AE, goods transport operator, hiring, leasing, plying goods carriages, total vehicles should not be more than 10. You are aware about that. Declare that income. There is no lock-in period and there is no exemption from advance tax. 44 AE assessee, they have to pay all the 4 installments. And further, there is no lock-in period. And further, 44 AE can be claimed by any assessee, even company, LLP, anyone can claim. And further, under section 44 AE, 40B deduction, there is no prohibition. 40B possible. Because in other 2 sections, it is specifically prohibited. But 44 AE, the act is silent. So, 40B deduction is possible against the 44 AE income. So, these are the provisions regarding presumptive. Rule 60D, what are the circumstances where we can make the payment in a single day exceeding 10,000 without complying 40A3. We can make payment in cash. That is Rule 60D. Rule 7 and Rule 8 deals with the splitting of agriculture and business income. That is tea, coffee, rubber. So these are this particular area, special area. And 40B will be discussed. Now disallowance, starting from here. See, in between there is a disallowance 38. So 38 says that if a asset is used simultaneously, partly for business and partly for non-business purpose, that expenditure should be splitted, including depreciation. That is 38, power of AO. 37 2B, permanent disallowance, advertisement expenditure in the printed publication of a political party to be disallowed permanently. But if you are an Indian company, advertisement expenditure paid by check, not in cash, even though it is disallowed in PGBP, it can be taken as Chapter 6A deduction 80 GGB. This benefit available only to Indian company because Companies Act only permit that. Companies Act applicable only to companies. That's why other assessees, they cannot claim under GGC. Other assessees, if they want to claim, donation should be given as a donation. But for Indian company, donation can be given as a donation or advertisement expenditure also will be treated as donation. Then 40A1, that is interest, royalty, fees for technical service or any other sum paid or payable to non-resident outside India or paid or payable outside India. During the previous year, we have to deduct TDS and the TDS should be paid before the due date for filing ITR. 2 conditions. Primary condition, during the year deduct. Second, pay before due date for ITR. Violated, 100% will be disallowed. Key points at the final level. Some students will study like this. Whatever expenditure paid outside India TDS. No, it's not like that. We are making a payment to non-resident. That non-resident's payment is treated as income and taxable in India. Then only you have to deduct TDS. If that payment made to non-resident, if that income is exempted in the hands of the non-resident under section 10, no need to deduct TDS. If that payment is not taxable in India due to operation of double taxation avoidance agreement, then no need to deduct TDS. Remember, only if the payment made to the non-resident is taxable as income in India, then the payer is liable to deduct TDS. If that payment is not taxable in India, there is no question of tax liability. If there is no question of tax liability, there is no question of recovery of tax. If there is no recovery of tax, there is no question of TDS because TDS is one of the forms of recovery of tax. If there is no question of tax liability, then there is no question of TDS. So whatever payment made to non-resident TDS, no, that is absolutely wrong. If you are making a payment to non-resident and for us it is an expenditure, for him it is an income. If that income is taxable in India as per the income tax law, deduct TDS. Non-resident has no business connection in India, no permanent establishment in India, but we purchased the goods from non-resident and we are making payment. For us it is a purchase cost, P&L account debit balance, trading account debit side. For the non-resident it is sales. He is making sales from that country. He does not have P in India, no business connection. See, that business income is not taxable in India. So for that purchase payment, no need to deduct TDS. So similarly, pure reimbursement of expenditure made to non-resident, it is not taxable in India. So no taxability, no TDS. That's very important. And second thing, we made a payment that is taxable in India, but we couldn't deduct the TDS. But the non-resident was a genuine person. He included this payment as his income in his return and paid tax and filed a return in the assessment year. Then for us, current year, 40A1 disallowance will be sure, will be disallowed. But in the next year, we can claim it back. 40A1A, that is, if the payment is made to residents on which TDS is applicable, that is section 192, 193, 194, 194A. So any one of that TDS section is applicable, you must comply with the TDS, deduct TDS, pay before due date, otherwise 30% only will be disallowed. So 40A1 and 40A1A both are actually TDS compliance disallowance, but 40A1 100%, 40A1A 30%. Both sections are temporary disallowance. In the subsequent year, if assessee paid that TDS, or in the subsequent year from another payment, this TDS has been deducted and paid, then in the subsequent year, deduction can be claimed back. So it is a temporary disallowance. 40A1B, we are making payment for a digital advertisement or space for digital advertisement to Google or similar type of non-resident. They does not have a P in India. They are operating from outside India, and we are making payment for digital advertisement or website for digital advertisement, and the payment exceeds 1 lakh. Then as per the provisions of Finance Act, we have to deduct equalization levy at the rate of 6%. If you did not deduct equalization levy, or equalization levy is deducted but did not remitted to government before the due date, then as per 40A subsection IB or 1B, that advertisement expense, digital advertisement expense will be disallowed. So any payment for which equalization levy applicable, and we must deduct and pay before due date, otherwise that expenditure will be disallowed. Practically, digital advertisement and web space purchased for digital advertisement from a non-resident who does not have a P in India and the amount exceeds 1 lakh. Section 48(2), income tax, provision for income tax, interest on income tax, penalty on income tax, if debited to P&L, whether Indian income tax or foreign income tax debited to P&L, it must be disallowed, because tax should be adjusted from tax only. Okay, it cannot be adjusted as an expense. You cannot claim. So income tax, provision for income tax, etc., even DDT should be disallowed. 48(2)B, that is not that much important. That is a government company, state government company, to evade the tax. Sometimes state government company P&L account will debit it with a royalty or service fee paid to the shareholder, which is government. Government is a shareholder, state government. Actually, it is a fraud. To reduce the profit, they are simply put royalty, service fee, commission paid to state government shareholder. Actually, there is no services rendered by the state government shareholder. So such expenditure should be disallowed permanently. And 48(3) is there. If salary paid outside India, we have to deduct the TDS. And if the TDS has not been deducted, it must be disallowed. And 48(4), not that much important. That is out of PF contribution. When the employee withdrawing from the PF, TDS must be deducted. Otherwise, PF contribution by employer will be disallowed. That is 48(4). Not that much important, because if you make a premature withdrawal from EPF, definitely 192A TDS will be attracted. So 48(5), if the employer paid income tax on perquisite of employee and debited to P&L, it must be disallowed permanently. 48(3), that is a single day expenditure exceeding 10,000. That goods transport operator fry 35. 48(3)A, mercantile system, current year expenditure incurred, due entry puts, expense account debited to expense payable, expense debited to P&L, payable booked in balance sheet. Current year no payment is made. Next year or after some 2-3 years, you made the payment to this party in a single day exceeding 10,000 by cash. So in that year, the expenditure is not debited. So there is no disallowance is possible. That is why 48(3)A says, once expenditure is claimed on accrual basis and in subsequent year, the liability is settled by cash exceeding 10,000, in the year of settlement, that amount settled by cash deemed to be income and added to net profit, because disallowance not possible, because expense is not debited in that year. That is why deemed income, A3A. A3 disallowance. 40(A3) disallowance applicable only for revenue expenditures debited to P&L. It's not applicable for capital expense. Capital expense disallowance available in 43 and 35 AD. This is only for revenue expense. That is why asset purchase, transportation, freight is paid. The limit is 10, not 35. 48(7), provision for gratuity if debited to P&L, disallowed. But when gratuity actually paid, reduce. We can say some sort of a temporary. Present provision, disallowed. Actually employee retired and paid or payable, allowed. 48(9), Unrecognized employee welfare funds, made contribution, debited to P&L, disallow. Example, unrecognized provident fund, unrecognized ESI, etc. That's an example. And now one more disallowance is provided under 40 and 9. That is, employer is making contribution to NBS in excess of 14% of basic plus DA forming part of salary. That excess must be disallowed. 40 and 9. And 48.13, which says that if any marked to market losses, MTML, marked to market losses, that is comparing certain items in the book value with the market value on the balance sheet date, and if there is any depletion, that will be debited to P&L. That is marked to market losses. So if the marked to market loss debited to P&L is not as per ICDS, ICDS 1 to 10. If it is not as per ICDS, maybe it is as per AS or Ind-AS, but it is not permitted by ICDS, it should be disallowed. So marked to market losses, or we can say provisions, debited to P&L not as per ICDS, then it must be disallowed. That is 48.13. 43B, 6 expenditure, that is duty, taxes, fees payable to government under any law, interest on loan if it is taken from banks, etc., bonus and commission to employees, employers' contribution to PF, ESI, leave encashment, fees payable to railway for use of railway assets. These 6 items, due date. Before the due date for filing ITR, you should pay. Otherwise, it should be disallowed, but temporary. If you paid at a later point of time, you can claim it back. 43B, second part. If the goods or services has been purchased from micro or small enterprises, the payment should be made within the due date prescribed under MSME Act. If the payment is not made within the due date prescribed under MSME Act, then deduction will be allowed in the financial year in which payment is made. So even though MSME due date is violated, but we made the payment before 31st March 2025, allowed in current year. But payment made in April 25, next financial year, but within the due date prescribed under MSME Act, allowed in current year. That's it. But that provision not applicable for medium enterprise. If you made purchase from micro and small, pay within the due date of MSME. If you purchase from medium enterprise, no problem. Even though payment is not made, you can claim. That amendment covers only micro and small, not covered medium enterprise. Got it? So we'll go for lunch break, come back, and what are the possible items we can cover, we'll cover later. Okay. So go for lunch break. You can go to real estate investment trust and infrastructure investment trusts. So in that handout, question number 35. Okay, first I will explain the provisions, then we will go to solve that question. So actually these are private trust, or otherwise it is known as business trust. So how it is working, the structure is, this is actually a mechanism to promote investment in real estate sector, and to collect some bulk investment. They created a model that is known as private trust or business trust. There are two types of business trust at present. One is real estate investment trust and another one is infrastructure investment trust. Even though it is called as a trust, it will look like a mutual fund. It will have a lot of units. So units will be subscribed by general public and even the sponsors. Actually, originally the idea of trust is created by the sponsor. That sponsors will be usually big corporates. And even general public also can participate. So this real estate investment trust fund will be collected by issuing units, not shares, not debentures, by issuing units. And this trust will be regulated by SEBI and its units will be listed in recognized stock exchange. So the real estate investment trust is getting money from unit holders and from the sponsors. So sponsors are also getting units. So unit holders, general public also getting units. So their fund is pooling together. So trust has a lot of money. So this fund, trust can invest in two ways. Majority of the investment must be made in another Indian company. That main purpose of that Indian company will be real estate business. Developing of real estate or real estate property development or property selling or real estate companies. So in majority cases that company will be listed also. That Indian companies are known as SPV. SPV means special purpose vehicles. So in that SPV or Indian real estate companies, domestic companies, the trust will make their major investment. Their major money collected from the unit holders will be put as an investment in shares of SPV or sometimes debentures of SPV, etc. Mainly into shares. So we can say that real estate investment trust or infrastructure investment trust is a shareholder of SPV or an investor in SPV. In addition to that, the remaining amount they can utilize to purchase real estate assets directly held by this real estate investment trust. And from that real estate properties, that will be large commercial buildings or residential buildings. From that they will get revenue, rental income, and sometimes they will sell it. So they will have capital gain also. So this is a structure of a real estate investment trust or infrastructure investment trust. Real estate investment trust or infrastructure investment trust. So here we are trying to study the tax aspects of the trust and unit holder. SPV anyway, that is an Indian company. Sponsors also will be Indian companies. So the other two persons are, one is real estate investment trust and another one is unit holder. As a unit holder, he will get return for the amount he invested in the units of trust. So what is the taxability of such income received by unit holder? And further, real estate investment trust will get income from SPV by way of dividend from shares invested in SPV, or sometimes they will get interest from SPV, or sometimes they will transfer the shares of SPV so that they will get capital gain. In addition to that, they will get revenue from that real estate assets, directly rental income they may receive. Sometimes they sell that real estate property, so there will be capital gain. So those are the income generated by trust. So what is a tax treatment? Mainly the majority of the income received by the trust are exempted at the trust level. But when it is distributed to the unit holders, it will be taxable in the hands of the unit holder. So the real estate investment trust will get a tax-free status unless the income is generated by the real estate investment trust as per the purpose for which this trust is created, to collect more investment from the public and to invest in real estate sector. So if they are earning income in such a way, there will be no tax liability. But if they are selling their share, or sometimes if they are selling their real estate property, or directly on the real estate property they are getting rental income. So all those income will be taxable at the trust level. So what are the income which will be taxable at the trust level, and what are the income which will be taxable at the unit holder level? So if an income is taxable at the trust level, definitely it will be exempted in the hands of the unit holder. And if at the trust level it is exempted, then it will be taxable at the unit holder level. So there won't be any double taxation. So if an income is taxable at the unit holder level, that income is distributed by trust. So trustee has to deduct TDS also. So total there will be 5 income. So this is the overall treatment. So if the real estate investment trust or infrastructure investment trust getting income from by way of interest from directly from SPV. SPV means special purpose vehicle, that is the Indian company main objective is real estate development. So from that SPV, if they are getting interest, that means this real estate investment trust or infrastructure investment trust made investment in debentures or deposits with SPV, so that they are getting interest. And second one, they are getting dividend from SPV. That means they are holding the shares of SPV, so that company will declare dividend. So unit holder is a shareholder, so they will get the dividend. And third one, rental income from directly owned real estate assets. So these are the 3 income which will be exempted at the time of receipt by the trust. In the hands of the trust, it won't be taxable, but when it is subsequently distributed, it will be taxable in the hands of the unit holder only. Now, capital gain from sale of shares of SPV, that is not promoting, because once you made investment in SPV, that should be keep it as an investment, and you can get interest income or dividend. So do not sell it. So if you sell it, it will be taxable at the trust level. So capital gain on sale of shares of SPV, that will be taxable if it is listed and STT paid 112A if it is long term. If it is short term, STT paid 111A, and if it is if STT is not paid, then it will be taxable at 112 flat rate 10% or 20% or 12.5%. Or otherwise, if it is listed and STT paid 112A or 111A. So that is capital gain on sale of shares of SPV. And then any other income here means the possibilities, sometimes the real estate investment trust may invest the income in some other assets, not in SPV, not in directly on the real estate property, with some other company, some minute amount they may invest. In that situation, if they are getting any return, that will be other income. Sale of directly on the real estate property, other income. So such incomes will be taxable at MMR at the trust level. Similarly, capital gain on sale of shares of SPV also taxable at the trust level. So other 3 items will be exempted. So whatever item taxable at the trust level, when it is subsequently distributed to the member, unit holder, it will be exempted. But if whatever income exempted at the trust level, it will be taxable in the hands of the unit holder. So trustee has to deduct TDS also. Now, interest income from SPV received by trust, if it is distributed to unit holder, it will be exempted in the hands of the trust. So it will be taxable in the hands of the unit holder. So real estate investment trustee has to deduct TDS under section 194 LBA. The rate will be depending upon whether the unit holder is resident or non-resident. The rates of TDS will vary, that we will discuss later. So it will be taxable in the hands of the unit holder. So TDS is applicable. Second one is dividend income from SPV, which is exempted in the hands of the trust. If subsequently distributed to the unit holder, it will be taxable, provided there is a condition. If SPV, special purpose vehicle, opted for section 115BAA. SPV means Indian company, mainly engaged in real estate development. So if that SPV opted for 115BAA, then only the dividend distributed by SPV taxable in the hands of the unit holder. But if the special purpose vehicle, that is Indian company, not opted for 115BAA, they opt out of BAA, that means normal provisions they are paying tax, then this dividend is exempted, completely exempted. Exempted at trust level, even exempted at unit holder level also. That is a treatment of dividend income from SPV. Not directly received from SPV received by trust, and then trust distributed to unit holder. So if SPV opted for 115BAA, taxable. If SPV not opted for 115BAA, then it will be exempted. And next one, rental income from directly on the real estate assets received by trust, exempted for trust. So it is taxable in the hands of the unit holder. So in that case also they have to deduct TDS. Then other 2 items, capital gain from sale of shares of SPV, directly taxable at the trust level at the concerned rate applicable under 112 or 12A or 111A. and hence it will be exempted in the hands of the unit holder at the time of distribution. Similarly, any other income from sale of development properties or something like that, it will be taxable at MMR, maximum marginal rate, that is 30% plus highest surcharge plus cess, effective rate 42.744. It will be taxable at the trust level. So any other income distributed also will be exempted. This is the tax treatment of real estate investment trust and the unit holder. And now what is the TDS aspects? So dividend from SPV exempted for unit holder if the SPV does not opted for BAA concessional rate of tax. But if SPV opted for BAA, it will be taxable. In that situation, the real estate investment trust shall deduct TDS under section 194 LBA at the rate of 10% if the payee is a non-resident, and at the normal rates in force if payee is a resident. Because for a payee, if the payee is a resident, dividend is taxable under income from other source. It will be taxable at a slab rate, normal rate. But if dividend is received by a non-resident from India, it will be taxable at a flat rate of 20% as per section 115A. But this particular dividend in the hands of the non-resident, taxable only at a 10% as per section 115A. Hence the TDS rate also 10% if payee or the unit holder is a non-resident. TDS rate is 10%. But if the payee, that is the unit holder, is a resident, then normal rates in force will be applied. Similarly, interest income and rental income also liable for TDS because interest income from SPV exempt in the hands of the trust, so taxable at the unit holder level. So at the time of distribution, trustee has to deduct TDS. Similarly, rental income is also exempted for trust, so it will be taxable in the hands of the unit holder. In that situation, TDS, when interest is distributed to non-resident unit holder, rate of TDS is 5%, tax rate also 5%, and to residents, the TDS rate will be 10%. Rent distributed to non-resident unit holder, TDS rate will be rates in force. That means normal rate prescribed under the income tax law or rate as per double taxation ordinance agreement, whichever is favorable, that is known as rates in force. Or to residents, 10%, because generally for residents, rent income TDS is as per section 194I, the general rate is 10%. So that rate is applied here also, 10%. So this is a TDS provision when the income is distributed by trusted to the unit holder. But remember, for all distribution, TDS is not applicable. Only if the income is taxable in the hands of the unit holder, then only trustee has to deduct TDS. So these are the main point we have to keep in mind in regarding real estate investment trust. So now we can try the question. So now the problem is sometimes the real estate investment trust will distribute only a small amount to the unit holder, but actually they are getting income by way of all these 5, 1, 2, 3, 4, 5. But the distributed amount will be a single amount. Say 1 lakh rupees will be distributed to unit holder. Actually, trust obtained 50 lakhs as income from various sources. Taxable exempted all these sources, they got 50 lakhs. But during the year, they are distributing only 1 lakh to the unit holder. So this is a consolidated amount of 1 lakh. So out of this 1 lakh, see how much is interest, how much is dividend, how much is rental income, the breakup is not available. So they are saying in what basis these incomes are received by the trust, in the same ratio, this amount should be splitted. Then only we can identify how much is interest, how much is dividend, how much is taxable, how much is exempted, for which amount TDS is applicable. To find out that, this consolidated amount of income distributed by trust to the unit holder has to be bifurcated. So the bifurcation is based on how the incomes are received by the trust. In that ratio, we have to split. Now we can go to that question. Question number 35. Buildwell Limited, a real estate investment trust, rights, registered under relevant SEBI regulations, holds 51% shares in HATS Limited. So here, HATS Limited is the SPV because their major amount is invested in 51% shares of HATS Limited. So HATS Limited is the SPV. Buildwell Limited provides the following information about its income for the previous year 24-25. So the details of income of trust is given. So HATS Limited is SPV. Interest income from HATS Limited 10 crore. So this interest income will be exempted for trust. Dividend income from HATS Limited 3 crore. So here in the note given to that question, HATS Limited has opted to pay tax under section 115BAA. So as the company opted for 115BAA, this dividend will be taxable, not exempted, taxable. If not opted for BAA, it will be exempted. So here it is taxable in the hands of the unit holder only. Short-term capital gain on sale of developmental properties. So this will be taxable at a MMR at trust level. Interest received from investment in unlisted debentures of companies. So that is not SPV. It is also taxable at MMR. Rental income from directly owned real estate properties, it is exempted at trust level, taxable at the unit holder level. Mr. Vijay, a resident Indian, holds 70% of the units of the trust. He does not have any other income during the year. Compute the total income and tax payable in the hands of Messrs. Buildwell Limited and Mr. Vijay. So we have to see that entire income of the trust will be deemed to be distributed to the unit holder at the year end. So that is the assumption we are taking here. So out of all the income, he will get 70% of his share. So what is the taxability of Vijay and what is the taxability of trust? They are asking compute total income and tax payable in the hands of. So we have to compute tax liability also. So first we can find out the tax liability build well. So regarding the interest income, this will be exempted in the hands of the trust level. Dividend income exempted for trust. Short-term capital gain on development of properties. This will be taxable at what rate? MMR, right? What is MMR? 42.744. Interest received from investment unlisted debenture. Yeah, this is also MMR 42.744%. Rental income from directly owned real estate, that is exempted. So the taxable income of the trust is, here the taxable income is only 1 crore 10 lakhs, which will be taxed at a MMR 42.744%. That is a tax liability. Remember, 42.744 is including cess. So further no need to take the cess. Directly we will get the tax liability. So what is the tax liability? 47.0184. That's a tax liability of real estate investment trust. Now Vijay. So Vijay is holding 70% of the units of the real estate investment trust. He does not have any other income during the year. So how much Vijay will get the income from this particular real estate investment trust? So first we have to take the what is the total income. So if you take the total income, total received by trust 10 plus 3 plus 1 plus 10, that is lakhs, right? So we have to put 0.10. 10 crore plus 3 crore plus 1 crore plus 0.10 crore plus 2.5 crore. What is the total? What is the total? Total income of the trust. How much? 16.6 crore. Suppose if the question says, say 5 lakhs rupees is distributed to unit holder. For example, if the question says 5 lakhs is distributed to unit holder, so then we can say, yeah, 5 lakh into, yeah, 10 divided by 16.6. Similarly, 5 lakhs into 3 divided by 16.6. 1 divided by 5 divided by 16.6 into 1. So similarly, we can apportion the ratio. But here they are not saying how much amount is distributed. So it is assumed that full amount is distributed. So he will get 70%. So directly we can take 70%, right? So interest income into 70%, 10 crore into 70%, how much? $70 lakhs, right? Sorry, 7 crore, 7 crore. This 7 crore taxable in the hands of the unit holder, Mr. Vijay. And dividend income. Dividend income here, the company is paying tax under BAA, so that is taxable. Dividend is taxable. 3 crore into 70%. How much? 3 crore into 70%. How much? 2.1, right? I'm saying the total income, right? So short-term capital gain from development of property exempted for the member because it is taxed at the trust level, that is exempted. Interest received from investments in unlisted debentures of company, taxed at the trust level, so it is not taxable again in the hands of Vijay. Rental income from direct, yeah, that is taxable for the member. So 2.5 crore into 70%, how much? 1.75 crore. So what is the total income of Vijay? 10.875 crore. 10.85. Yeah, 10.85 crore. Question is asking for tax liability. Remember, Vijay covered under 115 BAC. So 115 BAC, the tax rate is up to 3 nil, 3 to 7, 7 to 10, 10 to 12, 12 to 15, and above 15, 30%, right? So here all the incomes are taxable at a slab rate, right? Interest slab rate, dividend slab rate, rental income slab rate. There is no special rate. So we can find out tax under slab rate. So we have to find out the tax at slab rate. Just say the tax. Tax only. 3 crore 22 lakh 40. This is tax only, right? 3 crore 22 lakh 40,000 tax only. Yeah, now the problem is under section 115 BAC, the surcharge is maximum surcharge is 25%, right? Under BAC default tax regime, surcharge cannot exceed 25%. And again, there is another issue. For long-term capital gain, 112, 111A, 112A, and dividend. For these income, surcharge cannot exceed 15%. So there is a provision like that. So out of this 3 crore 22 lakh 40,000, what is the tax rate applicable for dividend? That we have to find out separately. How that is possible? We have to take the average. So 3 crore 22 lakh 40,000 tax is for 10.85 crore. Then what is for dividend? What is the dividend amount income? Dividend income? 2.1 crore, right? Yeah. Then we will get the tax on dividend. So what is the tax on dividend? Yeah, 62 lakh 40,000. On this tax, that is tax on dividend, we have to add surcharge at the rate of 15%. And 3 crore 22 lakh 40,000 minus 62 lakh 40,000. For our balance tax, we can apply surcharge at the rate of 25%. Minus 62 lakh 40,000. What is the balance? 2.2 crore. $3.224 minus 62 lakh 40,000. 2 crore 60 lakhs. For this 2 crore 60 lakhs, add surcharge at the rate of 25%. Because the total income crosses 2 crore. Under default tax regime, once the income crosses 2 crore, surcharge will be 25. Even though it crosses 5 crore, there is no 37% surcharge under default tax regime for an individual. So add 25% surcharge, here add 15% surcharge, then take the total tax, then add 4% health and education cess. That will be the tax liability of Vijay. So you will get the final answer. What is the final answer? 4 crore 12 lakhs. Yeah. 040. 4 crore 12 lakh 63 040. Okay. 4 crore 12 lakh 63 040. So there is another possibility of asking this real estate investment trust. Instead of asking a direct question, there is another possibility, that is, they may ask a assessment of a company question in the compulsory question, first question. In the compulsory question, they will give the details of a company, and finally they will say this company is a unit holder in a real estate investment trust, and this company is getting dividend, interest, all these things will be given. So as a unit holder, this company is getting some income, and further it is a normal domestic company, they have other activities also, and compute the tax liability. So they can ask such a type of a question. Once they asked, I think 2011 or 2012, something like that, in that period they asked a question like that, compulsory question, first question, company assessment, and the final part they are saying this company received the following from a real estate investment trust in which it holds this much units. So in that way also they can ask. Otherwise a direct question they can ask, or maybe a multiple choice question like a case scenario they may ask, including TDS aspects. So here we have to write the TDS aspect also. Okay, that way also they can ask. So that is that area. Now we can go to the another next question, that is actually that's a different area, alternate investment fund. So we can discuss what is alternate investment fund, then we will come to that question. This is also regulated by SEBI, alternate investment fund. There are total 3 levels. Alternate investment fund level 1, category 1, category 2, category 3. So here alternate investment fund means either category 1 or category 2 AIF as notified by SEBI and regulated by SEBI. So it is also just like that of a mechanism working in real estate investment trust, similar to that model, but it is not a real estate investment trust, but we will call it as a fund. So this AIF can be created as a company, or it can be created as a partnership firm, or it may be created as an AOP. In any model, an AIF can be created. The constitution is not important. It need not be as a trust. It can be in any form. Only important point is they should get approval from SEBI as a AIF. So it can be created in any model. So what is the tax treatment? Mainly the income of AIF is income from sale of securities or investment income earned. That is their main income, PGBP income. Then sometimes they will get another income also. So what is the tax treatment of unit holder and alternate investment fund? So first of all, PGBP income or PGBP loss. If the AIF generated PGBP income, then it will be taxable at the AIF level. So further, when it is distributed in the hands of the unit holder, it will be exempted. Similarly, if there is a PGBP loss, that loss cannot be carried forward by the unit holder. That loss can be carried forward by the AIF only, because when PGBP income arises, it is taxable only at the hands of the fund level. So loss also can be carried forward only at the fund level. In the hands of the unit holder, it will be exempted. Now, any income other than PGBP earned by the alternate investment fund, then it will be exempted at the fund level, and at the year end, it will be deemed as distributed. So even though here there is a specific provision, even though alternate investment fund does not distribute any income to the unit holder, at the year end, it will be deemed that all income received by AIF has been distributed. So deeming provision in the law itself. So even though they did not distribute, we have to distribute complete amount, deemed to be distributed. So any other income other than PGBP, it won't be taxed at the fund level, but it will be taxable at the unit holder level. So any other income other than PGBP when distributed, the alternate investment fund AIF has to deduct TDS under section 194 LBB. If the unit holder is resident, 10%, and if the unit holder is non-resident, at the rates in force, that is a TDS rate. Now, loss other than PGBP, that means any other head income generated, this is a treatment. What is the loss treatment? So if any loss is generated, not a PGBP loss, maybe some capital loss or some other type of losses, then that loss, if possible to set off, then it can be set off at the fund level. They can set off, and after set off, any remaining loss is there, then that loss cannot be carried forward by the fund. It can be carried forward only by the unit holder, and unit holder can set off such losses with his other personal income. So any loss except PGBP loss remaining after set off against the current year income available in the hands of the fund, it won't be allowed to set off not allowed to carry forward to the fund, but it can be carried forward only by the unit holder. But to carry forward such a loss by the unit holder, there is a strict condition. At least the unit holder shall held that units for minimum period of 12 months, for 12 months or more. So only if that unit is a long term, then only that unit holder can carry forward such a loss from any other head other than PGBP, because PGBP loss will be allowed to carry forward by the fund level only, but other losses AIF can set off with the other heads of income of the fund if possible to set off, because for set off there are certain rules. So without breaking the general rules of set off, they can set off at the fund level, but if there is still remaining balance loss is coming, then it should be carried forward to the unit holder, but unit holder should held that units for at least 12 months. So what will happen if the unit holder does not held that unit for period of 12 months? So that loss cannot be held by the unit holder. Then what will happen regarding that loss? The act is silent. Can it be carried forward by the fund? The answer is not clear. Actually, that is not possible, because act says only PGBP loss only they can carry forward at the fund level. So nobody will get that benefit if the unit is held by the unit holder for less than 12 months. If the income of AIF during the previous year is not paid or credited to the unit holder, that is the deeming provision, even though alternate investment fund did not distribute its income to the unit holder, it shall be deemed to have been credited to the account of the unit holder on the last day of the previous year in the same proportion in which such a person would have been entitled to receive had it been paid. And what is a tax treatment of fund? What is the rate of tax? If alternate investment fund is created as a company or created as a partnership firm, rate of tax will be 30% or 25%. That is, if it is a firm, 30%. If it is a company, 25%. Sorry, yeah, correct. And if it is a AIF is other than a company or firm, then the rate of tax will be MMR. What is MMR? Maximum marginal rate. So this is the provision regarding taxation of AIF. Now we can try a question. 36. That question also we have to do the tax treatment of both fund and unit holder. The following are the particulars of income of 3 investment funds for previous year 24-25. Fund A, Fund B, Fund C, Fund D. Business income for Fund A, there is no business income. Capital gain 16 lakhs, income from other source 4 lakhs. So it will be not taxable at the fund level. So it should be taxable in the hands of the unit holder. Here it is nothing. Fund B, this business income, here taxable at the fund level, and this 14 lakhs and 4 lakhs taxable in the hands of the unit holders. Fund C, business loss 2, capital loss 6, IFOS 8 lakhs. So we should do the set off. This business loss can set off against IFOS. So balance 6 lakhs to be distributed to unit holder. This 6 lakhs capital loss can set off only against capital gain, and again it will be available only to the unit holder. So this 6 lakhs will be given to the unit holder. So this is also unit holder, this is for unit holder, this is for unit holder, or we can say investor, unit holder. So this is also unit holder, but this 2, 8 balance also for unit holder. What about fund D? Business income 5 lakh taxable at the fund level, and there is a 2 lakhs income from other source loss is there, capital gain is there 20 lakhs. So this income from other source loss can set off against capital gain, right? So what is the balance capital gain? 18. So this 18 can be distributed to unit holder. To be distributed to unit holder. This 5 lakhs taxable at the fund level. This is the current year 24-25. And now compute the total income of investment fund. First case, taxable income of investment fund nil. Second case, taxable income of investment fund is 2. Third case, taxable income of investment fund is nil. Last case, taxable income of investment fund is 5. Now, each investment fund has 20 unit holders, each having 1 unit. So this income should be divided by 20, right? Each unit holders will get, so for every unit holders, how much income will be taxable? To find out that, we have divided by 20 because total there are 20 unit holders. So capital gain 16 lakhs divided by 20. This 4 lakhs IFOS divided by 20. And here 14 lakhs by 20, 4 lakhs by 20. And here 6 lakhs capital loss divided by 20. Here income 6 lakhs divided by 20. Last case, capital gain 18 lakhs divided by 20. So we will get each unit holder's income. Income from investment in the fund is the only income on the unit holder. If investment fund C has the following income, C. So second part of the question deals only with the fund C and the unit holder of C. If investment fund C has the following income components for assessment year 26-27, what would be the total income of the fund and the unit holder for that year? So remember, in assessment year 26-27, see, prior to that, in the current year, what is the impact of fund C? Fund C taxable income is nil, and what is the unit holder getting? So the 6 lakhs loss, capital loss divided by 20. Can you say that figure? 6 lakhs by 20 capital loss. 0.3, right? Capital loss. So this capital loss will be brought forward. So what is the impact of fund in the next year? Business income of 2 lakhs. Taxable at which level? Fund C. Taxable as fund C. Capital gain 9 lakhs. So against this capital gain, what is the share of unit holder? 9 by 20. How much? 1 point, right? Sorry, 0.45, right? This is capital gain for the current year, share received by unit holder from fund C, because capital gain taxable at the unit holder level, not at the fund level. And IFOS, they will get 8 lakhs divided by 20. How much? 0.8 by 20, 0.4. See, capital loss can set off only against the capital gain. So what is a net loss again to be carried forward? Sorry, what is a taxable income ultimately from capital gain? 0.15 capital gain. Correct. And IFO is 0.4. So what is the unit holder of fund C in the next year? 0.55 lakhs. So this 2 lakh will be taxable at the fund level. So whatever losses carry over from the last year, in this case that is capital loss only. So that capital loss can be carried forward by the unit holder to the next year, and next year he is getting some capital gain. So he can set off against that. So balance 0.15 and the income from other source will be 0.40. And again we have to write some notes, but whenever they are distributing that income, they have to deduct the TDS. So we have to mention that 194 LBB section and the rate of TDS, everything we have to mention if they are asking a question like this, because usually this type of a question, if they are asking, it will carry minimum 5 to 6 marks, maximum 6, minimum 5 marks. So we have to write the notes on TDS also. So that is real estate investment trust and alternate investment fund. Now we can go to discuss the provisions of TDS. Some questions are there. We will solve that question. Then we will go to charitable trust. Yeah, there is a provision of VDA also, right? Discuss VDA, then we will go to this virtual digit lesson. So taxation of virtual digital assets. So there is a specific provision 115 BBH. So virtual digital assets defined under section 2 subsection 47A. An information code number token generated through cryptographic means or otherwise having inherent value which can be transferred, stored or traded electronically. And further, a non-fungible token or any other digital asset notified by central government. But anyway, gift card, vouchers, mileage points, reward points, loyalty cards, subscription to websites, platforms, applications that are never treated as VDA. So practically virtual digital asset means these type of currencies, that is Bitcoin, Ethereum, Tether. So these type of digital coins that we can say Bitcoin like that, that is virtual digital assets. So what is a tax treatment? Irrespective of the status of the assessee, whether you are resident or non-resident, whether you are an individual, whether you are a company, irrespective of the status, there is a special provision 115 BBH which says income from transfer of or redemption of or converting your coin into money. So if you are getting money from transfer of this virtual digital asset, it will be taxable at a flat rate of 30%. No deductions are allowed and even no chapter 6A deduction is also not allowed. The only cost of acquisition is allowed. So if you purchase the Bitcoin for 1 crore rupees and you are selling it for 1.5 crore, then 1.5 crore minus 1 crore, balance 50 lakhs. Suppose for that sale, if you incurred commission or sale on brokerage, commission on sale or brokerage paid for sale, even that brokerage also not possible to claim. Only cost of acquisition is allowed. So there may be difficult situation if a person himself is mined and he created that virtual digital asset and transferred it, then that mining cost, production cost, he can claim it as deduction if that is proven. If purchased and sell it, cost of acquisition can be reduced. No other expense is possible. Even chapter 6 is also not possible. Even other losses cannot set off against this one. So against the virtual digital asset, you cannot set off any other losses, and further there cannot be any loss from transfer of VDA. That is also not possible. So loss from transfer of VDA cannot set off with any other income or cannot carry forward. So only positive income, that is taxable. Loss is not allowed, and even other losses cannot set off with this income also. It will be taxable at a flat rate of 30%. Section 87A rebate is not allowed. So even though this income does not exceed 5 lakhs and assessee has no other income or does not exceed 7 lakhs, rebate is not possible. Even basic exemption also not allowed. So a person obtained income from sale of virtual digital asset of rupees 1,50,000 and he does not have any other income, he has to pay 30% tax. Basic exemption cannot be adjusted. And further, if a person giving VDA as a gift to another person and if the value of VDA exceeds 50,000, then it will be taxable in the hands of the recipient as a movable property received as a gift. Generally under the income tax law, gift means jewelry, archaeological collection, work of art, paintings, sculptures, bullion, shares and securities, land, building and money. So to that definition, they added virtual digital asset also, 56(2)(10), provision of gift. If the market value exceeds 50,000, then it will be taxable in the hands of the donee as an income as gift. Now, the person who is buying that VDA, that is seller is selling, what we studied is aspect of the seller. So now regarding the buyer, the person who is buying VDA from the seller, he must deduct TDS. If the consideration exceeds rupees 10,000, then 1% TDS is applicable as per section 194S. So buyer at the time of making payment to the seller towards purchase of the virtual digital asset, if the consideration exceeds 10,000, he shall deduct TDS at the rate of 1%. But if the buyer is an individual or HEF and in the preceding financial year, this buyer's business turnover exceeds 1 crore, or if the buyer is a professional, his gross receipts from the profession exceeds 50 lakhs, in that situation, the limit will be 10,000. But if does not exceed 1 crore or does not exceed 50 lakhs in the preceding financial year's turnover, that means the buyer of virtual digital asset is an individual or HUF, plus that buyer is engaged in business or profession, plus his preceding financial year turnover from the business does not exceed 1 crore or does not exceed 50 lakhs, then TDS is applicable only if the amount exceeds 50,000. Instead of 10,000, it will be 50,000. And TDS should be deducted on the net amount excluding GST, because probably it may be treated as a taxable supply and there may be a possibility of GST. In that situation, if there is GST, then GST should be reduced. Only on the price we have to apply the TDS at the rate of 1%. So the threshold limit 10,000 or 50,000 depends upon status of the payer. That means status of the buyer. Okay, these are the provision. Now we can take that question. Question number 31. Compute the income tax payable by Mr. Siddhan, age 24, who has the following income for the assessment year 25-26. Income from salary computed 8,40,000. Interest on savings bank account with Axis Bank with 12,000. Consideration received on transfer of VDA to Mr. Harsh 50,000. Cost of acquisition of VDA transferred 5,000. Mr. Harsh is employed with ABC Limited on a monthly salary of 50,000. In addition, he has interest on savings bank account with the Bank of India. He does not opt out of default tax regime. He does not opt out of default tax regime means it's default, right? Default. So income from salary 8,40,000, interest on savings bank at 12,000, consideration on transfer of VDA 50, cost 5,000. So 50,000 minus 5,000. So 45,000. Taxable under 115 BBH at the rate of 30%. Against his interest on savings bank account, he is under default tax regime. So chapter 60 deduction is not possible. 8,40,000 income from salary, that is taxable. So 8,52,000 slab rate. So up to 3 lakh nil. So next 4 lakh 5%. 20,000. Next 1.52 lakhs into 10%, 15,200, correct? 45,000 into 30%, how much? 13,500. So here is total income exceeds 7 lakhs. So rebate is, otherwise rebate is not available. From VDA anyway rebate not available, but from other taxes we can claim rebate if eligibility is there. But here he is not eligible because total income crosses 7 lakhs. So this is a tax, 20,000 plus 15,200 plus 13,500. Then add 4% cess. That is a tax liability. So what is a tax liability? 56. 50,000 648. 648, right? Now there is another issue here. Who is the buyer? Buyer is Mr. Harsh is employee. Mr. Harsh is the buyer, right? Because Siddhant sold the VDA, virtual digital asset, to Harsh. So Harsh is the buyer. So buyer does not have a PGBP income, right? So if he does not have a PGBP income means TDS applicable only if the amount exceeds 50,000. So here the selling price is correct 50,000. So there will be no TDS. no TDS. So 50,648 is the tax liability. Rounded off to 50,650. Earlier we skipped a question on equalization levy, right? Question number 14. Sir, I am explaining equalization levy. So this is VDA. So what is the idea behind why equalization levy is created? The purpose is we should go to the basics, back to the basics. If a non-resident getting business income from India, business income of a non-resident can be taxable in India or deemed to accrue or arise in India only if that non-resident has a business connection in India. If the non-resident does not have a business connection either by way of a dependent agent or by way of a significant economic presence, if the non-resident does not have a business connection in India, then business income cannot be taxable in India. But even though there is no business connection, certain income can be taxed. That is interest income received from India, royalty received from India, fees for technical service received from India, dividend received from India. And again, if service is rendered in India, salary. But business income, to tax the business income, non-resident must have a business connection in India. And in that case also, if there is a double taxation avoidance agreement, then business connection is not enough. Something more concrete evidence is required. PE, permanent establishment. So taxability of business income of non-resident in India, as per domestic law, condition business connection. As per double taxation avoidance agreement, permanent establishment. So business connection present, but there is no permanent establishment, then DTAA will override domestic law. In that case also, business income cannot be taxed. So to tax a business income of non-resident in India, two conditions must be satisfied. There should be a business connection, and if there is a DTA exists, there should be PE also. So if there is no double taxation avoidance agreement with that country of that non-resident, then okay, business connection is enough. So if there is no business connection, no PE, business income of non-resident cannot be taxed. Now the question is digital advertisement, selling of web space for digital advertisement and related technical digital advertisement services. These cannot be said to be a royalty. It cannot be said to be technical service. Selling web space, we cannot say that it's at a technical service. It cannot be said to be a royalty. So it is not a royalty, it is not a FTS, and it is not a even that dividend. It is not like that. So what happened? Google, Amazon, and these type of big players, they are non-residents. They does not have a fixed place of profession in India or business in India. They don't have a business connection. They don't have a P in India, but they have a lot of virtual spaces that they will be given or selling to Indian entities, and they are getting a lot of money from India. So that money they are repatriating from India. So government can do nothing. It cannot be taxed in India because actually it is business income. So to tax the business income of non-resident, they should have a permanent establishment or business connection in India. But these Google or similar type of people, they don't have any business connection in India. Their server will be put in some other country, some tax haven country. So they cannot be taxed. So there is a huge revenue loss for the central government. So these developing countries are facing this as a base erosion and profit shifting by multinational companies. So to prevent that, BEPS action plan, they give certain suggestion. One of that suggestion was equalization levy that is implemented by central government. So this is a history of equalization levy. So when it will be applicable? It is applicable only for specified amounts. So what are the specified amounts? The specified amounts are online advertisement or providing web space or digital advertisement space for online advertisement or any other facility or service for online advertisement which will be notified by the government, and in a particular financial year, the total amount paid or payable to a non-resident payee exceeds 1 lakh. So here the payee must be non-resident, not having permanent establishment in India. Because if the non-resident is having permanent establishment in India, obviously it will be taxable as a business income in India as per section 911. So no PE. So business income cannot be taxed. So that is why payer is under an obligation to deduct equalization levy. So payee must be a non-resident not having a PE in India. And who is the payer? Payer may be a resident person carrying on business or profession in India. So remember, if the payer is an individual who does not have a business, equalization levy not applicable. If the payer does not have a business or profession, equalization levy not applicable. Payer must be a resident person having business or profession in India, or the payer may be a permanent establishment of a foreign company in India. So one foreign company may make payment to another foreign company for online advertisement. In that situation, payer foreign company shall have a PE in India, but the payee foreign company should not have a PE in India, because payee should not have a PE in India. Because if the payee have PE in India, definitely 911 directly income tax can be applied. No need to apply equalization levy. Equalization levy is not an income tax. It is levied not under the income tax law. It is levied as per the Finance Act, right? So it is levied as per Finance Act. Which Finance Act? Finance Act 2016, Chapter 8. So it is not as per income tax law. Now, when equalization levy applicable? Only if the specified amounts exceeds 1 lakh in a financial year, in a previous year. So the rate of equalization levy is 6%. Remember, it is not income tax, it is equalization levy, just like that of IDT. So on this 6%, do not add any cess or surcharge, nothing like that. It is not in plain 6% equalization levy. So it should be deducted by the payer and remaining amount should be given to the payee. So if they did not comply with this equalization levy, the consequence will be triggered in income tax. So even though it is levied as a separate provision, separate law, there is a connection between income tax law and this provision, because as it is 6% and the amount exceeds 1 lakh, it is a considerable amount. So if the people is not complying with this, there should be some strict provision to make them comply. So that is why they made a strict provision. Under PGBP, P&L account debit side, you debited online advertisement, providing web space for digital advertisement, on which equalization levy is applicable. Amount exceeds 1 lakh. You did not deduct equalization levy. Then as per section 40A(IB) or 40A(1)(B), 100% of such expenditure debited to P&L, that is that online advertisement expense, will be disallowed. So similar to 40A(1) and 40A(1)(A), they are saying during the previous year, equalization levy has to be deducted, and this equalization levy can be paid at least on or before the due date for filing IT return to not to attract the disallowance. You should pay before the due date for filing ITR. Actually, the due date for payment of equalization levy is not like that. Actually, the due date for payment of equalization levy is different. So here they are saying the due date for payment of equalization levy is 7th of the on or before 7th of the immediately following month. But here, in order to escape from the disallowance, they are saying during the previous year, deduct 6% equalization levy and pay it on or before the due date for filing ITR. Otherwise, 100% of that expenditure can be disallowed. But it is a temporary disallowance. In the subsequent year, if you complied with equalization levy, next year you can claim it deduction back. Now, as the payer complied with equalization levy in the hands of the payee, this income will be exempted as per section 10 subsection 50. Actually, it is a comedy. It cannot be taxable in the hands of the non-resident, right? Google, how Google can be taxed, right? If Indian government is saying that we don't need the service, then Google say, okay, fine. So here, see, we cannot make any operation related to internet, right? Because they are big players. So they won't pay tax. So that is why they are putting this condition, deduct 6% equalization levy. As the payer deducted equalization levy and paid tax, in your hand, it will be exempted. And they are saying, even though you are not exempted, we are not going to pay tax. So it's just like a comedy, right? 1050 is comedy. In the hands of the payee, it will be exempted. So this is equalization levy provision. Earlier, there was some complicated provisions of equalization levy of 2% regarding electronic commerce operator, but they, for the last finance 2024, they withdrawn that because it was very complicated and a lot of practical difficulties arises. So that is eliminated. So now equalization levy means only this 6% equalization. This is very easy. So try that question. Question number 14. Okay. MNO Incorporation, a country A based company, is carrying out the business of manufacture and sale of furniture under the brand name Pure Wood. In order to increase its share in Indian market, it launched a massive advertisement campaign of its product. For the purpose of online advertisement, it utilized the services of PQR Incorporation, a country Y based company which also owns and operates a digital platform. The gross receipt of PQR Incorporation from provision of such services during the previous year 24-25 is 3 crore. During the previous year 24-25, MNO Incorporation paid 5 lakhs to PQR Incorporation for such services. Discuss the tax implication of such a payment and receipt in the hands of MNO Incorporation and PQR Incorporation respectively if number 1, both MNO Incorporation and PQR Incorporation have no P in India. Okay, if both the persons have no P in India, whether this provision is applicable? No. To attract equalization levy, payer should be a PE of a foreign company in India. Payee can be non-resident not having PE. Okay, here payee satisfied the condition, but payer did not satisfy the condition. So, equalization levy not at all applicable. And second, MNO Incorporation has a permanent establishment in India, but PQR Incorporation has no permanent establishment in India. Okay. In that case, equalization levy is applicable because MNO Incorporation is the payer, that is a non-resident foreign company having a P in India, and recipient is PQR Incorporation, they does not have a P in India, and the amount exceeds 1 lakh. Here the amount paid is 5 lakh. So 5 lakhs into 6%. Equalization levy applicable, and in the hands of the PQR Incorporation, section 10 subsection 50, this 5 lakhs rupees is exempted. So second case, equalization levy applicable. And third one, PQR Incorporation has a permanent establishment in India and the advertisement services are effectively connected with such PE. Okay, then the things are completely different. If PQR Incorporation has a P in India, its business income is taxable in India. Accordingly, there is no equalization levy. But MNO Incorporation, while making the payment, they have to deduct TDS under which section? 195. 195 TDS will be triggered. Because whenever we are making a payment to non-resident, which is taxable in India, then the payer has to deduct TDS under section 195. So that provision will trigger. The third case. So first case, no income tax impact. Second case, equalization levy. Third case, no equalization levy, but 911 business income taxable in India. So the payer has to deduct TDS under section 195. Otherwise, there will be disallowance for payer. So in the second case and third case, if the equalization levy or in the third case TDS has not been deducted, then for the payer expense will be disallowed while computing PGP income. Got it? We'll take a small break. After that, we will discuss some of the provisions of charitable trust and TDS, and then we will wind up. Okay. Okay, some of the TDS provisions we can discuss, then we will go to the charitable trust. Question number 32. So Mr. Gupta, a resident Indian, is in retail business and his turnover for the financial year 23-24 last year was 12 crore. He regularly purchased goods from another resident, Mr. Agarwal, a wholesaler, and the aggregate payment made during the financial year 24-25 was rupees 95 lakhs. 20 lakhs on 1st June 24, 25 lakhs on 12th August, and again 22 lakhs on 23rd November, and 28 lakhs on 25th March. There is a breakup of that 95 lakhs. Assume that the said amounts were credited to Mr. Agarwal's account in the books of Mr. Gupta on the same date. Mr. Agarwal's turnover for financial year 23-24 was rupees 15 crore. Based on the above fact, examine the TDS or TCS implications, if any, under the Income Tax Act. Would your answer be different if Mr. Gupta's turnover for financial year 23-24 was rupees 8 crore? All the other facts remains the same. Would your answer to 1 and 2 change if PAN has not been furnished by the buyer or seller as required? Okay. So the relevant provisions are, there are two sections, 194Q and 206C subsection 1H. As per section 194Q, when the buyer making payment for purchase of goods to the seller, buyer has to deduct TDS as per section 194Q. The threshold limit is, if the purchase exceeds rupees 50 lakhs, purchase made from a single seller during the financial year exceeds rupees 50 lakhs, only on the excess amount, 0.1% TDS must be deducted. So that is provision prescribed under section 194Q. But to attract 194Q, there is a very strict condition. Buyer must be a person engaged in business and his preceding financial year turnover should exceed 10 crore. So if preceding financial year's turnover exceeds rupees 10 crore, then only in the current financial year TDS applicable for the purchase of goods exceeding rupees 50 lakhs. Simultaneously, at the same time, there is another section, TCS 206C1H. So as per section 206C1H, seller engaged in business, seller's preceding financial year turnover exceeds rupees 10 crore, current financial year seller selling goods in exceeding rupees 50 lakhs to a buyer, then on the excess amount exceeding 50 lakhs, the seller has to collect TCS from the buyer. That is 206C1H. So in the first part, both seller, that is here Agarwal is a seller, Gupta is the purchaser. So both Gupta and Agarwal, both are business people. In both sides, the turnover exceeds 10 crore because Gupta's turnover 12 crore, Agarwal's last year turnover 15 crore. So both persons turnover crosses the threshold limit of 10 and 10 crore. And in the current year, see seller, for the seller it is a sale and for the buyer it is a purchase. So both, that is 95 lakhs more than 50 lakhs. So both the sections are triggering. So if 194Q section and 206C1H simultaneously applicable, Act says 194Q will override section 206C1H. So in the first case, Mr. Gupta has to deduct TDS on the excess amount of 50 lakhs. So Agarwal not liable to collect TCS because whenever there is 194Q and 206C1H, 194Q will override 206C1H. That is prescribed under section 194Q itself. That's the first part. And now up to 50, no TCS. So no TDS. So first 20 lakh, 1st June, no TDS. Next 25 lakh, no TDS. And when he is making the purchase of another 22 lakhs, that is on 23rd November 24, it crosses 50. So at that time TDS will trigger, and again the next 28 lakhs also TDS is applicable. And in the second part, would your answer be different if Mr. Gupta's turnover in last year was rupees 8 crore? All the fact remains the same. Okay. If Gupta's preceding financial turnover does not exceed 10 crore, then 194Q section not applicable for the buyer side. So if 194Q not applicable, definitely 206C1H will be applicable. Here seller's preceding a turnover crosses 10 crore. So Agarwal has to collect TCS on the amount exceeding 50 lakhs. And now the last part. Would your answer to 1 and 2 change if PAN has not been furnished by the buyer or seller as required? Okay, in both cases, the answer will be different because under section 194Q, if PAN is not furnished, the TDS rate will be 5%. But under 206C1H, if the buyer did not furnish the PAN number to the seller, the TDS rate will be 1%. So 5% and 1% if PAN is not given. So that is question number 32. Now 33. Examine whether TDS provisions should be attracted in the following cases, and if so, under which section. Also specify the rate of TDS applicable in each case. Assume that all payments are made to residents. So before going to discuss the question, I will explain the relevant provision. So under the income tax law, total there are 6 sections where under the TDS, total 6 sections where TDS is applicable only if the turnover of the payer in the preceding financial year exceeds rupees 1 crore, or if it is a professional, preceding financial year's gross receipts exceeds 50 lakhs. So that means section 194A, 194C, 194H, 194I, 194J, 194R. So ACHIJR, 194ACHIJR. A, interest other than interest on security. C, contractors, subcontractors. H, commission. I, rent. J, professional fee, technical fee, royalty, etc. R, business or profession related perquisites. In these 6 cases, if the payer is individual or HUF, TDS applicable only if the payer is engaged in business or profession and his preceding financial year turnover from the business exceeds 1 crore. If he is a professional, gross receipts from profession should exceed 50 lakhs. So these 6 sections otherwise not applicable. This is the first point you have to keep in mind. ACHIJR. But if the payer is company or partnership firm or LLP, anyway TDS applicable. But if the payer is individual or HUF, to attract these 6 TDS sections in the current year, we should see whether the preceding financial year turnover exceeds 1 crore. So if a person does not have business or profession and he is an individual or HUF, these 6 sections are not applicable. If a person is individual or HUF having business or profession but started in the current year only, preceding year no business or profession, current year newly started, these 6 sections will not be applicable in the first year. And if assessee is a person is an individual or HUF having business but in the preceding financial year turnover does not exceed 1 crore or 50 lakhs in case of profession, in that case also these sections are not applicable. Now the second point, 194C, if the payment is made to contractor or subcontractor exclusively for personal purpose of individual and HUF, 194C not applicable. 194H, commission. If the commission is paid exclusively for personal purpose not related to business, 194H not applicable. 194J, payment of professional fee, technical fee, etc. if it is exclusively for personal purpose, 194J not applicable. So C, H, J, these 3 sections are applicable only if that payments are related to business or profession. So now, if the person is making payment to contractor or subcontractor not related to business or profession but for personal purpose, at that time, if the payment exceeds 50 lakhs, 194C cannot be applied, 194M will be applicable, 194M. Similarly, under section 194H, if the payer is an individual HUF, does not have business or profession but related to personal purpose, commission is paid exceeding 50 lakhs, M will be applied even though he has business or profession. Preceding year turnover crosses 1 crore. 194H is applicable, but he is making payment of commission for exclusively personal purpose. 194H cannot be applied, M will be applied. 194J, only if the professional fee payment made related to business, 194J TDS is applicable. If it is for personal purpose and exceeds 50 lakhs, M will be applied. So this is a question testing the knowledge of 194M and C and H and J. So this is a simple conclusion. If the payment of payment for the contract which is related to personal purpose, commission related to personal purpose not related to business, similarly professional fee not related to business purpose, when the payment exceeds 50 lakhs, C or H or J not applicable, because anyway C and H and J not applicable because it's not related to business. But if it exceeds 50 lakhs, 194M will be applied. So here the TDS rate will be 5%. That is section 194M. Okay. So first case, Ganesh, an individual carrying on retail business with a turnover of rupees 2.5 crore. So I think there is a change in TDS rate also, right? That 5% has been reduced to 2%. There's an amendment in TDS rates. Not all TDS, but some sections rates has been amended. With effect from 1st October 2024. With effect from 1st October 2024, TDS rate under section 194 M has been reduced to 2%, not 5%. Okay. So before 1st October, 5%. So particulars of the payer, Mr. Ganesh, an individual carrying on retail business with a turnover of 2.5 crore in last year. So Ganesh is an individual. Preceding financial turnover is more than 1 crore. So ACHIJR section applicable. But it should be related to business. Payment should be related to business. Mode of payment, contract payment for repair of residential house. Repair of residential house means exclusively personal purpose. So 194C is not applicable. M also not applicable because the amount does not exceed 50 lakhs. So not TDS for the first case. C not applicable because not for business. M not applicable because it does not exceed 50 lakhs. Payment of commission to Mr. Wallish for business purpose, 80,000. It is for business purpose. So 194H applicable. If the commission amount exceeds rupees 15,000, TDS rate will be 5%. And after 1st October, the rate will be 2%. So here it is 80,000. So TDS is applicable under section 194H. Rajesh, a wholesale trader whose turnover was rupees 95 lakhs in previous year 23-24. So last year the turnover does not exceed 1 crore. Does not exceed 1 crore. Current year contract payment for reconstruction of residential house made during the period January-March 2025. 20 lakh in January, 15 lakhs in February and 20 lakhs in March. So total 20 plus 15 plus 20, it crosses 50 lakhs. Here 194C is not applicable. Why 194C is not applicable? Because preceding financial turnover does not exceed 1 crore. But 194M will be applicable. So here more than 50 lakhs. So entire amount TDS will be applied at the rate of 2% under section 194M. Mr. Sadish, a salaried individual, payment of brokerage for buying a residential house in March 2025, purely personal purpose. So 194M applicable, 51 lakhs into 2%. Dheeraj, a pensioner. Pensioner means he does not have a business. Contract payment made during October-November 24 for reconstruction of residential house, 48 lakhs. 194C not applicable, but M also not applicable because it does not exceed the threshold limit of 50 lakhs. Next question. X Limited is a manufacturing company having head office at Delhi and branch office at Jaipur. X Limited has a current account with SBI Delhi and overdraft account with SBI Jaipur. The two accounts are separately operated by head office and branch office. Head office and branch office have a separate TAN and GSTN. Cash withdrawn by head office and branch office from these two accounts is as follows. So the relevant section is 194EN. As per section 194EN, if a person withdrawing cash from bank account exceeding rupees 1 crore in a financial year, on the excess amount withdrawn exceeding 1 crore, only on the excess amount, TDS will be deducted by the bank under section 194EN. So generally the threshold limit is 1 crore. So and the rate of TDS will be 194EN rate of TDS 2%. But there is a differential TDS, right? When the differential TDS is applicable, if the person withdrawing the cash did not filed ITR in all the 3 preceding years, filed belated. So last 3 years, all the 3 preceding years, if the person did not file the return within the due date. See, suppose 2 years filed belated, 1 year within that 3 year, 1 year filed on due date, 2 year belated, no problem. This provision not applicable. All the 3 years belated return is filed. In that situation, the threshold limit will be 20 lakhs. So if he withdrawn cash from the bank in a financial year exceeding rupees 20 lakhs cash withdrawal, up to 20 lakhs no TDS, between 20 lakhs and 1 crore, if he is making withdrawal 2% and exceeding 1 crore, the TDS rate will be 5%. So that is differential rate of TDS. And if the cash withdrawn by a cooperative society, the threshold limit will be 3 crore. Instead of 1 crore, it will be 3 crore. So exceeding 3 crore, excess of 3 crore, TDS will be 2%. In that case also, if the cooperative society does not file the return, all the 3 returns within the due date in the last 3 years, that situation, the threshold limit will be 20 lakhs and 20 lakhs to 3 crore, 2%, exceeding 3 crore, 5%. So that's a provision. So here, SBI Delhi head office, see all these withdrawal as from the same bank. So even though multiple account with the same bank, cumulative must be considered. So 15 lakhs when they are making withdrawal, no TDS because it is within the limit of 1 crore. 70 lakhs, no TDS. So when they are making a withdrawal of 40 lakhs, the cumulative amount will be 70 plus 40 plus 15, which will cross more than 1 crore. So up to 1 crore, no TDS. So the excess amount will be 25 lakhs, right? So on 25 lakhs, 2% TDS will be deducted. So under the TDS provisions, in all the TDS provision, only in 2 sections, TDS applicable only on the excess amount. Only in 2 sections. One is 194Q and is 194N. All other sections, once the threshold crosses, entire amount is subject to TDS. In these 2 sections, TDS only on excess amount. Similarly, in 6 sections, payer individual or HEF, that condition should be checked in the preceding year turnover crosses. 194A, CH, IJR. So first case, 25 lakhs into 2%. What would be your answer if X Limited has filed the returns for the 3 preceding years after the due date of furnishing the return of income? Okay, if all the 3 years, if they filed the return after the due date, that is belated, in that situation, the threshold limit will be 20 lakhs. So up to 20 lakhs, SBI will not collect TDS, will not deduct TDS, but between 20 to 1 crore, that is 75 lakhs, 80 lakhs, 20 to 1 crore, 80 lakhs, 2%, and 25 lakhs, that is exceeding 1 crore, 5%. Okay. So when it is come to TDS, actually the total sections are 192 is there. 192 actually important for CA final because sometimes non-resident employee may come to India rendering service in India, but the salary may be paid outside India in foreign currency. For that payment, TDS is applicable because 192 clearly says even though salary is paid in a foreign country to a non-resident, but service is rendered in India as per section 9 subsection 1 subclause 2, that salary deemed to occur or arise in India. So in that situation, that salary taxable in India. So TDS is applicable. So 192 is important. And in 192 there is some case laws are also there because in case of leave travel concession to claim the deduction, actually the evidence should be submitted by the employee to the employer. Then only while computing salary for the purpose of TDS, employer shall consider LTC exemption. Only if employee provides the evidences of that LTC exemption. Similarly, tips collected by the employer along with the bill and distributed to the employee, whether TDS is applicable, there is a case law is there. See, usually from TDS area for CF final, questions are asking in 3 ways. Number 1, if there is any complicated provision in any circular, any TDS provision which is clarified by a circular or recent notification scheme, that is very important. Second, if there is any amendment in TDS sections, that is very important. And third one is case law. Usually they are asking question based on case law. Otherwise, it will be based on a recent amendment or any complication or any complex situation which will be clarified by the CBDT. So this is the area. Otherwise, they won't ask any direct question from TDS. So after 192, there is 192A premature withdrawal from EPF. Anyway, that is very simple. If the threshold limit crosses 50,000, premature withdrawal before completing 5 years of continuous service with a company. Before completing 5 years, you are withdrawing from PF. Premature withdrawal, TDS applicable. That is 192A. Not much more important. 193, interest on securities, not that much important. 194, that is important, TDS on dividend. 222A, B, C, D, E, F, for all those dividends, TDS is applicable at the rate of 10% as per section 194. 194A, very, very important because there are a lot of case laws also associated with the 194A, interest other than interest on securities. 194A is important. Then 194B, 194BB, so that is related to winning from lottery, betting, gambling, and similarly winning from horse race. And again there is another section on winning from online game. Regarding winning from online games, there is no threshold limit is prescribed. Any amount TDS is applicable, and the timing is at the last day of the previous year, or if there is any withdrawal prior to last day of the previous year, at the time of withdrawal. And for the remaining amount available in user account, 31st March TDS should be deducted. That is winning TDS in the case of online game. Lottery, betting, gambling, and horse race, threshold limit is 10,000. If it exceeds 10,000, 30% TDS. Online game, TDS rate is 30%, but there is no threshold limit is prescribed. After 194B, BB, all those area, BA, then the next section is 194C. Contractors, subcontractors, that's very important for final. A lot of clarifications are there. Some other issues are also there. When the payment is made by channels or broadcasters to the production houses for producing a program according to the specification of the channel, whether that will be treated as a contract. Yes, it is a contract, but sometimes already produced program for which a copyright is with the production house, sometimes that will be taken by the channel only for telecasting for a particular period of time, and they will give a royalty. In that situation, the TDS will be under section 194J. So there is a circular like that. Similarly, there is another issue, contract to manufacturing. When the buyer gives an order to the contractor and the contractor manufacturing a goods according to the specification of the buyer, if the raw material required for production is also submitted by the buyer, then only it is a contract to manufacturing under section 194C. If the buyer did not supply the material, then it is not a contract manufacturing, it is a sale of goods. Q may be applicable, but C is not applicable. And again, if the payment is made to transport operator, as you are aware, if the contractor gives a declaration that he does not have more than 10 goods carriages, then no need to deduct TDS. So total contract operator, that is goods transport operators, they can enjoy total 3 concessions under the tax law. One is under section 194C, when the payment is made to goods transport contractors, if they give a declaration that they does not have more than 10 goods carriages along with the PAN number, no need to deduct TDS. And second one, as per section 40A3, goods transport operators freight can be paid up to rupees 35,000. And again, as per section 44AE, they can claim presumptive taxation without maintaining books and audit and all those things. That is, so contract section 194C is little bit important for our exam point of view. Now then 194D is there. So under section 194D, insurance commission, that is 15,000, TDS rate is 5%, that is 194D. Then 194DA. 194DA is little bit important for final because life insurance maturity, that is 194DA. Generally, the life insurance policy maturity will be exempted as per section 10 subsection 10D if the premium paid in a particular financial year does not exceed the threshold limit, but that is 10% or 20% or 15% of sum assured. But if it is not exempted, if it is taxable and the maturity amount is 1 lakh, exceeds 1 lakh, in that situation 194DA TDS will be applicable. So DA is important, life insurance maturity. And then section 194E is there. 194E, whenever we are making payment to non-resident sportsmen, non-resident entertainer, non-resident associations, etc., sports associations, that is subject to TDS at the rate of 20% plus surcharge if applicable plus cess. This is the corresponding provision is 115 BBA NR taxation. If non-resident sportsman or non-resident entertainer or non-resident sports association getting any amount for participation, games or advertisement, etc., that amount is taxable at a flat rate of 20%. So corresponding TDS is 194E. Then 194G, lottery ticket commission, not that much important. 194H, commission, some case laws are there, so that is important. 194H. Then 194I, rent, anyway important. 194IA is there. Immovable property, land and building purchase consideration exceeds 50 lakhs, TDS 1%, so that is also important. And then 194IB is there, that is rent paid by an individual not having business exceeding 50,000 per month, TDS is applicable, that is 194DA, sorry 194IB. And then 194IC is also there. So 194I, IA, IB and IC. 194IC deals with the joint development agreement consideration paid under section 45 subsection 5A. For those joint development agreement to the landowner, when the real estate developer making monetary consideration, that is subject to TDS under section 194 IC. Then 194J is there. It's very important. A lot of case laws. So J is very important. And then 194, after J, 194LA is there. And then 194K is there. That is mutual fund income from mutual fund, that is also similar to 194. That's very easy. And then 194J is there, and then 194K, then 194LA is there, right? 194LA, that is compulsory acquisition of land and building and consideration. Then 194LB, that is non-resident, LC, non-resident, LBA, non-resident. All those are related to non-resident area, and real estate investment trust when they are making distribution to unit holder. Similarly, alternate investment fund is making distribution to investor. So those are LBA, LBB. And then 194 LC, that is interest paid to non-resident. Then 194 LD. And after that, section 194 M, that we discuss. Then 194 N, cash withdrawal, we discuss. Then 194 O, that is very important for final. 194 O, that is electronic commerce operator. When they are making payment to the e-commerce participant, that is registered seller, the electronic commerce operator has to deduct TDS on the gross amount. So that is 194 O. Then 194 P is important. A resident super senior citizen, that is age 75 or more, does not have PGBP income, does not have any other income other than pension and interest income from the same bank in which pension is received. Only these two income, interest from FD or RD or savings with the bank, and through that same bank getting pension. Only these two income and no other income, and he is 75 years old or more. In that situation, he can give a declaration to the bank that I have only these too much income. In that situation, bank has to compute the total income and tax liability of that senior citizen, and that tax must be deducted as TDS under section 194P. Actual tax is the TDS under section 194P. In that situation, this person, senior citizen, no need to file ITR, exemption from filing ITR for the assessee, that is that senior citizen. That is 194P. Then 194Q, then 194R, that is business perquisites exceeds 20,000, TDS is applicable. That is very important. 194R is very important. Q is very important. P not that much important, already asked 1 or 2 times. So Q and R is very important. And then 194S is there, that is we discussed, that is virtual digital asset consideration, 10,000 or 50,000, that TDS case, that is 194S. So these are the main provisions of TDS we have to keep in mind. And then 195 payment to non-resident, that is also important. And then 196A, 196B, 196C, 196D is there. That is related to section 115AB, 115AC, 115AD. NR taxation, including foreign institutional investors taxation. So related TDS is 196A, 196B, 196C, 196D, etc. And then you should go to the TCS. 206C1, then 206C1C, then 1F, then 1G, 1H. Out of which section 206C1G, very important, foreign currency. 1H, very important. So that two sections are very important. Under section 206C1F, there is a small amendment, that is in addition to car or motor vehicle exceeding 10 lakhs, some other luxury goods will be notified. But so far nothing has been notified. So at present the motor vehicle exceeding rupees 10 lakhs, TCS has to be collected by the showroom from the customer. So that is 206C1F. So 1G, foreign currency, that's very important. Medical remittance, education remittance, overseas tour program package, any other remittance. 1G, foreign currency TCS is very important. You should go through that. Then 1H, that is seller has to collect the TCS. So those are the provisions. And then there is section 206AA and 206AB. 206AA says PAN is not furnished, then the rate of TDS will be normal rate of 20%, whichever is higher. Similarly, there is another section under TCS also. If the PAN has not been furnished, double the rate of TCS or 5%, whichever is higher, then this 206CC. And 206AB, if the payee is a, that is payer and payee, if the payee is a defaulter in filing the ITR and his TDS is more than 50,000 in the last year, in that case TDS rate will be higher, that is 206AB. Equivalent TCS 206CCA. So those 4 sections here, 206AA, 206AB, there is 206CC, 206CCA. So these 4 sections should be compared and should study like that. So TDS, TCS is a very important area, especially recent case laws or all the case laws mentioned in the study material, and then recent judicial rulings, if there is anything related to TCS and TDS, that is very important. And then this recent amendment, there are some amendment rates in has been amended in some sections, so that you must aware about that. And then circulars or notifications specifically related to certain issues in certain TDS sections. In 194Q also there is a detailed circular has been issued. In some cases 194Q is not applicable. So those circular is also very important. So this is TDS and the TCS, and then advance tax. Obviously advance tax, sometimes they may ask a question. Usually it is applicable only when the advance tax liability is 10,000 or more. Advance tax is mandatory. If it is less than 10,000, advance tax is not mandatory. Resident senior citizen not having PGBP income, even though tax liability more than 10,000, advance tax is not compulsory. And then 4 installments, 44 AD presumptive and ADA presumptive. If an assessee opted, then first 3 installments of advance tax is not applicable. So then 234B interest calculation, 234C interest calculation, that is for deferment of advance tax and shortfall or deficiency in each installment. So remember, first installment 15%, but if you paid minimum 12%, no interest. Second installment you have to pay 45%. If you paid minimum 36%, no interest. Third one 75% you must pay. Last installment 100%. So that is advance tax. So that is also important. TDS, TCS, advance tax, mainly recovery of tax. They may ask some questions, right? Regarding assessment procedure, usually they are asking question after 139. So earlier they were asking questions from 139, but anyway you should go through all those provisions: original return, belated return, revised return, especially updated return 139(8)(a). That is very important. So original return, belated, revised, updated, and defective return, then verification of return. After that, the next area is very important: inquiry before assessment 142, especially special audit 142 2A, 2B, 2C, 2D, special audit, inquiry before assessment, notice issued for inquiry. So all those area inquiry, and then assessments 144 bus judgment assessment, 143 subsection 2 scrutiny assessment or regular assessment 143(3), and then 147 reassessment, and then search assessment. So search assessment they may ask you some questions. So that is very important because old search assessment provision has been abolished and they created new provision. Again in the new Finance Act, again they made some other changes that has been made. And for the next year, I think 206C1H is not applicable. That is the last attempt. It will be January 2026 because they are going to abolish section 206C1H. So 194Q only will be there. Similarly, I think section 206 AB, that defaulter in filing of ITR. So those section in TDS and TCS also they are going to eliminate from the Income Tax Act from the next year onwards. But this will be the last attempt. They can ask questions. Now we can move to charitable trusts. So for charitable trusts, they have 2 different provisions under the income tax law. First regime 10 subsection 23C, and next one is section 11, 12 and 13. Okay, just I will tell the main provision. So first regime 1023C. So 1023C is already a person got registration under 1023C and continued that. Once the approval is over, next they cannot renew under 1023C because 1023C they are going to phase out. So nowadays only 11 to 13, 11, 12, 13. So new renewal cases they will give approval only under 11 to 13. 1023C in future that will not be available, that they are going to stop 2 regimes, only 1 regime 11 to 13. So charitable trust definition section 2 subsection 15, that is relief to the poor, education, medical relief, preservation of environment and advancement of any other object of general public utility. All the first 4 cases anyway charitable. They incidentally they can carry out any commercial activity also, but the last part, advancement of any other object of general public utility, will be treated as a charitable purpose only if they carried out any business activity, and that business activity receipts from business or commercial activity should not exceed 20% of total receipts. Then only they will get the status of charitable, otherwise they won't get the exemption. Now 11, 12, these 2 sections are the exemption providing. For a charitable trust, exemption is purely based on application. So whatever income received by the charitable trust, that must be applied for the objectives of the trust. At least 85% of the income must be applied for the objectives of the charitable trust. 15% they can claim as basic exemption from the gross receipts. Balance 85% to be applied for the objectives of the trust. So exemption based on application of income. And application must be made in India. But sometimes in rare cases where the central government approved and CBDT also approved, they can spend for charitable purpose outside India. In case of an international welfare where India is interested. So otherwise, the application must be within India. Application means simply spending. It may be for revenue purpose or it may be for capital purpose, but it must be for the objectives of the trust. So for a charitable trust, application means either revenue purpose or capital purpose. Now section 13 deals with the denial of exemption. Sometimes this exemption will not be allowed, or it will be the exemption will be denied. That is section 13, violation of conditions. And then section 115 BBC, anonymous donation. But this anonymous donation provision is not applicable for a religious trust, because for religious trust they can accept anonymous donation, no problem. It will be treated like a normal donation. But a charitable trust receives anonymous donation, then up to a particular limit. The limit is total donation into 5% or rupees 1 lakh, whichever is higher. Up to that amount, they can accept anonymous donation. And excess anonymous donation, no exemption will be given, which will be taxable at a flat rate of 30% as per section 115 BBC. 115 BBI is a new section introduced by Finance Act 2024 that says that in certain violation cases, sometimes if certain conditions has been violated, the income of the trust will be taxable, but now it will be taxable at a flat rate of 30% without giving any other benefit. That is 115 BBI. And 115 TD, a charitable trust claimed exemption for a long period of time. They created a lot of wealth, and on a fine morning, they are stopping their charitable activity and they are exiting. So at that time, government is saying all the wealth created is out of exempted income. So you have to pay exit tax. That is accreted in tax on accreted income at the rate of 30% plus surcharge plus cess. So that is 115 TD. So based on the balance sheet prepared on the date of exit, we have to find out the net accreted income, and on that we have to apply the tax. They can ask a problem from that area. Then 104A, return to be filed by the charitable trust. See, that are the main provisions. So I'm straight away going to, while computing an income of a charitable trust, what are the points we have to keep in mind? That is, we can say application of income. Application of income. So what are the conditions? So in between there is a provision of donation. Donation is prescribed under section 12. Remember, voluntary donation to be treated as normal income. Corpus donation. Corpus donation means the donation given by a donor with a specific direction that it must be forming part of capital of the trust. It must be forming part of corpus of the trust, or this donation must be utilized for this particular asset creation. That is known as corpus. Corpus donation should not be treated as income. So corpus donation will not be treated as income, but the condition is the corpus donation, whatever amount received, it must be kept in a separate account and it must be utilized only for that purpose. For what purpose it is received, it must be utilized only for that purpose. It should not be misutilized. So in that, subject to that condition, corpus donation will not be considered as income. It will be exempted. And third one is anonymous donation. Out of the anonymous donation, what is a total donation into 5%? Total donation means normal voluntary donation plus corpus donation plus anonymous donation. Out of this total donation, apply 5% or 1 lakh, whichever is higher. Up to that amount, out of anonymous, you have to reduce. That should be treated as normal income, and remaining anonymous donation will be taxable at the flat rate of 30% without any exemption. So that is a treatment of donations. Yeah. Yeah, government grant will be treated as voluntary contribution and it will be treated as income. Yeah. Yeah, yes, it will be the two views. Again, we can take a note because IC itself is putting two notes. If government grant is treated as a revenue grant and treated as a donation, then it can also be considered for the purpose of 5%. We have to put an assumption. But if simply saying government grant, not mentioning regarding any purpose, then we can take another assumption. It is for the purpose of corpus. So it is corpus donation. That we also possible. Then also we can consider for the 5% calculation, right? No problem, because corpus will be counted for 5% calculation. So application of income, how the exemption will be claimed. So remember, first we should take the income received by the trust from the main property and any incidental income received from any business activity, and if they are getting any dividend income or income from mutual fund or government grant, all these income, contributions, donations, total income. From that total income, we can claim 15% basic exemption. Other than anonymous, we can claim 15% basic exemption. So remaining balance 85% income to be applied for the object of the trust. So how application can be claimed? So application may be for revenue or capital purpose of the trust. So that purpose must be charitable purpose. It may be revenue expenditure. For example, day-to-day running of the trust, expenditure is spent, that is an application. If asset is purchased for the purpose of the trust, that is also capital purpose, that is also application. Maybe revenue or capital purpose. Application of expenditure allowed only on payment basis, that is an amendment, a recent amendment. Earlier, if some of the trustees making payment on due basis and they are claiming it as application, now that is not possible. Application of expenditure allowed only on payment basis means on accrual basis. If the expenditure is due, that's not enough, application won't be allowed. Next one, corpus donation to other trust, not allowed as application. That is also a recent development. Within 2-3 years, that amendment came. Corpus, you can give voluntary donation, normal donation out of the current year income of the trust to another trust. That can be claimed as application. But that another trust must be 12A registered or 1023C approved, having similar objects. Then you can give the donation to another registered trust, that can be claimed as application, but it should not be corpus. So voluntary donation, not corpus, to other trusts registered under 12AB or 1023C out of current year income will be allowed as application. However, only 85% of the actual donation given to other trust only can be claimed as application. So if we give 10 lakhs normal donation to another registered trust, not corpus, 10 lakhs is given, we can claim only 8.5 lakhs as application. Yeah. Yeah. Yeah, balance 85. Yeah, out of that 85, if you give application of donation to another trust 10, out of the 10, only 8.5 will be allowed. Yeah, because the other trust will get this donation, right? Then they will show us normal income, right? There they are keeping 15%, again basic exemption. And if they are given to the another trust, again 15%, finally this amount will be vanished, right? It's a beautiful way of evasion, right? So that is why, because 15% unconditional exception. Anyway, they can claim. That is why. Corpus also same objective. Why corpus is prohibited? We are giving corpus, not considered, it's not taxable, right? They are also showing it as corpus, not coming under income, not utilizing. This money is keeping there. So that is why they are saying corpus is not allowed as application. Earlier there was another fraud. When asset is purchased, you will claim it as an application, and then on that asset you will claim depreciation as an expense, operational expense. So now that is not possible. So voluntary donation, not corpus, to other trusts registered under 12AB out of current year allowed, should not be corpus. But remember, the other trust must be registered. And one more thing, what is the actual donation? Only 85% will be allowed to us as an application. Repayment of loan taken for charitable purpose allowed as an application, but there is a very strict condition. Earlier there was no such condition. It's a recent development that loan must be repaid within 5 years from the end of the financial in which a loan was taken. See, at the time of original time, when the loan has been taken, it must be treated as income. And now when the loan is repaid, you can claim it as application. If at the time of taking loan, if it is not considered as income, then now repayment won't be allowed because duplication. You are claiming excess benefit. So that is why original, at the time of taking loan, it is taken as income. So now it is repaid. Repayment can be claimed as application, but that loan should be repaid within 5 years from the end of the financial in which a loan was taken. And loan must be taken and it must be utilized for the purpose of the trust. Then only repayment will be allowed. Otherwise, it is not charitable purpose. And sometimes some charitable trust will get some huge amount of donations as on the last day of the previous year. That is 31st March 2025, they will get the donation. They cannot utilize you see on 31st March, that is a single day. Single day, you cannot spend that entire money for charitable application. That's not possible. But in April or in May, you already spend it. But the problem is donation received on 31st March. So it will put under the current income. So current income will be more. But application in next year. To solve that, they give a solution. You can do one thing. You can file a specified form number 9A within 2 months prior to the due date for filing ITR. In that form, you have to show it is the income received on the last day of the previous year. It is spent in the subsequent periods. Then that will be allowed as application, so that unnecessarily our current year income is not increasing. That can be reduced. So if non-application is due to non-receipt or due to some other genuine reason, then the same will be treated as applied in the current year itself. But if it has exercised such option in writing in form number 9A, within 2 months, it should be filed with prior to the due date for filing ITR. But such income must be fully utilized in the year of receipt. That is, March 31st you receive, next April, May, next financial year. So in that period, you should be actually fully utilized. But such income must be fully utilized in the year of receipt. Otherwise, the unutilized amount will be taxable and it will be treated as a violation. 115 BBI, flat rate 30. Normally, the rate of tax for a charitable trust is slab rate, but here it will be taxed at 30%. This unutilized amount. Similarly, 85% amount of the current year total income, we are claiming 15%, balance 85% to be applied. If you could not apply, we can earmark and set apart for future applications. Maximum time period for set apart is 5 years. Within 5 years, it must be withdrawn and it should be utilized for the purpose of the charitable trust. Whatever amount earmarked and set apart, it must be invested in specific modes prescribed under section 11 subsection 5, including nationalized bank account or immovable properties or government securities. There are certain specified modes prescribed in 11 subsection 5. Only in that modes, this earmarked and set apart amount should be deposited. Otherwise also it will be treated as income and taxable, 115 BBI 30%. So amount earmarked and set apart will be allowed as application now, but it should be utilized before the maximum period of 5 years. If you are saying 2 years, within 2 years it should be utilized. Otherwise you should make an application to extend the period. Maximum 5 years is set apart is possible. So if 85% of income could not be applied, same may be accumulated or set apart for future. Form number 10 to be filed at least 2 months prior to 139(1) due date to set apart this amount. Purpose and period should not exceed 5 years. Accumulated or set apart amount to be invested in the prescribed modes and 11(5). Misutilized or not utilized before the expiry of 5 years. On the expiry of 5 years, 6th year, it will be taxed under 115 BBI 30%. Donation to other trust out of accumulation. See, if the amount is earmarked and set apart and out of that amount give donation to other trust, that is not an application. That won't be permitted. Purchase of asset allowed as application. But if the purchase of asset is immediately taken as application, then depreciation is not allowed. And if a charitable trust having a business undertaking, incidental business undertaking, and that business undertaking has some business transaction, in that while computing that income, 40A1A, 40A3, even 40A3A, all those disallowance applicable to PGBP equally applicable for the trust. Further, while claiming application of income, see, for the purpose of the charitable trust, 10 lakhs rupees is spent. That payment is made to a contractor. TDS has not been deducted by the trust. There also this problem will arise. Application 10 lakhs paid to a contractor without deducting TDS. In that situation, out of this 10 lakhs, only 70% of 10 lakhs will be allowed as application. Balance 30% will be disallowed. See, it is not a P&L, so we cannot disallow. So they are saying only 70% will be allowed, 30% not be allowed. Similarly, for the objectives of the charitable trust, you are making payment in cash exceeding 10,000 in a single day. That won't be allowed because 40A3. So 40A1A, 40A3, 40A3A disallowance usually applicable for PGBP will be applied for a charitable trust. And further, if a charitable trust has a business undertaking incidental to the main objective, all PGBP provisions will be applied for computing income of that particular business undertaking also. But that business undertaking income will be computed, that income will be taken to main income of the charitable trust, and if it is applied, they can claim exemption. But if the objective of the charitable trust is advancement of any other object of general public utility, then the business receipt should not exceed 20% of total receipts. So these are the major points we have to keep in mind while solving problem. Circumstances where the income of a charitable trust will be taxable at 30%. That is accumulation not allowable as per IT Act. That is accumulation not made as per the prescribed procedure. That is form has not been filed or it is not been invested in prescribed modes. In those situations, it will be taxed at 30% as per BBI. Deemed income due to violation of condition. See, before the expiry of 5 years, it has not been utilized or misutilized. That will be taxed at 30%. Income applied for the benefit of interested persons. Interested persons means author of the trust, founder of the trust, or a person who is a substantial contributor. That means he is contributing more than rupees 50,000 in a year. So that is not a substantial contributor. So if income of the trust is applied for the interest of these important persons, that is a violation. That also will be taxed at 30%. So these are circumstances where 115 BBI will be applied. Now we can try a question. There's only one question is there that you should take. Question number 29, right? Question number 29. Tulsi Foundation is a public charitable trust and religious trust registered under section 12AB, runs a hospital. It furnishes you the following information for the year 31st March 2025. Under section 10 subsection 23C, if it is a medical college solely for philanthropic purpose and not for the purpose of profit, then if the aggregate annual receipts does not exceed 5 crore, it will be automatically exempted. No need to make any computation. But it is registered under 12AB. So we have to do the normal computation. Income from property held under trust 80 lakhs and income from incidental business activities 10 lakhs. So that both we can take as income. 80 plus 10, 90 lakhs. Voluntary contribution received from public amounted to rupees 40 lakhs. It includes corpus 5 lakhs and anonymous 10 lakhs. Corpus of 5 lakh invested in one of the modes specified in 11 subsection 5. So corpus is not taxable. But this voluntary donation out of this 40 lakhs, first we can eliminate corpus 5. What is the balance? 35. Out of this 35, how much is anonymous? 10 lakhs. So this 35 includes anonymous of 10. So the provision is total donation into 5% or 1 lakh, whichever is higher. Up to that amount, anonymous can be treated as normal income. So total donation 40. So 40 into 5%, how much? 2 lakhs or 1 lakh, whichever is higher, that is 2 lakhs. Okay, 2 lakh should be taken from anonymous and it should be treated as normal income. So out of anonymous treated as normal income, rupees 2 lakhs. And out of this balance 8 lakhs taxable under section 115 BBC at the rate of 30%. This 2 lakhs will be treated as normal income added to normal income because we can claim exemptions and everything. This 8 lakhs, no exception. So what is the balance voluntary donation? Balance voluntary donation out of this 40, 5 reduce 35. Out of this 35, 10 reduce, balance 25. 25. Yeah, these are the income. These are the income. So what's the total? Balance 8 lakhs, please do not add now, that is income, but that will be considered last only, because if you are adding here unnecessarily we will claim exemption, right? That is wrong. So what is the total? 117. Yeah, now we can straight away claim basic exemption 15%. 117 into 15%. How much? 17? 17.55. Reduce that, take the remaining. 99.45. Now go to the next item. Rupees 44 lakhs was applied for charitable purpose, including rupees 4 lakhs paid to a contractor in cash. Yeah, that is a violation. 4 lakh paid in cash, not allowed because 48.3. 48.3 applicable for charitable trust. Amount applied includes purchase of new computers and software for rupees 15 lakhs for the hospital out of loan taken from a bank. See, if it is taken loan taken, if it is purchased from loan taken from the bank, can it be treated as application? If loan is taken as an income earlier, then it is okay. Otherwise, we cannot take because it is directly purchased out of the loan. So it cannot be claimed as application. But when this loan is repaid, we can claim it as an application. So we are not taking that. So out of this 44 lakhs minus 4, balance 40 lakhs. So less applied 40 lakhs. So against this 99.45, you can write like this: 85% to be applied for the object of the trust. No, they're saying another sentence, right? Amount applied includes purchase. Yeah. 44 lakhs includes that, right? Yeah, please reduce that. Yeah, correct. 40 minus 15. How much? 25. The trust gave a donation 12 lakhs to Balaji Trust having object of same nature, registered under 12 AB. This includes 2 lakhs corpus. Oh, corpus, whether it is allowed? No. So 12 minus 2, what is the balance? 10 into 85%. 8.5. Corpus anyway not allowed. Regarding a normal donation, only 85% of the normal donation will be allowed. Income of 2 lakh could not be applied for charitable purpose as the same was received on last day of the previous year. Okay, no problem. You have to file that particular form within 2 months prior to the due date for filing ITR. Then it can be claimed as application, provided it should be utilized in the next months. So that is, we are taking it as application. You have to put a note. It is assumed they filed the form. Income of rupees 5 lakhs was accumulated for future charitable purpose to be utilized within 4 years. The said amount is invested in prescribed amount. Yeah, that is also can be claimed. 5 lakhs. So what is income? What is the balance income? $99.45 minus 25 minus 8.5 minus 2 lakhs minus 5 lakhs. $58.95. Now add anonymous donation taxed at 30%. Earlier we taken 2 lakhs. Sorry, 8 lakhs. Now 66.95 is the total income. The question is asking for tax liability also. So we have to find out the tax also. Out of this 66.95, for rupees 8 lakhs under section 115 BBC, we have to apply 30% flat. And for balance amount is 58.95. We have to apply slab rate. Once you got the tax, add surcharge at the rate of 10%. Then add 4% cess. you will get the tax liability. So for anonymous donation, separately tax should be computed 8 lakhs into 30%. And for 58.95, you have to compute the tax as per slab rate. Take the both tax. As the total income exceeds 50 lakhs, because normal individual rate of tax will be applicable for charitable trust. So here the total income exceeds 50 lakhs. So surcharge should be applied 10% and then cess. Okay. So I am here winding up. So one more question is there, that is accreted income. Please go through that question. It is a question in your study material. You can go through the solution. That is important area. So that you must go through that accreted income. And there is a penalty question that is also available in your study material. Computation of penalty under section 270A. So that area also you should keep in mind. So regarding penalty chapter, in my personal opinion, as a student, from a student's perspective, all these penalties, small penalties, very difficult to memorize. So do one thing, 270A, 270AA, that penalty calculation only you need to study. And some other normal penalty, tax audit penalty, non-maintenance of books penalty, return is not filed. So all those penalty you can study along with the relevant chapters. But other penalties very difficult to memorize. If you are able to memorize, you can study. Otherwise, study only this area, calculation of penalty. Under reporting of income, how will be calculated? Misreporting of income, how will be calculated, and how the tax will be computed, and how the penalty will be calculated. So that area you must need to go through that. So with these 3 days, I think what we can do maximum, I think I did that. Okay, fine. So all the best for your coming exam. Study well. So be confident, be positive, go write the exam. Even though whatever happened at the last moment of time, do not skip the attempt. That's very bad. Don't skip the attempt. Even though you studied 100% or 80% or 70% or 50%, go write the exam. Do not skip. Okay. And after January, you may aware the next, definitely there is a lot of amendments already came by Finance Act 2025. Amendments will be there, right? Not much more structural amendment, but still. So try to clear in between these two attempts. Okay. All the best.